What if one book could completely change the way you see the markets and turn confusion into clarity? Technical analysis of the financial markets is often called the Bible of trading, and honestly, it earns that title. This isn't just another trading book. It's a complete roadmap that separates losing traders from profitable ones. Whether you're just starting or you already have experience, this book teaches you how markets really move. Stocks, forex, crypto, commodities, it all follows the same core principles. Inside this book, there's a huge amount of knowledge. You'll learn the foundations of technical analysis, how to read chart patterns that repeat again and again, how indicators actually work and how to use them the right way, and most importantly, how traders think. Because the market isn't random. It's driven by fear, greed, and human behavior. But here's the problem. Reading this book alone can feel overwhelming. There's a lot of information, and it's easy to get lost. So in this video, I've done the hard work for you. I've taken the most important ideas, the key charts, and the concepts that actually matter, and turned them into simple visual explanations. No complicated language, no unnecessary details, just what you need to understand and actually improve. The book itself has 19 chapters, from basic concepts all the way to advanced strategies. In this video, we're focusing on the first 10 chapters, step by step, and in part 2, we'll cover the rest, so you get the full picture. At its core, this book teaches one powerful idea. The market moves in patterns, and those patterns can be understood. When you learn to read charts properly, you stop guessing, you stop reacting emotionally, and you start making calculated decisions. So if you're serious about becoming a better trader, and you want to finally understand what's really happening on the charts, let's get started.
Introduction. Before beginning a study of the actual techniques and tools used in technical analysis, it is necessary first to define what technical analysis is, to discuss the philosophical premises on which it is based, to draw some clear distinctions between technical and fundamental analysis, and finally, to address a couple of criticisms frequently raised against the technical approach. The author's strong belief is that a full appreciation of the technical approach must begin with a clear understanding of what technical analysis claims to be able to do, and, maybe even more importantly, the philosophy or rationale on which it bases those claims. First, let's define the subject. Technical analysis is the study of market action, primarily through the use of charts, for the purpose of forecasting future price trends. The term market action includes the three principal sources of information available to the technician: price, volume, and open interest. Open interest is used only in futures and options. The term price action, which is often used, seems too narrow because most technicians include volume and open interest as an integral part of their market analysis. With this distinction made, the terms price action and market action are used interchangeably. Throughout the remainder of this discussion, philosophy or rationale, there are three premises on which the technical approach is based. 1. Market action discounts everything. 2. Prices move in trends. 3. History repeats itself. Market action discounts everything. The statement "market action discounts everything" forms what is probably the cornerstone of technical analysis. Unless the full significance of this first premise is fully understood and accepted, nothing else that follows makes much sense. The technician believes that anything that can possibly affect the price, fundamentally, politically, psychologically, or otherwise, is actually reflected in the price of that market. It follows, therefore, that a study of price action is all that is required. While this claim may seem presumptuous, it is hard to disagree with if one takes the time to consider its true meaning. All the technician is really claiming is that price action should reflect shifts in supply and demand. If demand exceeds supply, prices should rise. If supply exceeds demand, prices should fall. This action is the basis of all economic and fundamental forecasting. The technician then turns the statement around to arrive at the conclusion that if prices are rising, for whatever the specific reasons, demand must exceed supply and the fundamentals must be bullish. If prices fall, the fundamentals must be bearish. If this last comment about fundamentals seems surprising in the context of a discussion of technical analysis, it shouldn't. After all, the technician is indirectly studying fundamentals. Most technicians would probably agree that it is the underlying forces of supply and demand, the economic fundamentals of a market, that cause bull and bear markets. The charts do not in themselves cause markets to move up or down. They simply reflect the bullish or bearish psychology of the marketplace. As a rule, chartists do not concern themselves with the reasons why prices rise or fall. Very often, in the early stages of a price trend or at critical turning points, no one seems to know exactly why a market is performing a certain way. While the technical approach may sometimes seem overly simplistic in its claims, the logic behind this first premise, that markets discount everything, becomes more compelling the more market experience one gains. It follows then that if everything that affects market price is ultimately reflected in market price, then the study of that market price is all that is necessary. By studying price charts and a host of supporting technical indicators, the chartist in effect lets the market tell him or her which way it is most likely to go. The chartist does not necessarily try to outsmart or outguess the market. All of the technical tools discussed later on are simply techniques used to aid the chartist in the process of studying market action. The chartist knows there are reasons why markets go up or down. He or she just doesn't believe that knowing what those reasons are is necessary in the forecasting process. Prices move in trends. The concept of trend is absolutely essential to the technical approach. Here, again, unless one accepts the premise that markets do in fact trend, there's no point in reading any further. The whole purpose of charting the price action of a market is to identify trends in early stages of their development for the purpose of trading in the direction of those trends. In fact, most of the techniques used in this approach are trend-following in nature, meaning that their intent is to identify and follow existing trends. See Figure 1.1. Figure 1.1 example of an uptrend. Technical analysis is based on the premise that markets trend and that those trends tend to persist. There is a corollary to the premise that prices move in trends. A trend in motion is more likely to continue than to reverse. This corollary is, of course, an adaptation of Newton's first law of motion. Another way to state this corollary is that a trend in motion will continue in the same direction until it reverses. This is another one of those technical claims that seems almost circular, but the entire trend-following approach is predicated on riding an existing trend until it shows signs of reversing. History repeats itself. Much of the body of technical analysis and the study of market action has to do with the study of human psychology. Chart patterns, for example, which have been identified and categorized over the past 100 years, reflect certain pictures that appear on price charts. These pictures reveal the bullish or bearish psychology of the market. Since these patterns have worked well in the past, it is assumed that they will continue to work well in the future. They are based on the study of human psychology, which tends not to change. Another way of saying this last premise, that history repeats itself, is that the key to understanding the future lies in a study of the past, or that the future is just a repetition of the past. Technical versus fundamental forecasting. While technical analysis concentrates on the study of market action, fundamental analysis focuses on the economic forces of supply and demand that cause prices to move higher, lower, or stay the same. The fundamental approach examines all of the relevant factors affecting the price of a market in order to determine the intrinsic value of that market. The intrinsic value is what the fundamentals indicate something is actually worth based on the law of supply and demand. If this intrinsic value is under the current market price, then the market is overpriced, and should be sold. If market price is below the intrinsic value, then the market is undervalued and should be bought. Both of these approaches to market forecasting attempt to solve the same problem, that is, to determine the direction prices are likely to move. They just approach the problem from different directions. The fundamentalist studies the cause of market movement, while the technician studies the effect. The technician, of course, believes that the effect is all that he or she wants or needs to know and that the reasons or the causes are unnecessary. The fundamentalist always has to know why. Most traders classify themselves as either technicians or fundamentalists. In reality, there's a lot of overlap. Many fundamentalists have a working knowledge of the basic tenets of chart analysis. At the same time, many technicians have at least a passing awareness of the fundamentals. The problem is that the charts and fundamentals are often in conflict with each other. Usually, at the beginning of important market moves, the fundamentals do not explain or support what the market seems to be doing. It is at these critical times in the trend that these two approaches seem to differ the most. Usually they come back into sync at some point, but often too late for the trader to act. One explanation for these seeming discrepancies is that market price tends to lead the known fundamentals. Stated another way, market price acts as a leading indicator of the fundamentals or the conventional wisdom of the moment, while the known fundamentals have already been discounted and are already in the market. Prices are now reacting to the unknown fundamentals. Some of the most dramatic bull and bear markets in history have begun with little or no perceived change in the fundamentals. By the time those changes became known, the new trend was well underway. After a while, the technician develops increased confidence in his or her ability to read the charts. The technician learns to be comfortable in a situation where market movement disagrees with the so-called conventional wisdom. A technician begins to enjoy being in the minority. He or she knows that eventually the reasons for market action will become common knowledge. It is just that the technician isn't willing to wait for that added confirmation. In accepting the premises of technical analysis, one can see why technicians believe their approach is superior to the fundamentalists. If a trader had to choose only one of the two approaches to use, the choice would logically have to be the technical, because by definition, the technical approach includes the fundamental. If the fundamentals are reflected in market price, then the study of those fundamentals becomes unnecessary. Chart reading becomes a shortcut form of fundamental analysis. The reverse, however, is not true. Fundamental analysis does not include a study of price action. It is possible to trade financial markets using just the technical approach. It is doubtful that anyone could trade off the fundamentals alone with no consideration of the technical side of the market. Analysis versus timing. This last point is made clearer if the decision-making process is broken down into two separate stages, analysis and timing. Because of the high leverage factor in the futures markets, timing is especially crucial in that arena. It is quite possible to be correct on the general trend of the market and still lose money. Because margin requirements are so low in futures trading, usually less than 10%, a relatively small price move in the wrong direction can force the trader out of the market with the resulting loss of all or most of that margin. In stock market trading, by contrast, a trader who finds him or herself on the wrong side of the market can simply decide to hold onto the stock, hoping that it will stage a comeback at some point. Futures traders don't have that luxury. A buy and hold strategy doesn't apply to the futures arena. Both the technical and the fundamental approach can be used in the first phase, the forecasting process. However, the question of timing, of determining specific entry and exit points, is almost purely technical. Therefore, considering the steps the trader must go through before making a market commitment, it can be seen that the correct application of technical principles becomes indispensable at some point in the process, even if fundamental analysis was applied in the earlier stages of the decision. Timing is Also important in individual stock selection and in the buying and selling of stock market sector and industry groups. Flexibility and adaptability of technical analysis. One of the great strengths of technical analysis is its adaptability to virtually any trading medium and time dimension. There is no area of trading in either stocks or futures where these principles do not apply. The chartist can easily follow as many markets as desired, which is generally not true of his or her fundamental counterpart. Because of the tremendous amount of data the latter must deal with, most fundamentalists tend to specialize. The advantages here should not be overlooked. For one thing, markets go through active and dormant periods, trending and non-trending stages. The technician can concentrate his or her attention and resources in those markets that display strong trending tendencies and choose to ignore the rest. As a result, the chartist can rotate his or her attention and capital to take advantage of the rotational nature of the markets. At different times, certain markets become hot and experience important trends. Usually those trending periods are followed by quiet and relatively trendless market conditions, while another market or group takes over. The technical trader is free to pick and choose. The fundamentalist, however, who tends to specialize in only one group, doesn't have that kind of flexibility. Even if he or she were free to switch groups, the fundamentalist would have a much more difficult time doing so than would the chartist. Another advantage the technician has is the big picture. By following all of the markets, he or she gets an excellent feel for what markets are doing in general and avoids the tunnel vision that can result from following only one group of markets. Also, because so many of the markets have built-in economic relationships and react to similar economic factors, price action in one market or group may give valuable clues to the future direction of another market or group of markets. Technical analysis applied to different trading mediums. The principles of chart analysis apply to both stocks and futures. Actually, technical analysis was first applied to the stock market and later adapted to futures. With the introduction of stock index futures, the dividing line between these two areas is rapidly disappearing. International stock markets are also charted and analyzed according to technical principles. See Figure 1.2. Financial futures, including interest rate markets and foreign currencies, have become enormously popular over the past decade and have proven to be excellent subjects for chart analysis. Technical principles play a role in options trading. Technical forecasting can also be used to great advantage in the hedging process. Figure 1.2. The Japanese stock market charts very well, as do most stock markets around the world, versus the fundamentalist. Most seem to fall into one category or the other. Whether or not the traditional chartist uses quantitative work to supplement his or her analysis, charts remain the primary working tool. Everything else is secondary. Charting, of necessity, remains somewhat subjective. The success of the approach depends, for the most part, on the skill of the individual chartist. The term art charting has been applied to this approach because chart reading is largely an art. By contrast, the statistical or quantitative analyst takes these subjective principles, quantifies, tests, and optimizes them for the purpose of developing mechanical trading systems. These systems or trading models are then programmed into a computer that generates mechanical buy and sell signals. These systems range from the simple to the very complex. However, the intent is to reduce or completely eliminate the subjective human element in trading, to make it more scientific. These statisticians may or may not use price charts in their work, but they are considered technicians as long as their work is limited to the study of market action. Even computer technicians can be subdivided further into those who favor mechanical systems or the black box approach, and those who use computer technology to develop better technical indicators. The latter group maintains control over the interpretation of those indicators and also the decision-making process. One way of distinguishing between the chartist and the statistician is to say That all chartists are technicians, but not all technicians are chartists. Although these terms are used interchangeably throughout this book, it should be remembered that charting represents only one area in the broader subject of technical analysis. A brief comparison of technical analysis in stocks and futures. A question often asked is whether technical analysis as applied to futures is the same as the stock market. The answer is both yes and no. The basic principles are the same, but there are some significant differences. The principles of technical analysis were first applied to stock market forecasting and only later adapted to futures. Most of the basic tools, bar charts, point and figure charts, price patterns, volume, trend lines, moving averages, and oscillators, for example, are used in both areas. Anyone who has learned these concepts in either stocks or futures wouldn't have too much trouble making the adjustment to the other side. However, there are some general areas of difference having more to do with the different nature of stocks and futures than with the actual tools themselves. Pricing structure. The pricing structure in futures is much more complicated than in stocks. Each commodity is quoted in different units and increments. Grain markets, for example, are quoted in cents per bushel, livestock markets in cents per pound, gold and silver in dollars per ounce, and interest rates in basis points. The trader must learn the contract details of each market, which exchange it is traded on, how each contract is quoted, what the minimum and maximum price increments are, and what these price increments are worth. Limited lifespan. Unlike stocks, futures contracts have expiration dates. A March 1999 Treasury bond contract, for example, expires in March of 1999. The typical futures contract trades for about a year and a half before expiration. Therefore, at any one time, at least a half dozen different contract months are trading in the same commodity at the same time. The trader must know which contracts to trade and which ones to avoid. This is explained later in this book. This limited life feature causes some problems for longer-range price forecasting. It necessitates the continuing need for obtaining new charts once old contracts stop trading. The chart of an expired contract isn't of much use. New charts must be obtained for the newer contracts along with their own technical indicators. This constant rotation makes the maintenance of an ongoing chart library a good deal more difficult. For computer users, it also entails greater time and expense by making it necessary to be constantly obtaining new historical data as old contracts expire. Lower margin requirements. This is probably the most important difference between stocks and futures. All futures are traded on margin, which is usually less than 10% of the value of the contract. The result of these low margin requirements is tremendous leverage. Relatively small price moves in either direction tend to become magnified in their impact on overall trading results. For this reason, it is possible to make or lose large sums of money very quickly in futures, because a trader puts up only 10% of the value of the contract as margin, then a 10% move in either direction will either double the trader's money or wipe it out. By magnifying the impact of even minor market moves, the high leverage factor sometimes makes the futures markets seem more volatile than they actually are. When someone says, for example, that he or she was wiped out in the futures market, remember that he or she only committed 10% in the first place. From the standpoint of technical analysis, the high leverage factor makes timing in the futures markets much more critical than it is in stocks. The correct timing of entry and exit points is crucial in futures trading and much more difficult and frustrating than market analysis. Largely for this reason, technical trading skills become indispensable to a successful futures trading program. Time frame is much shorter because of the high leverage factor and the need for close monitoring of market positions. The time horizon of the commodity trader is much shorter of necessity. Stock market technicians tend to look more at the longer range picture and talk in time frames that are beyond the concern of the average commodity trader. Stock technicians may talk about where the market will be in 3 or 6 months. Futures traders want to know where prices will be next week, tomorrow, or maybe even later this afternoon. This has necessitated the refinement of very short-term timing tools. One example is the moving average. The most commonly watched averages in stocks are 50 and 200 days. In commodities, most moving averages are under 40 days. A popular moving average combination in futures, for example, is 4, 9, and 18 days. Greater reliance on timing. Timing is everything in futures trading. Determining the correct direction of the market only solves a portion of the trading problem. If the timing of the entry point is off by a day or sometimes even minutes, it can mean the difference between a winner or a loser. It's bad enough to be on the wrong side of the market and lose money. Being on the right side of the market and still losing money is one of the most frustrating and unnerving aspects of futures trading. It goes without saying that timing is almost purely technical in nature because the fundamentals rarely change on a day-to-day basis. Less reliance on market averages and indicators. Stock market analysis is based heavily on the movement of broad market averages such as the Dow Jones Industrial Average or the S&P 500. In addition, technical indicators that measure the strength or weakness of the broader market, like the NYSE Advanced Decline Line or the New Highs New Lows list, are heavily employed, while commodity markets can be tracked using measures like the Commodity Research Bureau Futures Price Index. Less emphasis is placed on the broader market approach. Commodity market analysis concentrates more on individual market action. That being the case, technical indicators that measure broader commodity trends aren't used much. With only about 20 or so active commodity markets, there isn't much need. Specific technical tools. While most of the technical tools originally developed in the stock market have some application in commodity markets, they are not used in the exact same way. For example, chart patterns in futures often tend not to form as fully as they do in stocks. Futures traders rely more heavily on shorter-term indicators that emphasize more precise trading signals. These points of difference and many others are discussed later in this book. Finally, there is another area of major difference between stocks and futures. Technical analysis in stocks relies much more heavily on the use of sentiment indicators and flow of funds analysis. Sentiment indicators monitor the performance of different groups such as odd lotters, mutual funds, and floor specialists. Enormous importance is placed on sentiment indicators that measure the overall market bullishness and bearishness on the theory that the majority opinion is usually wrong. Flow of funds analysis refers to the cash position of different groups, such as mutual funds or large institutional accounts. The thinking here is that the larger the cash position, the more funds that are available for stock purchases. Technical analysis in the futures markets is a much purer form of price analysis. While contrary opinion theory is also used to some extent, much more emphasis is placed on basic trend analysis and the application of traditional technical indicators. Some criticisms of the technical approach. A few questions generally crop up in any discussion of the technical approach. One of these concerns is the self-fulfilling prophecy. Another is the question of whether or not past price data can really be used to forecast future price direction. The critic usually says something like, "Charts tell us where the market has been, but can't tell us where it is going." For the moment, we'll put aside the obvious answer that a chart won't tell you anything if you don't know how to read it. The random walk theory questions whether prices trend at all, and doubts that any forecasting technique can beat a simple buy and hold strategy. These questions deserve a response. The self-fulfilling prophecy. The question of whether there is a self-fulfilling prophecy at work seems to bother most people because it is raised so often. It is certainly a valid concern, but of much less importance than most people realize. Perhaps the best way to address this question is to quote from a text that discusses some of the disadvantages of using chart patterns. A. The use of most chart patterns has been widely publicized in the last several years. Many traders are quite familiar with these patterns and often act on them in concert. This creates a self-fulfilling prophecy, as waves of buying or selling are created in response to bullish or bearish patterns. B. Chart patterns are almost completely subjective. No study has yet succeeded in mathematically quantifying any of them. They are literally in the mind of the beholder. These two criticisms contradict one another, and the second point actually cancels out the first. If chart patterns are completely subjective and in the mind of the beholder, then it is hard to imagine how everyone could see the same thing at the same time, which is the basis of the self-fulfilling prophecy. Critics of charting can't have it both ways. They can't, on the one hand, criticize charting for being so objective and obvious that everyone will act in the same way at the same time, thereby causing the price pattern to be fulfilled, and then also criticize charting for being too subjective. The truth of the matter is that charting is very subjective. Chart reading is an art. Possibly the word skill would be more to the point. Chart patterns are seldom so clear that even experienced chartists always agree on their interpretation. There is always an element of doubt and disagreement. As this book demonstrates, there are many different approaches to technical analysis that often disagree with one another. Even if most technicians did agree on a market forecast, they would not all necessarily enter the market at the same time and in the same way. Some would try to anticipate the chart signal and enter the market early. Others would buy the breakout from a given pattern or indicator. Still others would wait for the pullback after the breakout before taking action. Some traders are aggressive, others are conservative. Some use stops to enter the market, while others like to use market orders or resting limit orders. Some are trading for the long pull, while others are day trading. Therefore, the possibility of all technicians acting at the same time and in the same way is actually quite remote. Even if the self-fulfilling prophecy were of major concern, it would probably be self-correcting in nature. In other words, traders would rely heavily on charts until their concerted actions started to affect or distort the markets. Once traders realized this was happening, they would either stop using the charts or adjust their trading tactics. For example, they would either try to act before the crowd or wait longer for greater confirmation. So, even if the self-fulfilling prophecy did become a problem over the near term, it would tend to correct itself. It must be kept in mind that bull and bear markets only occur and are maintained when they are justified by the law of supply and demand. Technicians could not possibly cause a major market move just by the sheer power of their buying and selling. If this were the case, technicians would all become wealthy very quickly. Of much more concern than the chartists is the tremendous growth in the use of computerized technical trading systems in the futures market. These systems are mainly trend-following in nature, which means that they are all programmed to identify and trade major trends. With the growth in professionally managed money in the futures industry and the proliferation of multi-million-dollar public and private funds, most of which are using these technical systems, tremendous concentrations of money are chasing only a handful of existing trends. Because the universe of futures markets is still quite small, the potential for these systems distorting short-term price action is growing. However, even in cases where distortions do occur, they are generally short-term in nature and do not cause major moves. Here again, so it seems that the use of past price data to predict the future in technical analysis is grounded in sound statistical concepts. If anyone were to seriously question this aspect of technical forecasting, he or she would have to also question the validity of every other form of forecasting based on historical data, which includes all economic and fundamental analysis. Random walk theory. The random walk theory, developed and nurtured in the academic community, claims that price changes are serially independent and that price history is not a reliable indicator of future price direction. In a nutshell, price movement is random and unpredictable. The theory is based on the efficient market hypothesis, which holds that prices fluctuate randomly about their intrinsic value. It also holds that the best market strategy to follow would be a simple buy and hold strategy as opposed to any attempt to beat the market. While there seems little doubt that a certain amount of randomness or noise does exist in all markets, it's just unrealistic to believe that all price movement is random. This may be one of those areas where empirical observation and practical experience prove more useful than sophisticated statistical techniques, which seem capable of proving anything the user has in mind or incapable of disproving anything. It might be useful to keep in mind that randomness can only be defined in the negative sense of an inability to uncover systematic patterns in price action. The fact that many academics have not been able to discover the presence of these patterns does not prove that they do not exist. The academic debate as to whether markets trend is of little interest to the average market analyst or trader who is forced to deal in the real world where market trends are clearly visible. If the reader has any doubts on this point, a casual glance through any chart book, randomly selected, will demonstrate the presence of trends in a very graphic way. How do the random walkers explain the persistence of these trends if prices are serially independent, meaning that what happened yesterday or last week has no bearing on what may happen today or tomorrow? How do they explain the profitable real-life track records of many trend-following systems? How, for example, would a buy and hold strategy fare in the commodity futures markets where timing is so crucial? Would those long positions be held during bear markets? How would traders even know the difference between bull and bear markets if prices are unpredictable and don't trend? In fact, how could a bear market even exist in the first place, because that would imply a trend?
C.
Figure 1.3. Figure 1.3. A random walker would have a tough time convincing a holder of gold bullion that there's no real trend on this chart. It seems doubtful that statistical evidence will ever totally prove or disprove the random walk theory. However, the idea that markets are random is totally rejected by the technical community. If the markets were truly random, no forecasting technique would work. Far from disproving the validity of the technical approach, the efficient market hypothesis is very close to the technical premise that markets discount everything. The academics, however, feel that because markets quickly discount all information, there's no way to take advantage of that information. The basis of technical forecasting, already touched upon, is that important market information is discounted in the market price long before it becomes known. Without meaning to, the academics have very eloquently stated the need for closely monitoring price action and the futility of trying to profit from fundamental information, at least over the short term. Finally, it seems only fair to observe that any process appears random and unpredictable to those who do not understand the rules under which that process operates. An electrocardiogram printout, for example, might appear like a lot of random noise to a layperson. But to a trained medical person, all those little blips make a lot of sense and are certainly not random. The working of the markets may appear random to those who have not taken the time to study the rules of market behavior. The illusion of randomness gradually disappears as the skill in chart reading improves. Hopefully, that is exactly what will happen as the reader progresses through the various sections of this book. There may even be hope for the academic world. A number of leading American universities have begun to explore behavioral finance, which maintains that human psychology and securities pricing are intertwined. That, of course, is the primary basis of technical analysis.
Universal Principles.
When an earlier version of this book was published 12 years ago, many of the technical timing tools that were explained were used mainly in the futures markets. Over the past decade, however, these tools have been widely employed in analyzing stock market trends. The technical principles that are discussed in This book can be applied universally to all markets, even mutual funds.
1.
Additional feature of stock market trading that has gained wide popularity in the past decade has been sector investing, primarily through index options and mutual funds. Later in the book, we'll show how to determine which sectors are hot and which are not by applying technical timing tools. 2. Dow Theory. Introduction. Charles Dow and his partner Edward Jones founded Dow Jones and Company in 1882. Most technicians and students of the markets concur that much of what we call technical analysis today has its origins in theories first proposed by Dow. Around the turn of the century, Dow published his ideas in a series of editorials. He wrote for the Wall Street Journal. Most technicians today recognize and assimilate Dow's basic ideas, whether or not they recognize the source.
Dow
Theory still forms the cornerstone of the study of technical analysis, even in the face of today's sophisticated computer technology and the proliferation of newer and supposedly better technical indicators. On July 3, 1884, Dow published the first stock market average composed of the closing prices of 11 stocks, 9 railroad companies, and 2 manufacturing firms. Dow felt that these 11 stocks provided a good indication of the economic health of the country. In 1897, Dow determined that 2 separate indices would better represent that health and created a 12-stock industrial index and a 20-stock rail index. By 1928, the industrial index had grown to include 30 stocks, the number at which it stands today. The editors of the Wall Street Journal have updated the list numerous times in the ensuing years, adding a utility index in 1929. In 1984, the year that marked the 100th anniversary of Dow's first publication, the Market Technicians Association presented a Gorham Silver Bowl to Dow Jones and Company. According to the MTA, the award recognized the lasting contribution that Charles Dow made to the field of investment analysis. His index, the forerunner of what today is regarded as the leading barometer of stock market activity, remains a vital tool for market technicians 80 years after his death. Unfortunately for us, Dow never wrote a book on his theory. Instead, he set down his ideas of stock market behavior in a series of editorials that the Wall Street Journal published around the turn of the century. In 1903, the year after Dow's death, S.A. Nelson compiled these essays into a book entitled The ABC of Stock Speculation. In that work, Nelson first coined the term Dow's theory. Richard Russell, who wrote the introduction to a 1978 reprint, compared Dow's contribution to stock market theory with Freud's contribution to psychiatry. In 1922, William Peter Hamilton, Dow's associate and successor at the Journal, categorized and published Dow's tenets in a book entitled The Stock Market Barometer. Robert Rhea developed the theory even further in the Dow Theory. New York, Barron's, published in 1932. Dow applied his theoretical work to the stock market averages that he created, namely the industrials and the rails. However, most of his analytical ideas apply equally well to all market averages. This chapter will describe the 6 basic tenets of Dow theory, and will discuss how these ideas fit into a modern study of technical analysis. We will discuss the ramifications of these ideas in the chapters that follow. Basic tenets. 1. The averages discount everything. The sum and tendency of the transactions of the stock exchange represent the sum of all Wall Street's knowledge of the past, immediate and remote, applied to the discounting of the future. There is no need to add to the averages, as some statisticians do, elaborate compilations of commodity price index numbers, bank clearings, fluctuations in exchange, volume of domestic and foreign trades, or anything else. Wall Street considers all these things. Hamilton, pages 40, 41. Sound familiar? The idea that the markets reflect every possible knowable factor that affects overall supply and demand is one of the basic premises of technical theory, as was mentioned in Chapter 1. The theory applies to market averages as well as it does to individual markets, and even makes allowances for acts of God. While the markets cannot anticipate events such as earthquakes and various other natural calamities, they quickly discount such occurrences and almost instantaneously assimilate their affects into the price action. 2. The market has three trends. Before discussing how trends behave, we must clarify what Dow considered a
trend.
Dow defined an uptrend as a situation in which each successive rally closes higher than the previous rally high, and each successive rally low also closes higher than the previous rally low. In other words, an uptrend has a pattern of rising peaks and troughs. The opposite situation, with successively lower peaks and troughs, defines a downtrend. Dow's definition has withstood the test of time and still forms the cornerstone of trend analysis. Dow believed that the laws of action and reaction apply to the markets just as they do to the physical universe. He wrote, "Records of trading show that in many cases when a stock reaches top it will have a moderate decline and then go back again to near the highest figures. If after such a move the price again recedes, it is liable to decline some distance." Nelson, page 43. Dow considered a trend to have three parts: primary, secondary, and minor, which he compared to the tide, waves, and ripples of the sea. The primary trend represents the tide, the secondary or intermediate trend represents the waves that make up the tide, and the minor trends behave like ripples on the waves. An observer can determine the direction of the tide by noting the highest point on the beach reached by successive waves. If each successive wave reaches further inland than the preceding one, the tide is flowing in. When the high point of each successive wave recedes, the tide has turned out and is ebbing. Unlike actual ocean tides, which last a matter of hours, Dow conceived of market tides as lasting for more than a year and possibly for several years. The secondary, or intermediate, trend represents corrections in the primary trend and usually lasts 3 weeks to 3 months. These intermediate corrections generally retrace between 1/3 and 2/3 of the previous trend movement and most frequently about half, or 50%, of the previous move. According to Dow, the minor, or near-term, trend usually lasts less than 3 weeks. This near-term trend represents fluctuations in the intermediate
trend.
We will discuss trend concepts in greater detail in Chapter 4, Basic Concepts of Trends, where you will see that we continue to use the same basic concepts and terminology today. 3. Major trends have 3 phases. Dow focused his attention on primary or major trends, which he felt usually take place in 3 distinct phases: an accumulation phase, a public participation phase, and a distribution phase. The accumulation phase represents informed buying by the most astute investors. If the previous trend was down, then at this point these astute investors recognize that the market has assimilated all the so-called bad news. The public participation phase, where most technical trend followers begin to participate, occurs when prices begin to advance rapidly and business news improves. The distribution phase takes place when newspapers begin to print increasingly bullish stories, when economic news is better than ever, and when speculative volume and public participation increase. During this last phase, the same informed investors who began to accumulate near the bear market bottom, when no one else wanted to buy, begin to distribute before anyone else starts selling. Students of Elliott wave theory will recognize this division of a major bull market into 3 distinct phases. R. N. Elliott elaborated upon Rhea's work in Dow Theory to recognize that a bull market has 3 major upward movements. In Chapter 13, Elliott wave theory will show the close similarity between Dow's 3 phases of a bull market and the 5-wave Elliott sequence. 4. The averages must confirm each other. Dow, in referring to the industrial and rail averages, meant that no important bull or bear market signal could take place unless both averages gave the same signal. thus confirming each other. He felt that both averages must exceed a previous secondary peak to confirm the inception or continuation of a bull market. He did not believe that the signals had to occur simultaneously, but recognized that a shorter length of time between the two signals provided stronger confirmation. When the two averages diverged from one another, Dow assumed that the prior trend was still maintained. Elliott wave theory only requires that signals be generated in a single average. Chapter 6, Continuation. Patterns, will cover the key concepts of confirmation and divergence.
C.
Figures 2.1 and 2.2. 5. Volume must confirm the trend. Dow recognized volume as a secondary but important factor in confirming price signals. Simply stated, volume should expand or increase in the direction of the major trend. In a major uptrend, volume would then increase as prices move higher and diminish as prices fall. In a downtrend, volume should increase as prices drop and diminish as they rally. Dow considered volume a secondary indicator. He based his actual buy and sell signals entirely on closing prices.
In
Chapter 7, Volume and Open Interest, will cover the subject of volume and build on Dow's ideas. Today's sophisticated volume indicators help determine whether volume is increasing or falling off. Savvy traders then compare this information to price action to see if the two are confirming each other. Figure 2.1, a long-term view of the Dow theory at work. For a major bull trend to continue, both the Dow Industrials and the Dow Transports must advance together. 6. A trend is assumed to be in effect until it gives definite signals that it has reversed. This tenet, which we touched upon in Chapter 1, forms much of the foundation of modern trend-following approaches. It relates a physical law to market movement, which states that an object in motion, in this case a trend, tends to continue in motion until some external force causes it to change direction.
A.
Number of technical tools are available to traders to assist in the difficult task of spotting reversal signals, including the study of support and resistance levels, price patterns, trend lines, and moving averages. Some indicators can provide even earlier warning signals of loss of momentum. All of that notwithstanding, the odds usually favor that the existing trend will continue. Figure 2.2, examples of two Dow theory confirmations. At the start of 1997, point 1, the Dow Transports confirmed the earlier breakout in the industrials. The following May, point 2, the Dow Industrials confirmed the earlier new high in the transports. The most difficult task for a Dow theorist, or any trend follower for that matter, is being able to distinguish between a normal secondary correction in an existing trend and the first leg of a new trend in the opposite direction.
Dow
Theorists often disagree as to when the market gives an actual reversal signal. Figures 2.3a and 2.3b show how this disagreement manifests itself. Figures 2.3a and 2.3b illustrate two different market scenarios. In Figure 2.3a, notice that the rally at point C is lower than the previous peak at A's price, then declines below point B. The presence of these two lower peaks and two lower troughs gives a clear-cut sell signal at the point where the low at B is broken, point S. This reversal pattern is sometimes referred to as a failure swing. Figure 2.3 of failure swing. The failure of the peak at C to overcome A, followed by the violation of the low at B, constitutes a sell signal at S. Figure 2.3b, non-failure swing. Notice that C exceeds A before falling below B. Some Dow theorists would see a sell signal at S1, while others would need to see a lower high at E before turning bearish at S2. In Figure 2.3b, the rally top at C is higher than the previous peak at A. Then, price declines below point B. Some Dow theorists would not consider the clear violation of support at S1 to be a bona fide sell signal. They would point out that only lower lows exist in this case, but not lower highs. They would prefer to see a rally to point E, which is lower than point C. Then they would look for Another new low under point D. To them, S2 would represent the actual sell signal with 2 lower highs and 2 lower lows. The reversal pattern shown in Figure 2.3b is referred to as a non-failure swing. A failure swing, shown in Figures 2.3a, is a much weaker pattern than the non-failure swing in Figure 2.3b. Figures 2.4a and 2.4b show the same scenarios at a market bottom, the use of closing prices, and the presence of lines. Dow relied exclusively on closing prices. He believed that averages had to close higher than a previous peak or lower than a previous trough to have significance. Dow did not consider intraday penetrations valid. Figure 2.4 a failure swing bottom. The buy signal takes place when point B is exceeded at B1. Figure 2.4b non-failure swing bottom. Buy signals occur at points B1 or B2. When traders speak of lines in the averages, they are referring to horizontal patterns that sometimes occur on the charts. These sideways trading ranges usually play the role of corrective phases and are usually referred to as consolidations. In more modern terms, we might refer to such lateral patterns as rectangles. Some criticisms of Dow theory. Dow theory has done well over the years in identifying major bull and bear markets, but has not escaped criticism. On average, Dow theory misses 25% of a move before generating a signal. Many traders consider this to be too
late.
A Dow theory buy signal usually occurs in the second phase of an uptrend, as price penetrates a previous intermediate peak. This is also, incidentally, about where most trend-following technical systems begin to identify and participate in existing trends. In response to this criticism, traders must remember that Dow never intended to anticipate trends. Rather, he sought to recognize the emergence of major bull and bear markets and to capture the large middle portion of important market moves. Available records suggest that Dow's theory has performed that function reasonably well. From 1920 to 1975, Dow theory signals captured 68% of the moves in the industrial and transportation averages and 67% of those in the S&P 500 Composite Index. Source: Barron's. Those who criticize Dow theory for failing to catch actual market tops and bottoms lack a basic understanding of the trend-following philosophy. Stocks as economic indicators. Dow apparently never intended to use his theory to forecast the direction of the stock market. He felt its real value was to use stock market direction as a barometric reading of general business conditions. We can only marvel at Dow's vision and genius. In addition to formulating a great deal of today's price forecasting methodology, he was among the first to recognize the usefulness of stock market averages as a leading economic indicator. Dow theory applied to futures trading. Dow's work considered the behavior of stock averages. While most of that original work has significant application to commodity futures, there are some important distinctions between stock and futures trading. For one thing, Dow assumed that most investors follow only the major trends and would use intermediate corrections for timing purposes only. Dow considered the minor or near-term trends to be unimportant. Obviously, this is not the case in futures trading, in which most traders who follow trends trade the intermediate instead of the major trend. These traders must pay a great deal of attention to minor swings for timing purposes. If a futures trader expected an intermediate uptrend to last for a couple of months, he or she would look for short-term dips to signal purchases. In an intermediate downtrend, the trader would use minor bounces to signal short sales. The minor trend, therefore, becomes extremely important in futures trading. New ways to trade the Dow averages. For the first 100 years of its existence, the Dow Jones Industrial Average could only be used as a market indicator. That all changed on October 6, 1997, when futures and options began trading on Dow's venerable average. For the first time, the Chicago Board of Trade launched a futures contract on the Dow Jones Industrial Average, while options on the Dow symbol DJX, started trading at the Chicago Board Options Exchange. In addition, options were also launched on the Dow Jones Transportation Average, symbol DJTA, and the Dow Jones Utility Index, symbol DJUA.
In
January 1998, the American Stock Exchange started trading the diamonds, a trust, a unit investment trust that mimics the 30 Dow Industrials.
In
addition, 2 mutual funds were offered based on the 30 Dow benchmark. Mr. Dow would probably be happy to know that, a century after their creation, it would now be possible to trade his Dow averages and actually put his Dow theory into practice. Conclusion. This chapter presented a relatively quick review of the more important aspects of the Dow theory. It will become clear, as you continue through this book, that an understanding and appreciation of Dow theory provides a solid foundation for any study of technical analysis. Much of what is discussed in the following chapters represents some adaptation of Dow's original theory. The standard definition of a trend, the classification of a trend into 3 categories and phases, the principles of confirmation and divergence, the interpretation of volume, and the use of percentage retracements, to name a few, all derive in one way or another from Dow theory. In addition to the sources already cited in this chapter, an excellent review of the principles of Dow theory can be found in Technical Analysis of Stock Trends, Edwards and McGee. 3. Chart construction. Introduction. This chapter is primarily intended for those readers who are unfamiliar with bar chart construction. We'll begin by discussing the different types of charts available and then turn our focus to the most commonly used chart, the daily bar chart. We'll look at how the price data is read and plotted on the chart. Volume and open interest are also included in addition to price. We'll then look at other variations of the bar chart, including longer range weekly and monthly charts. Once that has been completed, we'll be ready to start looking at some of the analytical tools applied to that chart in the following chapter. Those readers already familiar with the charts themselves might find this chapter too basic. Feel free to move on to the next chapter. Types of charts available. The daily bar chart has already been acknowledged as the most widely used type of chart in technical analysis. There are, however, other types of charts also used by technicians, such as line charts, point and figure charts, and more recently,
candlesticks.
Figure 3.1 shows a standard daily bar chart. It's called a bar chart because each day's range is represented by a vertical bar. The bar chart shows the open, high, low, and closing prices. The tick to the right of the vertical bar is the closing price. The opening price is the tick to the left of the bar. Figure 3.2 shows what the same market looks like on a line chart. In the line chart, only the closing price is plotted for each successive day. Many chartists believe that because the closing price is the most critical price of the trading day, a line or close-only chart is a more valid measure of price activity. Figure 3.1 a daily bar chart of Intel. Each vertical bar represents 1 day's action. Figure 3.2 a line chart of Intel. This type of chart produces a solid line by connecting the successive closing prices. A third type of chart, the point and figure chart, is shown in Figure 3.3. Notice here that the point and figure chart shows the same price action, but in a more compressed format. Notice the alternating column of X's and O's. The X columns show rising prices and the O columns, declining prices. Buy and sell signals are more precise and easier to spot on the point and figure chart than on the bar chart. This type of chart also has a lot more flexibility. Chapter 11 covers point and figure charts. Candlesticks. Candlestick charts are the Japanese version of bar charting and have become very popular in recent years among Western chartists. The Japanese candlestick records the same 4 prices as the traditional bar chart: the open, the close, the high, and the low. The visual presentation differs, however. On the candlestick chart, a thin line called the shadow shows the day's price range from the high to the low. A wider portion of the bar, called the real body, measures the Distance between the open and the close. If the close is higher than the open, the real body is white, positive. If the close is lower than the open, the real body is black, negative. See Figure 3.4. Figure 3.3a point and figure chart of Intel. Notice the alternating columns of X's and O's. The X column shows rising prices. The O column shows falling prices. Buy and sell signals are more precise on this type of chart. The key to candlestick charts is the relationship between the open and the
close.
Possibly because of the growing popularity of candlesticks, Western chartists now pay a lot more attention to the opening tick on their bar charts.
You
Can do everything with a candlestick chart that you can do with a bar chart.
in
Other words, all the technical tools and indicators we'll be showing you for the bar chart can also be used on candlesticks. We'll show you a bit later in the chapter how to construct bar charts for weekly and monthly periods. You can do the same with candlesticks. Chapter 12, Japanese Candlesticks, provides a more thorough explanation of candlestick charting. Figure 3.4a Candlestick chart of Intel. The color of the candlestick is determined by the relationship between the open and the close.
white.
Candlesticks are positive, while black candlesticks are negative. Arithmetic versus logarithmic scale. Charts can be plotted using arithmetic or logarithmic price scales. For some types of analysis, particularly for very long-range trend analysis, there may be some advantage to using logarithmic charts. See Figures 3.5 and 3.6. Figure 3.5 shows what the different scales would look like. On the arithmetic scale, the vertical price scale shows an equal distance for each price unit of change. Notice, in this example, that each point on the arithmetic scale is equidistant. On the log scale, however, note that the percentage increases get smaller as the price scale increases. The distance from points 1 to 2 is the same as the distance from points 5 to 10 because they both represent the same doubling in price. For example, a move from 5 to 10 on an arithmetic scale would be the same distance as a move from 50 to 55, even though the former represents a doubling in price, while the latter is a price increase of only 10%. Prices plotted on ratio or log scale show equal distances for similar percentage moves. For example, a move from 10 to 20, a 100% increase, would be the same distance on a log chart as a move from 20 to 40 or 40 to 80. Many stock market chart services use log charts, whereas futures chart services use arithmetic. Charting software packages allow both types of scaling, as shown in Figure 3.6. Figure 3.5, a comparison of an arithmetic and logarithmic scale. Notice the equal spacing on the scale to the left. The log scale shows percentage changes. Right scale. Construction of the daily bar chart. The construction of the daily bar chart is extremely simple. The bar chart is both a price and a time chart. The vertical axis, the y-axis, shows a scale representing the price of the contract. The horizontal axis, the x-axis, records the passage of
time.
Dates are marked along the bottom of the chart. All the user has to do is plot a vertical bar in the appropriate day from the day's high to the day's low, called the range. Place a horizontal tick to the right of the vertical bar identifying the daily closing price. See Figure 3.7. The reason for placing the tick to the right of the bar is to distinguish it from the opening price, which chartists record to the left of the bar. Once that day's activity has been plotted, the user moves one day to the right to plot the next day's action. Most chart services use 5-day weeks. Weekends are not shown on the chart. Whenever an exchange is closed during the trading week, that day's space is left blank. The bars along the bottom of the chart measure volume.
C.
Figure 3.7. Figure 3.6 longer view of Intel using two different price scales. The chart to the left shows the traditional arithmetic scale. The chart on the right shows a logarithmic scale. Notice that the 3-year uptrend line worked better on the log chart. Volume Another piece of important information should be included on the bar chart. Volume. Volume represents the total amount of trading activity in that market for
that day.
It is the total number of futures contracts traded during the day or the number of common stock shares that change hands on a given day in the stock market. The volume is recorded by a vertical bar at the bottom of the chart under that day's price bar. A higher volume bar means the volume was heavier for that
day.
A smaller bar represents lighter volume. A vertical scale along the bottom of the chart is provided to help plot the data, as shown in Figure 3.7. Figure 3.7, a closer look at the Intel daily bar chart. Each bar measures the day's price range. The opening price is marked by the small tick to the left of each
bar.
The closing tick is to the right. The bars along the bottom measure each day's volume. Futures open interest. Open interest is the total number of outstanding futures contracts that are held by market participants at the end of the day. Open interest is the number of outstanding contracts held by the longs or the shorts, not the total of both. Remember, because we're dealing with futures contracts, for every long there must also be a short. Therefore, we only have to know the totals on one side. Open interest is marked on the chart with a solid line along the bottom, usually just above the volume but below the price. See Figure 3.8. Figure 3.8, a daily line chart of a Treasury bond futures contract. The vertical bars along the bottom measure the total daily volume. The solid line along the middle represents the total outstanding open interest for the Treasury bond futures market. Total versus individual volume and open interest numbers in futures. Futures chart services, along with most futures technicians, use only the total volume and open interest figures. Although figures are available for each individual delivery month, the total figures for each commodity market are the ones that are used for forecasting purposes. There is a good reason for this. In the early stages of a futures contract's life, volume and open interest are usually quite small. The figures build up as the contract reaches maturity. In the last couple of months before expiration, however, the numbers begin to drop. Again, obviously, traders have to liquidate open positions as the contract approaches expiration. Therefore, the increase in the numbers in the first few months of life and the decline near the end of trading have nothing to do with market direction and are just a function of the limited life feature of a commodity futures contract. To provide the necessary continuity in volume and open interest numbers and to give them forecasting value, the total numbers are
generally used.
Stock charts plot total volume figures, but do not include open interest. Volume and open interest reported a day late in futures. Futures volume and open interest numbers are reported a day late. Therefore, the chartist must be content with a day's lag in obtaining and interpreting the figures. The numbers are usually reported during the following day's trading hours, but too late for publication in the day's financial newspapers. Estimated volume. Figures are available, however, after the markets close and are included in the following morning's paper. Estimated volume numbers are just that, but they do at least give the futures technician some idea of whether trading activity was heavier or lighter the previous day. In the morning paper, therefore, what the reader gets is the last day's futures prices along with an estimated volume figure. Official volume and open interest numbers, however, are given for the day before. Stock chartists don't have that problem. Volume totals for stocks are immediately available. The value of individual volume and open interest numbers in futures. The individual open interest numbers in futures do provide valuable information. They tell us which contracts are the most liquid for trading purposes.
As a
general rule, trading activity should be limited to those delivery months with the highest open interest. Months with low open interest numbers should be avoided. As the term implies, higher open interest means that there is more interest in certain delivery months. Weekly and monthly bar charts. We've focused so far on the daily bar chart. However, be aware that a bar chart can be constructed for any time period. The intraday bar chart measures the high, low, and last prices for periods as short as 5 minutes. The average daily bar Chart covers from 6 to 9 months of price action. For longer-range trend analysis, however, weekly and monthly bar charts must be used. The value of using these longer-range charts is covered in Chapter 8, but the method of constructing and updating the charts is essentially the same. See figures 3.9 and 3.10. On the weekly chart, one bar represents the price activity for the entire
week.
On the monthly chart, each bar shows the entire month's price action. Obviously, weekly and monthly charts compress the price action to allow for much longer range trend analysis. A weekly chart can go back as much as 5 years and a monthly chart up to 20 years. It's a simple technique that helps the chartist study the markets from a longer range perspective, a valuable perspective that is often lost by relying solely on daily charts. Figure 3.9, a weekly bar chart of the US dollar index. Each bar represents 1 week's price data. By compressing the price data, the weekly chart allows for chart analysis of longer-range price trends, usually in the vicinity of 5 years. Figure 3.10, a monthly bar chart of the US dollar index. Each bar represents 1 month's price data. By compressing the data even further, the monthly chart allows chart analysis for periods as long as 20 years. Conclusion: now that we know how to plot a bar chart, and having introduced the 3 basic sources of information, price, volume, and open interest, we're ready to look at how that data is interpreted. Remember that the chart only records the data.
In
itself, it has little value. It's much like a paintbrush and canvas. By themselves, they have no value. In the hands of a talented artist, however, they can help create beautiful images. Perhaps an even better comparison is a scalpel. In the hands of a gifted surgeon, it can help save lives. In the hands of most of us, however, a scalpel is not only useless, but might even be dangerous. A chart can become an extremely useful tool in the art or skill of market forecasting once the rules are understood. Let's begin the process. In the next chapter, we'll look at some of the basic concepts of trend and what I consider to be the building blocks of chart analysis. 4 basic concepts of trend. Definition of trend. The concept of trend is absolutely essential to the technical approach to market analysis. All of the tools used by the chartist, support and resistance levels, price patterns, moving averages, trend lines, etc., have the sole purpose of helping to measure the trend of the market for the purpose of participating in that
trend.
We often hear such familiar expressions as always trade in the direction of the trend, never buck the trend, or the trend is your friend. So let's spend a little time to define what a trend is and classify it into a few categories. In a general sense, the trend is simply the direction of the market, which way it's moving. But we need a more precise definition with which to work. First of all, markets don't generally move in a straight line in any direction. Market moves are characterized by a series of zigzags. These zigzags resemble a series of successive waves with fairly obvious peaks and troughs. It is the direction of those peaks and troughs that constitutes market trend. Whether those peaks and troughs are moving up, down, or sideways tells us the trend of the market. An uptrend would be defined as a series of successively higher peaks and troughs. A downtrend is just the opposite, a series of declining peaks and troughs. Horizontal peaks and troughs would identify a sideways price trend. See figures 4.1 AD. Figure 4.1, an example of an uptrend with ascending peaks and troughs. Figure 4.1b, example of a downtrend with descending peaks and troughs. Figure 4.1c, example of a sideways trend with horizontal peaks and troughs. This type of market is often referred to as trendless. Figure 4.1d, example of a downtrend turning into an uptrend. The first portion to the left shows a downtrend. From April 1996 to April 1997, the market traded sideways. During the summer 1997, the trend turned up. Trend has three directions. We've mentioned an uptrend, downtrend, and sideways trend for a very good reason. Most people tend to think of markets as being always in either an uptrend or a downtrend. The fact of the matter is that markets actually move in three directions: up, down, and sideways. It is important to be aware of this distinction because for at least a third of the time, by a conservative estimate, prices move in a flat, horizontal pattern that is referred to as a trading range. This type of sideways action reflects a period of equilibrium in the price level, where the forces of supply and demand are in a state of relative balance.
If.
You'll recall, Dow theory refers to this type of pattern as a line. Although we've defined a flat market as having a sideways trend, it is more commonly referred to as being trendless. Most technical tools and systems are trend-following in nature, which means that they are primarily designed for markets that are moving up or down. They usually work very poorly or not at all when markets enter these lateral or trendless phases. It is during these periods of sideways market movement that technical traders experience their greatest frustration and systems traders their greatest equity losses. A trend-following system, by its very definition, needs a trend in order to do its stuff. The failure here lies not with the system. Rather, the failure lies with the trader who is attempting to apply a system designed for trending markets into a non-trending market environment. There are three decisions confronting the trader: whether to buy a market, go long, sell a market, go short, or do nothing, stand aside. When a market is rising, the buying strategy is preferable. When it is falling, the second approach would be correct. However, when the market is moving sideways, the third choice, to stay out of the market, is usually the wisest. Trend has three classifications. In addition to having three directions, trend is usually broken down into the three categories mentioned in the previous chapter. Those three categories are the major, intermediate, and near-term trends. In reality, there are almost an infinite number of trends interacting with one another, from the very short-term trends, covering minutes and hours, to super-long trends lasting 50 or 100 years. Most technicians, however, limit trend classifications to three. There is a certain amount of ambiguity, however, as to how different analysts define each trend. Dow theory, for example, classifies the major trend as being in effect for longer than a year, because futures traders operate in a shorter time dimension than do stock investors. I would be inclined to shorten the major trend to anything over 6 months in the commodity markets. Dow defined the intermediate or secondary trend as 3 weeks to as many months, which also appears about right for the futures markets. The near-term trend is usually defined as anything less than 2 or 3 weeks. Each trend becomes a portion of its next larger trend. For example, the intermediate trend would be a correction in the major trend. In a long-term uptrend, the market pauses to correct itself for a couple of months before resuming its upward path. That secondary correction would itself consist of shorter waves that would be identified as near-term dips and rallies. This theme recurs many times, that each trend is part of the next larger trend and is itself comprised of smaller trends. See figures 4.2a and b. In figure 4.2a, the major trend is up as reflected by the rising peaks and troughs, points 1, 2, 3, 4. The corrective phase, 2 to 3, represents an intermediate correction within the major uptrend. But notice that the wave 2 to 3 also breaks down into 3 smaller waves, A, B, C. At point C, the analyst would say that the major trend was still up, but the intermediate and near-term trends were
Down.
At point 4, all 3 trends would be up. It is important to understand the distinction between the various degrees of trend. When someone asks what the trend is in a given market, it is difficult, if not impossible, to respond until you know which trend the person is inquiring about. You may have to respond in the manner previously discussed by defining the 3 different trend classifications. Figure 4.2, example of the 3 degrees of trend: major, secondary, and near term. Points 1, 2, 3, and 4 show the major uptrend. Wave 2 to 3 represents a secondary correction within the major uptrend. Each secondary wave, in turn, divides into near-term trends. For example, secondary wave 2 to 3 divides into minor waves ABC. Figure 4.2b, the major trend, over a year, is up during 1997. A short-term correction occurred during March. An intermediate correction lasted from August to November, 3 months. The intermediate correction broke down into 3 short-term trends. Quite a bit of misunderstanding arises because of different traders' perceptions as to what is meant by a trend. To long-term position traders, a few days to a few weeks price action might be insignificant. To a day trader, a 2 or 3 day advance might constitute a major uptrend. It's especially important, then, to understand the different degrees of trend and to make sure that all involved in a transaction are talking about the same ones. As a general statement, most trend-following approaches focus on the intermediate trend, which may last for several months. The near-term trend is used primarily for timing purposes. In an intermediate uptrend, short-term setbacks would be used to initiate long positions. Support and resistance. In the previous discussion of trend, it was stated that prices move in a series of peaks and troughs, and that the direction of those peaks and troughs determined the trend of the market. Let's now give those peaks and troughs their appropriate names and, at the same time, introduce the concepts of support and resistance. The troughs, or reaction lows, are called support. The term is self-explanatory and indicates that support is a level or area on the chart under the market where buying interest is sufficiently strong to overcome selling pressure. As a result, a decline is halted and prices turn back up again. Usually a support level is identified beforehand by a previous reaction low. In Figure 4.3a, points 2 and 4 represent support levels in an uptrend. See Figures 4.3a and b. Resistance is the opposite of support and represents a price level or area over the market where selling pressure overcomes buying pressure and a price advance is turned back. Usually a resistance level is identified by a previous
peak.
In Figure 4.3, points 1 and 3 are resistance levels. Figure 4.3 shows an uptrend. In an uptrend, the support and resistance levels show an ascending
pattern.
Figure 4.3b shows a downtrend with descending peaks and troughs. In the downtrend, points 1 and 3 are support levels under the market, and points 2 and 4 are resistance levels over the market. Figure 4.3 shows rising support and resistance levels in uptrend. Points 2 and 4 are support levels, which are usually previous reaction lows. Points 1 and 3 are resistance levels, usually marked by previous peaks. Figure 4.3b shows support and resistance in a downtrend. In an uptrend, the resistance levels represent pauses in that uptrend and are usually exceeded at some point. In a downtrend, support levels are not sufficient to stop the decline permanently but are able to check it at least temporarily. A solid grasp of the concepts of support and resistance is necessary for a full understanding of the concept of trend. For an uptrend to continue, each successive low support level must be higher than the one preceding it.
Each
rally high resistance level must be higher than the one before it.
If the
corrective dip in an uptrend comes all the way down to the previous low, it may be an early warning that the uptrend is ending or at least moving from an uptrend to a sideways trend. If the support level is violated, then a trend reversal from up to down is likely. Each time a previous resistance peak is being tested, the uptrend is in an especially critical phase. Failure to exceed a previous peak in an uptrend, or the ability of prices to bounce off the previous support low in a downtrend, is usually the first warning that the existing trend is changing. Chapters 5 and 6 on Price patterns show how the testing of these support and resistance levels form. Pictures on the charts that suggest either a trend reversal in progress or merely a pause in the existing trend. But the basic building blocks on which those price patterns are based are support and resistance levels. Figures 4.4a-c are examples of a classic trend reversal. Notice in figure 4.4a that at point 5 prices failed to exceed the previous peak, point 3 before turning down to violate the previous low at point 4. This trend reversal could have been identified simply by watching the support and resistance levels.
In our
coverage of price patterns, this type of reversal pattern will be identified as a double top. How support and resistance levels reverse their roles. So far we've defined support as a previous low and resistance as a previous
high.
However, this is not always the case. This leads us to one of the more interesting and lesser known aspects of support and resistance, their reversal of roles. Whenever a support or resistance level is penetrated by a significant amount, they reverse their roles and become the opposite. In other words, a resistance level becomes a support level and support becomes resistance.
To
understand why this occurs, perhaps it would be helpful to discuss some of the psychology behind the creation of support and resistance levels. Figure 4.4, example of a trend reversal. The failure of prices at point 5 to exceed the previous peak at point 3 followed by a downside violation of the previous low at point 4 constitutes a downside trend reversal. This type of pattern is called a double top. Figure 4.4b example of a bottom reversal pattern. Usually, the first sign of a bottom is the ability of prices at point 5 to hold above the previous low at point 3. The bottom is confirmed when the peak at 4 is overcome. Figure 4.4c example of a bottom reversal. During January 1998, prices retested the December support low and bounced off it, forming a second support level. The upside penetration of the middle resistance peak signaled the psychology of support and resistance. To illustrate, let's divide the market participants into 3 categories: the longs, the shorts, and the uncommitted. The longs are those traders who have already purchased contracts. The shorts are those who have already committed themselves to the sell side. The uncommitted are those who have either gotten out of the market or remain undecided as to which side to enter. Let's assume that a market starts to move higher from a support area where prices have been fluctuating for some time. The longs, those who bought near the support area, are delighted but regret not having bought more. If the market would dip back near that support area again, they could add to their long positions. The shorts now realize or strongly suspect that they are on the wrong side of the market. How far the market has moved away from that support area will greatly influence these decisions, but we'll come back to that point a bit later. The shorts are hoping and praying for a dip back to that area where they went short so they can get out of the market where they got in their break-even point. Those sitting on the sidelines can be divided into 2 groups: those who never had a position and those who, for one reason or another, liquidated previously held long positions in the support area. The latter group are, of course, mad at themselves for liquidating their longs prematurely and are hoping for another chance to reinstate those longs near where they sold them. The final group, the undecided, now realize that prices are going higher and resolve to enter the market on the long side on the next good buying opportunity. All 4 groups are resolved to buy the next dip. They all have a vested interest in that support area under the market. Naturally, if prices do decline near that support, renewed buying by all 4 groups will materialize to push prices up. The more trading that takes place in that support area, the more significant it becomes because more participants have a vested interest in that area. The amount of trading in a given support or resistance area can be determined in 3 ways: the amount of time spent there, volume, and how recently the trading took place. The longer the period of time that prices trade in a support or resistance area, the more significant that area becomes. For example, if prices trade sideways for 3 weeks in a congestion area before moving higher, that support area would be more important than if only 3 days of trading had occurred. Volume is another way to measure the significance of support and resistance. If a support level is formed on heavy volume, this would indicate that a large number of units changed hands and would mark that support level as more important than if very little trading had taken place. Point and figure charts that measure the intraday trading activity are especially useful in identifying these price levels where most of the trading took place and, consequently, where support and resistance will be most likely to function. A third way to determine the significance of a support or resistance area is how recently the trading took place. Because we are dealing with the reaction of traders to market movement and to positions that they have already taken or failed to take, it stands to reason that the more recent the activity, the more potent it becomes. Now let's turn the tables and imagine that, instead of moving higher, prices move lower. In the previous example, because prices advanced, the combined reaction of the market participants caused each downside reaction to be met with additional buying, thereby creating new support. However, if prices start to drop and move below the previous support area, the reaction becomes just the opposite. All those who bought in the support area now realize that they made a mistake. For futures traders, their brokers are now calling frantically for more margin money. Because of the highly leveraged nature of futures trading, traders cannot sit with losses very long. They must put up additional margin money or liquidate their losing positions. What created the previous support in the first place was the predominance of buy orders under the market. Now, however, all of the previous buy orders under the market have become sell orders over the market. Support has become resistance. And the more significant that previous support area was, that is, the more recent, and the more trading that took place there, the more potent it now becomes as a resistance area. All of the factors that created support by the 3 categories of participants, the longs, the shorts, and the uncommitted, will now function to put a ceiling over prices on subsequent rallies or bounces. It is useful once in a while to pause and reflect on why the price patterns used by chartists and concepts like support and resistance actually do work. It's not because of some magic produced by the charts or some lines drawn on those charts. These patterns work because they provide pictures of what the market participants are actually doing and enable us to determine their reactions to market events. Chart analysis is actually a study of human psychology and the reactions of traders to changing market conditions. Unfortunately, because we live in the fast-paced world of financial markets, we tend to rely heavily on chart terminology and shortcut expressions that overlook the underlying forces that created the pictures on the charts in the first place. There are sound psychological reasons why support and resistance levels can be identified on price charts and why they can be used to help predict market movements. Support becoming resistance and vice versa. Degree of penetration. A support level, penetrated by a significant margin, becomes a resistance level, and vice versa. Figures 4.5a, c are similar to figures 4.3a and b, but with one added refinement. Notice that as prices are rising in figure 4.5 of the reaction at point 4 stops at or above the top of the peak at point 1. That previous peak at point 1 had been a resistance level, but once it was decisively penetrated by wave 3, that previous resistance peak became a support level. All of the previous selling near the top of wave 1, creating the resistance level, has now become buying under the market. In figure 4.5b, howing declining prices, point 1, which had been a previous support level under the market, has now become a resistance level over the market, acting as a ceiling at point 4. Figure 4.5, in an uptrend, resistance levels that have been broken by a significant margin become support levels. Notice that once resistance at point 1 is exceeded, it provides support at point 4. Previous peaks function as support on subsequent corrections. Figure 4.5b in a downtrend. Violated support levels become resistance levels on subsequent bounces. Notice how previous support at point 1 became resistance at point 4. Figure 4.5c roll reversal at play. Once the early 1997 resistance peak was broken, it reversed rolls to become a support level. A year later, the intermediate price decline found support right at that prior resistance peak, which had become new support. It was mentioned earlier that the distance prices traveled away from support or resistance increased the significance of that support or resistance. This is particularly true when support and resistance levels are penetrated and reverse rolls. For example, it was stated that support and resistance levels reverse rolls only after a significant penetration. But what constitutes significant? There is quite a bit of subjectivity involved here in determining whether penetration is significant or not. As a benchmark, some chartists use a 3% penetration as a criteria, particularly for major support and resistance levels. Shorter-term support and resistance areas would probably require a much smaller number, like 1%. In reality, each analyst must decide for himself or herself what constitutes a significant penetration. It's important to remember, however, that support and resistance areas only reverse rolls when the market moves far enough away to convince the market participants that they have made a mistake. The farther away the market moves, the more convinced they become. The importance of round numbers as support and resistance. There is a tendency for round numbers to stop advances or declines.
Traders tend
to think in terms of important round numbers such as 10, 20, 25, 50, 75, 100, and multiples of 1,000 as price objectives and act accordingly. These round numbers, therefore, will often act as psychological support or resistance levels. A trader can use this information to begin taking profits as an important round number is approached. The gold market is an excellent example of this phenomenon. The 1982 bear market low was right at $300. The market then rallied to just above $500 in the first quarter of 1983 before falling to $400. A gold rally in 1987 stopped at $500 again. From 1990 to 1997, gold failed each attempt to break through $400. The Dow Jones Industrial Average has shown a tendency to stall at multiples of 1,000. One trading application of this principle is to avoid placing trading orders right at these obvious round numbers. For example, if the trader is trying to buy into a short-term market dip in an uptrend, it would make sense to place limit orders just above an important round number. Because others are trying to buy the market at the round number, the market may never get there. Traders looking to sell on a bounce should place resting sell orders just below round numbers. The opposite would be true when placing protective stops on existing positions. As a general rule, avoid placing protective stops at obvious round numbers. In other words, protective stops on long positions should be placed below round numbers and on short positions above such numbers. The tendency for markets to respect round numbers, and especially the more important round numbers previously referred to, is one of those peculiar market characteristics that can prove most helpful in trading and should be kept in mind by the technically oriented trader. Trend lines. Now that we understand support and resistance, let's add another building block to our arsenal of technical tools, the trend line. See figures 4.6a. The basic trend line is one of the simplest of the technical tools employed by the chartist, but is also one of the most valuable. An uptrend line is a straight line drawn upward to the right along successive reaction lows as shown by the solid line in figure 4.6a. A downtrend line is drawn downward to the right along successive rally peaks as shown in figure 4.6b. Figure 4.6, an example of an uptrend line. The uptrend line is drawn under the rising reaction lows. A tentative trend line is first drawn under two successively higher lows, points 1 and 3, but needs a third test to confirm the validity of the trend line, point 5. Figure 4.6b, a downtrend line is drawn over the successively lower rally highs. The tentative downtrend line needs 2 points, 1 and 3, to be drawn and a third. Test 5 to confirm its validity. Figure 4.6, see long-term uptrend line at work. The uptrend line was drawn upward, and to the right along the first two reaction lows, see arrows. The third low at the start of 1998 bounced right off the rising trend line, thereby keeping the uptrend intact. Drawing a trend line. The correct drawing of trend lines is a lot like every other aspect of charting, and some experimenting with different lines is usually necessary to find the correct
1.
Sometimes a trend line that looks correct may have to be redrawn, but there are some useful guidelines in the search for that correct line. First of all, there must be evidence of a trend. This means that for an up trend line to be drawn, there must be at least 2 reaction lows with a second low higher than the first. Of course, it always takes 2 points to draw any straight line. In Figure 4.6a, for example, only after prices have begun to move higher from point 3 is the chartist reasonably confident that a reaction low has been formed, and only then can a tentative up trend line be drawn under points 1
and 3.
Some chartists require that the peak at point 2 be penetrated to confirm the uptrend before drawing the trend line. Others only require a 50% retracement of wave 2 to 3, or that prices approach the top of wave 2. While the criteria may differ, the main point to remember is that the chartist wants to be reasonably sure that a reaction low has been formed before identifying a valid reaction low. Once 2 ascending lows have been identified, a straight line is drawn connecting the lows and projected up and to the right. Tentative versus the valid trend line. So far, all we have is a tentative trend line. In order to confirm the validity of a trend line, however, that line should be touched a third time with prices bouncing off of it. Therefore, in Figure 4.6a, the successful test of the uptrend line at point 5 confirmed the validity of that line. Figure 4.6b shows a downtrend, but the rules are the same. The successful test of the trend line occurs at point 5.
2.
Summarize, 2 points are needed to draw the trend line, and a third point to make it a valid trend line. How to use the trend line. Once the third point has been confirmed and the trend proceeds in its original direction, that trend line becomes very useful in a variety of ways. One of the basic concepts of trend is that a trend in motion will tend to remain in motion. As a corollary to that, once a trend assumes a certain slope or rate of speed, as identified by the trend line, it will usually maintain the same slope. The trend line then helps not only to determine the extremities of the corrective phases, but, maybe even more importantly, tells us when that trend is changing. In an uptrend, for example, the inevitable corrective dip will often touch or come very close to the uptrend line. Because the intent of the trader is to buy dips in an uptrend, that trend line provides a support boundary under the market that can be used as a buying area. A downtrend line can be used as a resistance area for selling purposes. See Figures 4.7a and b. As long as the trend line is not violated, it can be used to determine buying and selling areas. However, at point 9 in Figures 4.7a, b, the violation of the trend line signals a trend change, calling for liquidation of all positions in the direction of the previous trend. Very often, the breaking of the trend line is one of the best early warnings of a change in trend. Figure 4.7, once the uptrend line has been established, subsequent dips near the line can be used as buying areas. Points 5 and 7 in this example could have been used for new or additional longs. The breaking of the trend line at point 9 called for liquidation of all longs by signaling a downside trend reversal. Figure 4.7b, points 5 and 7 could have been used as selling areas. The breaking of the trend line at point 9 signaled an upside trend reversal. How to determine the significance of a trend line. Let's discuss some of the refinements of the trend line. First, what determines the significance of a trend line? The answer to that question is twofold. The longer it has been intact and the number of times it has been tested. A trend line that has been successfully tested 8 times, for example, that has continually demonstrated its validity, is obviously a more significant trend line than one that has only been touched 3 times. Also, a trend line that has been in effect for 9 months is of more importance than one that has been in effect for 9 weeks or 9 days. The more significant the trend line, the more confidence it inspires, and the more important is its penetration. Trend lines should include all price action. Trend lines on bar charts should be drawn over or under the entire day's price range. Some chartists prefer to draw the trend line by connecting only the closing prices, but that is not the more standard procedure. The closing price may very well be the most important price of the day, but it still represents only a small sample of that day's activity. The technique of including the day's price range takes into account all of the activity and is the more common usage. See Figure 4.8. Figure 4.8. The correct drawing of a trend line should include the entire day's trading range. How to handle small trend line penetrations. Sometimes prices will violate a trend line on an intraday basis, but then close in the direction of the original trend, leaving the analyst in some doubt as to whether or not the trend line has actually been broken. See Figure 4.9. Figure 4.9 shows how such a situation might look. Prices did dip under the trend line during the day but closed back above the uptrend line. Should the trend line be redrawn? Figure 4.9. Sometimes an intraday violation of a trend line will leave the chartist in doubt as to whether the original trend line is still valid or if a new line should be drawn. A compromise is to keep the original trend line but draw a new dotted line until it can be better determined which is the truer line. Unfortunately, there's no hard and fast rule to follow in such a situation. Sometimes it is best to ignore the minor breach, especially if subsequent market action proves that the original line is still valid. What constitutes a valid breaking of a trend line? As a general rule, a close beyond the trend line is more significant than just an intraday penetration. To go a step further, sometimes even a closing penetration is not enough. Most technicians employ a variety of time and price filters in an attempt to isolate valid trendline penetrations and eliminate bad signals or whipsaws. One example of a price filter is the 3% penetration criteria. This price filter is used mainly for the breaking of longer-term trendlines, but requires that the trendline be broken on a closing basis by at least 3%. The 3% rule doesn't apply to some financial futures, such as the interest rate markets. If, for example, gold prices broke a major uptrend line at $400, prices would have to close below that line by 3% of the price level where the line was broken. In this case, prices would have to close $12 below the trend line, or at $388. Obviously, a $12 penetration criteria would not be appropriate for shorter term trading. Perhaps a 1% criterion would serve better in such cases. The percent rule represents just one type of price filter. Stock chartists, for example, might require a full point penetration and ignore fractional moves. There is trade-off involved in the use of any type of filter. If the filter is too small, it won't be very useful in reducing the impact of whipsaws. If it's too big, then much of the initial move will be missed before a valid signal is given. Here again, the trader must determine what type of filter is best suited to the degree of trend being followed, always making allowances for the differences in the individual's markets. An alternative to a price filter, requiring that a trend line be broken by some predetermined price increment or percentage amount, is a time filter. A common time filter is the 2-day rule. In other words, to have a valid breaking of a trend line, prices must close beyond the trend line for 2 successive days. To break an uptrend line, therefore, prices must close under the trend line 2 days in a row. A 1-day violation would not count. The 1 to 3% rule and the 2-day rule are also applied to the breaking of important support and resistance levels. not just to major trend lines. Another filter would require a Friday close beyond a major breakout point to ensure a weekly signal. How trend lines reverse roles. It was mentioned earlier that support and resistance levels became the opposite. Once violated, the same principle holds true of trend lines. See figures 4.10a-c. In other words, an uptrend line, a support line, will usually become a resistance line once it's decisively broken. A downtrend line, a resistance line, will often become a support line once it's decisively broken. This is why it's usually a good idea to project all trend lines as far out to the right on the chart as possible even after they've been broken. It's surprising how often old trend lines act as support and resistance lines again in the future, but in the opposite role. Measuring implications of trend lines. Trend lines can be used to help determine price objectives. We'll have a lot more to say about price objectives in the next 2 chapters on price patterns. In fact, some of the price objectives addressed that are derived from various price patterns are similar to the one we'll cover here with trend lines. Stated briefly, once a trend line is broken, prices will usually move a distance beyond the trend line equal to the vertical distance that prices achieved on the other side of the line prior to the trend reversal. Figure 4.10, example of a rising support line becoming resistance.
Usually a
Support line will function as a resistance barrier on subsequent rallies after it
has been broken on the downside.
Figure 4.10b, very often a downtrend line will become a support line once it's been broken on the upside. Figure 4.10c, trend lines also reverse roles. On this chart, the broken up trend line became a resistance barrier on the following rally attempt. In other words, if in the prior uptrend, prices moved $50 above the up trend line measured vertically, then prices would be expected to drop that same $50 below the trend line after it's broken. In the next chapter, for example, we'll see that this measuring rule using the trend line is similar to that used for the well-known head and shoulders reversal pattern, where the distance from the head to the neckline is projected beyond that line once it's broken. The fan principle. This brings us to another interesting use of the trend line, the fan principle.
C.
Figures 4.11a-c. Sometimes, after the violation of an uptrend line, prices will decline a bit before rallying back to the bottom of the old uptrend line, now a resistance line. In figure 4.11a, notice how prices rallied to but failed to penetrate line 1. A second trend line, line 2, can now be drawn, which is also broken. After another failed rally attempt, a third line is drawn, line 3.
The
breaking of that third trend line is usually an indication that prices are headed lower. In figure 4.11b, the breaking of the third downtrend line, line 3, constitutes a new uptrend signal. Notice in these examples how previously broken support lines became resistance and resistance lines became support.
The
term fan principle derives from the appearance of the lines that gradually flatten out, resembling a fan. The important point to remember here is that the breaking of the third line is the valid trend reversal signal. Figure 4.11, example of the fan principle. The breaking of the third trend line signals the reversal of a trend. Notice also that the broken trend lines 1 and 2 often become resistance lines. Figure 4.11b, the fan principle at a bottom. The breaking of the third trend line signals the upside trend reversal. The previously broken trend lines, 1 and 2, often become support levels. Figure 4.11c, fan lines are drawn along successive peaks as shown in this chart. The breaking of the third fan line usually signals the start of the uptrend. The importance of the number 3. In examining the 3 lines in the fan principle, it's interesting to note how often the number 3 shows up in the study of technical analysis and the important role it plays in so many technical approaches. For example, the fan principle uses 3 lines. Major bull and bear markets usually have 3 major phases. Dow theory and Elliott wave theory. There are 3 kinds of gaps to be covered shortly. Some of the more commonly known reversal patterns, such as The triple top and the head and shoulders have three prominent peaks. There are three different classifications of trend: major, secondary, and minor, and three trend directions: up, down, and sideways. Among the generally accepted continuation patterns, there are three types of triangles: the symmetrical, ascending, and descending. There are three principal sources of information: price, volume, and open interest. For whatever the reason, the number 3 plays a very prominent role throughout the entire field of technical analysis. The relative steepness of the trend line. The relative steepness of the trend line is also important. In general, most important uptrend lines tend to approximate an average slope of 45 degrees. Some chartists simply draw a 45-degree line on the chart from a prominent high or low and use this as a major trend line. The 45-degree line was one of the
techniques favored by Degan.
Such a line reflects a situation where prices are advancing or declining at such a rate that price and time are in perfect balance. Figure 4.12. Most valid trend lines rise at an angle approximating 45 degrees. See line 2. If the trend line is too steep, line 1, it usually indicates that the rate of ascent is not sustainable. A trend line that is too flat, line 3, suggests that the uptrend is too weak and probably suspect. Many technicians use 45-degree lines from previous tops or bottoms as major trend lines. If a trend line is too steep, see line 1 in figure 4.12. It usually indicates that prices are advancing too rapidly and that the current steep ascent will not be sustained. The breaking of that steep trend line may be just a reaction back to a more sustainable slope closer to the 45-degree line, line 2. If a trend line is too flat, see line 3, it may indicate that the uptrend is too weak and not to be trusted. How to adjust trend lines. Sometimes trend lines have to be adjusted to fit a slowing or an accelerating
trend.
See figure 4.13 and figures 4.14a and b. For example, as shown in the previous case, if a steep trend line is broken, a slower trend line might have to be
drawn.
If the original trend line is too flat, it may have to be redrawn at a steeper angle. Figure 4.13 shows a situation where the breaking of the steeper trend line, line 1, necessitated the drawing of a slower line, line 2. Figure 4.13 example of a trend line that is too steep, line 1. The original up trend line proved too steep. Often the breaking of a steep trend line is only an adjustment to a slower and more sustainable up trend line, line 2. In figure 4.14a, the original trend line, line 1, is too flat and has to be redrawn at a steeper angle, line 2. The uptrend accelerated, requiring a steeper
line.
A trend line that is too far away from the price action is obviously of little use in tracking the trend. In the case of an accelerating trend, sometimes several trend lines may have to be drawn at increasingly steeper angles. In my experience, however, where steeper trend lines become necessary, it is best to resort to another tool, the moving average, which is the same as a curvilinear trend line. One of the advantages of having access to several different types of technical indicators is being able to choose the one most appropriate for a given situation. All of the techniques covered in this book work well in certain situations, but not so well in others. By having an arsenal of tools to fall back on, the technician can quickly switch from one tool to another that might work better in a given situation.
An
accelerated trend is one of those cases where a moving average would be more useful than a series of steeper and steeper trend lines. Figure 4.14, an example of an uptrend line that is too flat, line 1. Line 1 proved too slow as the uptrend accelerated. In this case, a second and steeper trend line, line 2, should be drawn to more closely track the rising trend. Figure 4.14b, an accelerating uptrend, requires the drawing of steeper trend lines. As shown in this chart, the steepest trend line becomes the most important one. Just as there are several different degrees of trend in effect at any one time, so is there a need for different trend lines to measure those various trends.
A
Major up trend line, for example, would connect the low points of the major uptrend, while a shorter and more sensitive line might be used for secondary swings. An even shorter line can measure the short-term movements. See Figure 4.15. Figure 4.15. Different trend lines are used to define the different degrees of trend. Line 1 in the above example is the major uptrend line, defining the major uptrend. Lines 2, 3, and 4 define the intermediate uptrends. Finally, line 5 defines a shorter-term advance within the last intermediate uptrend. Technicians use many different trend lines on the same chart. The channel line. The channel line, or the return line as it is sometimes called, is another useful variation of the trend line technique. Sometimes prices trend between two parallel lines, the basic trend line and the channel line. Obviously, when this is the case and when the analyst recognizes that a channel exists, this knowledge can be used to profitable advantage. The drawing of the channel line is relatively simple. In an uptrend, see Figure 4.16a. First, draw the basic up trend line along the lows. Then draw a dotted line from the first prominent peak, point 2, which is parallel to the basic up trend line. Both lines move up to the right, forming a channel. If the next rally reaches and backs off from the channel line at point 4, then a channel may
exist.
If prices then drop back to the original trend line at point 5, then a channel probably does exist. The same holds true for a downtrend. Figure 4.16b, but of course in the opposite direction. Figure 4.16, an example of a trend channel. Once the basic uptrend line is drawn below points 1 and 3, a channel or return line, dotted line, can be projected over the first peak at 2, which is parallel to the basic uptrend line. Figure 4.16b, a trend channel in a downtrend. The channel is projected downward from the first low at point 2, parallel to the downtrend line along the 1 and 3 peaks. Prices will often remain within such a trend channel. Figure 4.16c. Notice how prices fluctuated between the upper and lower parallel channels over a period of 25 years. The 1987, 1989, and 1993 tops occurred right at the upper channel line. The 1994 bottom bounced off the lower trend line. The reader should immediately see the value of such a situation. The basic uptrend line can be used for the initiation of new long positions. The channel line can be used for short-term profit-taking. More aggressive traders might even use the channel line to initiate a countertrend short position, although trading in the opposite direction of the prevailing trend can be a dangerous and usually costly tactic. As in the case of the basic trend line, the longer the channel remains intact and the more often it is successfully tested, the more important and reliable it becomes. The breaking of the major trend line indicates an important change in trend, but the breaking of a rising channel line has exactly the opposite meaning and signals an acceleration of the existing trend. Some traders view the clearing of the upper line in an uptrend as a reason to add to long positions. Figure 4.17. The failure to reach the upper end of the channel is often an early warning that the lower line will be broken. Notice the failure to reach the upper line at point 5 is followed by the breaking of the basic uptrend line at point 6. Another way to use the channel technique is to spot failures to reach the channel line, usually a sign of a weakening trend. In Figure 4.17, the failure of prices to reach the top of the channel at point 5 may be an early warning that the trend is turning and increases the odds that the other line, the basic up trend line, will be broken. As a general rule of thumb, the failure of any move within an established price channel to reach one side of the channel usually indicates that the trend is shifting and increases the likelihood that the other side of the channel will be broken. The channel can also be used to adjust the basic trend line. See Figures 4.18 and 4.19. If prices move above a projected rising channel line by a significant amount, it usually indicates a strengthening trend. Some chartists then draw a Steeper basic uptrend line from the last reaction, low parallel to the new channel line, as demonstrated in Figure 4.18. Often, the new steeper support line functions better than the old flatter line. Similarly, the failure of an uptrend to reach the upper end of a channel justifies the drawing of a new support line under the last reaction, low parallel to the new resistance line over the past two peaks, as shown in Figure 4.19. Figure 4.18, when the upper channel line is broken, as in Wave 5, many chartists will redraw the basic up trend line parallel to the new upper channel
line.
In other words, line 4 to 6 is drawn parallel to line 3 to 5. Because the uptrend is accelerating, it stands to reason that the basic uptrend line will do likewise. Figure 4.19, when prices fail to reach the upper channel line and a down trend line is drawn over the two declining peaks, line 3 to 5, a tentative channel line can be drawn from the low at point 4 parallel to line 3 to 5. The lower channel line sometimes indicates where initial support will be evident. Channel lines have measuring implications. Once a breakout occurs from an existing price channel, prices usually travel a distance equal to the width of the channel. Therefore, the user has to simply measure the width of the channel and then project that amount from the point at which either trend line is broken. It should always be kept in mind, however, that of the two lines, the basic trend line is by far the more important and the more reliable. The channel line is a secondary use of the trend line technique, but the use of the channel line works often enough to justify its inclusion in the chartist's toolkit. Percentage retracements. In all of the previous examples of uptrends and downtrends, the reader has no doubt noticed that after a particular market move, prices retrace a portion of the previous trend before resuming the move in the original direction. These countertrend moves tend to fall into certain predictable percentage parameters. The best known application of the phenomenon is the 50% retracement. Let's say, for example, that a market is trending higher and travels from the 100 level to the 200 level. Very often, the subsequent reaction retraces about half of the prior move to about the 150 level before upward momentum is regained. This is a very well-known market tendency and happens quite frequently. Also, these percentage retracements apply to any degree of trend, major, secondary, and near-term. Besides the 50% retracement, there are minimum and maximum percentage parameters that are also widely recognized, the 1/3 and the 2/3 retracements. In other words, the price trend can be divided into thirds. Usually, a minimum retracement is about 33% and a maximum about 66%. What this means is that in a correction of a strong trend, the market usually retraces at least a third of the previous move. This is very useful information for a number of reasons. If a trader is looking for a buying area under the market, he or she can just compute a 33 to 50% zone on the chart and use that price zone as a general frame of reference for buying opportunities. See Figures 4.20a and b. Figure 4.20a prices often retrace about half of the prior trend before resuming in the original direction. This example shows a 50% retracement. The minimum retracement is 1/3 and the maximum 2/3 of the prior trend. The maximum retracement parameter is 66%, which becomes an especially critical area. If the prior trend is to be maintained, the correction must stop at the 2/3 point. This then becomes a relatively low-risk buying area in an uptrend or selling area in a downtrend. If prices move beyond the 2/3 a point, the odds then favor a trend reversal rather than just a retracement. The move usually then retraces the entire 100% of the prior trend. You may have noticed that the 3 percentage retracement parameters we've mentioned so far, 50%, 33%, and 66%, are taken right from the original Dow Theory. When we get to the Elliott wave theory and Fibonacci ratios, we will see that followers of that approach use percentage retracements of 38% and 62%. I prefer to combine both approaches for a minimum retracement zone of 33 to 38% and a maximum zone of 62 to 66%. Some technicians round off these numbers even further to arrive at a 40 to 60% retracement zone. Figure 4.20b, the three horizontal lines mark the 38%, 50%, and 62% retracement levels measured from the April 1997 low to the August high.
The
First decline fell to the 38% line, the second declined to the 62% line, and the third near the 50% line. Most corrections will find support in the 38% to 50%.
retracement zone.
The 38% and 62% lines are Fibonacci retracements and are popular with chartists. Students of W.D. Gand are aware that he broke down the trend structure into eighths: 1/8, February 8th, March 8th, April 8th, May 8th, 6/8, 7/8, August 8th. However, even Gand attached special importance to the 3/8, 38%, 4/8, 50%, and 5/8, 62% retracement numbers, and also felt it was important to divide the trend into thirds: 1/3, 33%, and 2/3, 66%. Speed resistance lines. Speaking of thirds, let's touch on another technique that combines the trend line with percentage retracements, speed lines. This technique, developed by Edson Gould, is actually an adaptation of the idea of dividing the trend into thirds.
The
Main difference from the percentage retracement concept is that the speed resistance lines, or speed lines, measure the rate of ascent or descent of a trend. In other words, its speed. To construct a bullish speed line, find the highest point in the current uptrend. See Figure 4.21a. From that high point on the chart, a vertical line is drawn toward the bottom of the chart to where the trend began. That vertical line is then divided into thirds. A trend line is then drawn from the beginning of the trend through the 2 points marked off on the vertical line, representing the 1/3 and 2/3 points. In a downtrend, just reverse the process. Measure the vertical distance from the low point in the downtrend to the beginning of the trend and draw 2 lines from the beginning of the trend through the 1/3 and 2/3 points on the vertical line. See Figures 4.21a and b. Figure 4.21 examples of speed resistance lines in an uptrend. The vertical distance from the peak to the beginning of the trend is divided into thirds.
2.
Trend lines are then drawn from point 1 through points 2 and 3. The upper line is the 2/3 speed line and the lower, the 1/3. The lines should act as support during market corrections. When they're broken, they revert to resistance lines on bounces. Sometimes these speed lines intersect price action. Figure 4.21b, speed lines in a downtrend. Each time a new high is set in an uptrend or a new low in a downtrend, a new set of lines must be drawn because there is now a new high or low point. Because the speed lines are drawn from the beginning of the trend to the 1/3 and 2/3 points, those trend lines may sometimes move through some of the price action. This is one case where trend lines are not drawn under lows or over highs, but actually through the price action. If an uptrend is in the process of correcting itself, the downside correction will usually stop at the higher speed line, the 2/3 speed line. If not, prices will drop to the lower speed line, the 1/3 speed line. If the lower line is also broken, prices will probably continue all the way to the beginning of the prior trend.
In a
downtrend, the breaking of the lower line indicates a probable rally to the higher
line.
If that is broken, a rally to the top of the prior trend would be indicated. As with all trend lines, speed lines reverse roles once they are broken. Therefore, during the correction of an uptrend, if the upper line 2/3 line is broken and prices fall to the 1/3 line and rally from there, that upper line becomes a resistance barrier. Only when that upper line is broken would a signal be given that the old highs will probably be challenged. The same principle holds true in downtrends. Gann and Fibonacci fan lines. Charting software also allows the drawing of Gann and Fibonacci fan lines. Fibonacci fan lines are drawn in the same fashion as the speed line, except that Fibonacci lines are drawn at 38% and 62% angles. We'll explain where those 38% and 62% numbers come from in Chapter 13, Elliott Wave Theory.
Gann.
Lines, named after the legendary commodity trader W.D. Gann, are trend lines, drawn from prominent tops or bottoms at specific geometric angles. The most important Gann line is drawn at a 45-degree angle from a peak or trough.
Steeper.
Gann lines can be drawn during an uptrend at 63 and 3/4 degree and 75-degree angles. Flatter Gann lines can be drawn at 26 and 1/4 and 15-degree lines.
It's possible to draw
As many as 9 different Gann lines. Gann and Fibonacci lines are used in the same way as speed lines. They are supposed to provide support during downward corrections. When one line is broken, prices will usually fall to the next lower line. Gann lines are somewhat controversial. Even if one of them works, you can't be sure in advance which
one it will be.
Some chartists question the validity of drawing geometric trend lines at all. Internal trend lines. These are variations of the trend line that don't rely on extreme highs or lows. Instead, internal trend lines are drawn through the price action and connect as many internal peaks or troughs as possible. Some chartists develop a good eye for this type of trend line and find them useful. The problem with internal trend lines is that their drawing is very subjective, whereas the rules for drawing of more traditional trend lines along the extreme highs and lows are more exact. See Figure 4.21c. Reversal days. Another important building block is the reversal day. This particular chart formation goes by many names: the top reversal day, the bottom reversal day, the buying or selling climax, and the key reversal day. By itself, this formation is not of major importance, but taken in the context of other technical information, it can sometimes be significant. Let's first define what a reversal day is. Figure 4.21c. Internal trend lines are drawn through the price action connecting as many highs and lows as possible. This internal trend line drawn along the early 1996 highs provided support a year later during the spring of 1997. A reversal day takes place either at a top or a bottom. The generally accepted definition of a top reversal day is the setting of a new high in an uptrend, followed by a lower close on the same day. In other words, prices set a new high for a given up move at some point during the day, usually at or near the opening, then weaken, and actually close lower than the previous day's closing. A bottom reversal day would be a new low during the day followed by a higher
close.
The wider the range for the day and the heavier the volume, the more significant is the signal for a possible near-term trend reversal. Figures 4.22a-b show what both would look like on a bar chart. Note the heavier volume on the reversal day. Also notice that both the high and low on the reversal day exceed the range of the previous day, forming an outside day. While an outside day is not a requirement for a reversal day, it does carry more significance. See Figure 4.22c. The bottom reversal day is sometimes referred to as a selling climax. This is usually a dramatic turnaround at the bottom of a down move where all the discouraged longs have finally been forced out of the market on heavy volume. The subsequent absence of selling pressure creates a vacuum over the market, which prices quickly rally to fill. The selling climax is one of the more dramatic examples of the reversal day, and while it may not mark the final bottom of a falling market, it usually signals that a significant low has been seen. Figure 4.22, example of a top reversal day. The heavier the volume on the reversal day and the wider the range, the more important it becomes. Figure 4.22, B example of a bottom reversal day. If volume is especially heavy, bottom reversals are often referred to as selling climaxes. Figure 4.22, see the chart action of October 28, 1997 was a classic example of an upside reversal day or a selling climax. Prices opened sharply lower and closed sharply higher. The unusually heavy volume bar for that day added to its importance. Two less dramatic upside reversal days, see arrows, also marked price bottoms, weekly and monthly reversals. This type of reversal pattern shows up on weekly and monthly bar charts, and with much greater significance. On a weekly chart, each bar represents the entire week's range, with the close registered on Friday. An upside weekly reversal, therefore, would occur when the market trades lower during the week, makes a new low for the move, but on Friday closes above the previous Friday's close. Weekly reversals are much more significant than daily reversals for obvious reasons and are watched closely by chartists as signaling important turning
points.
By the same token, monthly reversals are even more important. Price gaps. Price gaps are simply areas on the bar chart where no trading has taken place.
In
an uptrend, for example, prices open above the highest price of the previous day, leaving a gap or open space on the chart that is not filled during the day.
In a
downtrend, the day's highest price is below the previous day's low. Upside gaps are signs of market strength, while downside gaps are usually signs of weakness. Gaps can appear on long-term weekly and monthly charts and, when they do, are usually very significant. But they are more commonly seen on daily bar charts. Several myths exist concerning the interpretation of gaps. One of the maxims often heard is that gaps are always filled. This is simply not true. Some should be filled and others shouldn't. We'll also see that gaps have different forecasting implications depending on which types they are and where they occur. 3 types of gaps. There are 3 general types of gaps: the breakaway, runaway, or measuring, and exhaustion gaps. The breakaway gap. The breakaway gap usually occurs at the completion of an important price pattern and usually signals the beginning of a significant market
move.
After a market has completed a major basing pattern, the breaking of resistance often occurs on a breakaway gap. Major breakouts from topping or basing areas are breeding grounds for this type of gap. The breaking of a major trend line, signaling a reversal of trend, might also see a breakaway gap. Breakaway gaps usually occur on heavy volume. More often than not, breakaway gaps are not filled. Prices may return to the upper end of the gap in the case of a bullish breakout, and may even close a portion of the gap, but some portion of the gap is often left unfilled. As a rule, the heavier the volume after such a gap appears, the less likely it is to be filled. Upside gaps usually act as support areas on subsequent market corrections. It's important that prices not fall below gaps during an uptrend. In all cases, a close below an upward gap is a sign of weakness. See figures 4.23a and b. Figure 4.23 of the 3 types of gaps. The breakaway gap signaled the completion of the basing pattern. The runaway gap occurred at about the midway point, which is why it is also called the measuring gap. An exhaustion gap to the upside, followed within a week by a breakaway gap to the downside, left an island reversal top. Notice that the breakaway and runaway gaps were not filled on the way up, which is often the case. The runaway or measuring gap. After the move has been underway for a while, somewhere around the middle of the move, prices will leap forward to form a second type of gap, or a series of gaps, called the runaway gap. This type of gap reveals a situation where the market is moving effortlessly on moderate volume. In an uptrend, it's a sign of market strength. In a downtrend, a sign of weakness. Here again, runaway gaps act as support under the market on subsequent corrections and are often not filled. As in the case of the breakaway, a close below the runaway gap is a negative sign in an uptrend. Figure 4.23b, the first box, shows an exhaustion gap near the end of the rally. Prices falling below that gap signaled a top. The second box is a measuring gap about halfway through the downtrend. The third box is another exhaustion gap at the bottom. The move back above that gap signal higher prices. This variety of gap is also called a measuring gap because it usually occurs at about the halfway point in a trend by measuring the distance the trend has already traveled from the original trend signal or breakout. An estimate of the probable extent of the remaining move can be determined by doubling the amount already achieved, the exhaustion gap. The final type of gap appears near the end of a market
Move.
after all objectives have been achieved, and the other two types of gaps, breakaway and runaway, have been identified. The analyst should begin to expect the exhaustion gap. Near the end of an uptrend, prices leap forward in a last gasp, so to speak. However, that upward leap quickly fades and prices turn lower within a couple of days or within a week. When prices close under that last gap, it is usually a dead giveaway that the exhaustion gap has made its appearance. This is a classic example where falling below a gap in an uptrend has very bearish implications. The island reversal. This takes us to the island reversal pattern. Sometimes, after the upward exhaustion gap has formed, prices will trade in a narrow range for a couple of days or a couple of weeks before gapping to the downside. Such a situation leaves the few days of price action looking like an island surrounded by space or water. The exhaustion gap to the upside followed by a breakaway gap to the downside completes the island reversal pattern and usually indicates a trend reversal of some magnitude. Of course, the major significance of the reversal depends on where prices are in the general trend structure. See Figure 4.23c. Figure 4.23c. The two gaps on this daily chart form an island reversal top. The first box shows an up gap after a rally. The second box shows a down gap 3 weeks later. That combination of gaps usually signals an important top. Conclusion. This chapter introduced introductory technical tools that I consider to be the building blocks of chart analysis: support and resistance, trend lines and channels, percentage retracements, speed resistance lines, reversal days, and
Gaps.
every technical approach covered in later chapters uses these concepts and tools in one form or another. Armed with a better understanding of these concepts, we're now ready to begin a study of price patterns. 5 major reversal patterns. Introduction. So far, we've touched on Dow theory, which is the basis of most trend following work being used today. We've examined the basic concepts of trend, such as support, resistance, and trend lines. And we've introduced volume and open interest. We're now ready to take the next step, which is a study of chart patterns. You'll quickly see that these patterns build on the previous concepts. In Chapter 4, the definition of a trend was given as a series of ascending or descending peaks and troughs. As long as they were ascending, the trend was up. If they were descending, the trend was down. It was stressed, however, that markets also move sideways for a certain portion of the time. It is these periods of sideways market movement that will concern us most in these next 2 chapters. It would be a mistake to assume that most changes in trend are very abrupt affairs. The fact is that important changes in trend usually require a period of transition. The problem is that these periods of transition do not always signal a
Trend reversal.
Sometimes these sideways periods just indicate a pause or consolidation in the existing trend after which the original trend is resumed. Price patterns. The study of these transition periods and their forecasting implications leads us to the question of price patterns. First of all, what are price patterns? Price patterns are pictures or formations which appear on price charts of stocks or commodities that can be classified into different categories and that have predictive value. 2 types of patterns: reversal and continuation. There are 2 major categories of price patterns: reversal and continuation.
As.
These names imply reversal patterns indicate that an important reversal in trend is taking place. The continuation patterns, on the other hand, suggest that the market is only pausing for a while, possibly to correct a near-term overbought or oversold condition, after which the existing trend will be resumed.
The trick is to
Distinguish between the two types of patterns as early as possible during the formation of the pattern. In this chapter, we'll be examining the 5 most commonly used major reversal patterns: the head and shoulders, triple tops and bottoms, double tops and bottoms, spike or V, tops and bottoms, and the rounding or saucer pattern. We will examine the price formation itself, how it is formed on the chart, and how it can be identified. We will then look at the other important considerations, the accompanying volume pattern and measuring implications. Volume plays an important confirming role in all of these price patterns. In times of doubt, and there are lots of those, a study of the volume pattern accompanying the price data can be the deciding factor as to whether or not the pattern can be trusted. Most price patterns also have certain measuring techniques that help the analyst to determine minimum price objectives. While these objectives are only an approximation of the size of the subsequent move, they are helpful in assisting the trader to determine his or her reward to risk ratio. In Chapter 5, we'll look at a second category of patterns, the continuation variety. There we will examine triangles, flags, pennants, wedges, and rectangles. These patterns usually reflect pauses in the existing trend rather than trend reversals, and are usually classified as intermediate and minor as opposed to major. Preliminary points common to all reversal patterns. Before beginning our discussion of the individual major reversal patterns, there are a few preliminary points to be considered that are common to all of these reversal patterns. 1. A prerequisite for any reversal pattern is the existence of a prior trend. 2. The first signal of an impending trend reversal is often the breaking of an important trend line. 3. The larger the pattern, the greater the subsequent move. 4. Topping patterns are usually shorter in duration and more volatile than bottoms. 5. Bottoms usually have smaller price ranges and take longer to build. 6. Volume is usually more important on the upside. The need for a prior trend. The existence of a prior major trend is an important prerequisite for any reversal pattern. A market must obviously have something to reverse. A formation occasionally appears on the charts, resembling one of the reversal patterns. If that pattern, however, has not been preceded by a trend, there is nothing to reverse, and the pattern is suspect. Knowing where certain patterns are most apt to occur in the trend structure is one of the key elements in pattern recognition. A corollary to this point of having a prior trend to reverse is the matter of measuring implications. It was stated earlier that most of the measuring techniques give only minimum price objectives. The maximum objective would be the total extent of the prior move. If a major bull market has occurred and a major topping pattern is being formed, the maximum implication for the potential move to the downside would be a 100% retracement of the bull market, or the point at which it all began. The breaking of important trend lines. The first sign of an impending trend reversal is often the breaking of an important trend line. Remember, however, that the violation of a major trend line does not necessarily signal a trend reversal. What is being signaled is a change in trend. The breaking of a major up trend line might signal the beginning of a sideways price pattern, which later would be identified as either the reversal or consolidation type. Sometimes the breaking of the major trend line coincides with the completion of the price
pattern.
The larger the pattern, the greater the potential. When we use the term larger, we are referring to the height and the width of the price pattern.
The
height measures the volatility of the pattern. The width is the amount of time required to build and complete the pattern. The greater the size of the pattern, that is, the wider the price swings within the pattern, the volatility, and the longer it takes to build, the more important the pattern becomes and the greater the potential for the ensuing price move. Virtually all of the measuring techniques in these 2 chapters are based on the height of the pattern. This is the method applied primarily to bar charts, which use a vertical measuring criteria. The practice of measuring the horizontal width of a price pattern usually is reserved for point and figure charting.
That
method of charting uses a device known as the count, which assumes a close relationship between the width of a top or bottom and the subsequent price. Target. Differences between tops and bottoms. Topping patterns are usually shorter in duration and are more volatile than bottoms. Price swings within the tops are wider and more violent. Tops usually take less time to form. Bottoms usually have smaller price ranges but take longer to build. For this reason, it is usually easier and less costly to identify and trade bottoms than to catch market tops. One consoling factor, which makes the more treacherous topping patterns worthwhile, is that prices tend to decline faster than they go up. Therefore, the trader can usually make more money a lot faster by catching the short side of a bear market than by trading the long side of a bull market. Everything in life is a trade-off between reward and risk. The greater risks are compensated for by greater rewards and vice versa. Topping patterns are harder to catch, but are worth the effort. Volume is more important on the upside. Volume should generally increase in the direction of the market trend and is an important confirming factor in the completion of all price patterns. The completion of each pattern should be accompanied by a noticeable increase in volume. However, in the early stages of a trend reversal, volume is not as important at market tops. Markets have a way of falling of their own weight once a bear move gets underway. Chartists like to see an increase in trading activity as prices drop, but it is not critical.
At
Bottoms, however, the volume pickup is absolutely essential. If the volume pattern does not show a significant increase during the upside price breakout, the entire price pattern should be questioned. We will be taking a more in-depth look at volume in Chapter 7, the Head and Shoulders Reversal
pattern.
Let's take a close look now at what is probably the best known and most reliable of all major reversal patterns, the Head and Shoulders Reversal. We'll spend more time on this pattern because it is important and also to explain all the nuances involved. Most of the other reversal patterns are just variations of the Head and Shoulders and will not require as extensive a treatment. This major reversal pattern, like all of the others, is just a further refinement of the concepts of trend covered in Chapter 4. Picture a situation in a major uptrend where a series of ascending peaks and troughs gradually begin to lose momentum. The uptrend then levels off for a while. During this time, the forces of supply and demand are in relative balance. Once this distribution phase has been completed, support levels along the bottom of the horizontal trading range are broken and a new downtrend has been established. That new downtrend now has descending peaks and troughs. Let's see how this scenario would look on a Head and Shoulders top.
C.
Figures 5.1a and b. At point A, the uptrend is proceeding as expected with no signs of a top. Volume expands on the price move into new highs, which is normal. The corrective dip to point B is on lighter volume, which is also to be expected. At point C, however, the alert chartist might notice that the volume on the upside breakout through point A is a bit lighter than on the previous rally. This change is not in itself of major importance, but a little yellow caution light goes on in the back of the analyst's head. Figure 5.10 example of a Head and Shoulders top. The left and right shoulders, A and E, are at about the same height. The head, C, is higher than either shoulder. Notice the lighter volume on each peak. The pattern is completed on A, close under the neckline, line 2. The minimum objective is the vertical distance from the head to the neckline projected downward from the breaking of the neckline. A return move will often occur back to the neckline, which should not recross the neckline once it has been broken. Figure 5.1b, a Head and Shoulders top. The three peaks show the head higher than either shoulder. The return move, see arrow, back to the neckline occurred on schedule. Prices then begin to decline to point D, and something even more disturbing happens. The decline carries below the top of the previous peak at point A. Remember that in an uptrend, a penetrated peak should function as support on subsequent corrections. The decline well under point A, almost to the previous reaction low at point B, is another warning that something may be going wrong with the uptrend. The market rallies again to point E, this time on even lighter volume, and isn't able to reach the top of the previous peak at point C. That last rally at point E will often retrace 1/2 to 2/3 of the decline from point C to D.
2.
Continue an uptrend, each high point must exceed the high point of the rally preceding it. The failure of the rally at point E to reach the previous peak at point C fulfills half of the requirement for a new downtrend, namely descending. X. By this time, the major uptrend line, line 1, has already been broken, usually at point D, constituting another danger signal. But despite all of these warnings, all that we know at this point is that the trend has shifted from up to sideways. This might be sufficient cause to liquidate long positions, but not necessarily enough to justify new short sales. The breaking of the neckline completes the pattern. By this time, a flatter trend line can be drawn under the last two reaction lows, points B and D, which is called a neckline, see line 2. This line generally has a slight upward slope at tops, although it's sometimes horizontal and less often tilts downward. The deciding factor in the resolution of the head and shoulders top is a decisive closing violation of that neckline. The market has now violated the trend line along the bottom of points B and D, has broken under support at point D, and has completed the requirement for a new downtrend descending peaks and troughs. The new downtrend is now identified by the declining highs and lows at point C, D, E, and F. Volume should increase on the breaking of a
neckline.
A sharp increase in downside volume, however, is not critically important in the initial stages of a market top. The return move. Usually a return move develops, which is a bounce back to the bottom of the neckline or to the previous reaction low at point D, see point G, both of which have now become overhead resistance. The return move does not always occur, or is sometimes only a very minor bounce. Volume may help determine the size of the bounce. If the initial breaking of the neckline is on very heavy trading, the odds for a return move are diminished because the increased activity reflects greater downside pressure. Lighter volume on the initial break of the neckline increases the likelihood of a return move. That bounce, however, should be on light volume, and the subsequent resumption of the new downtrend should be accompanied by noticeably heavier trading activity.
Summary.
Let's review the basic ingredients for a head and shoulders top. 1. A prior uptrend. 2. A left shoulder on heavier volume, point A, followed by a corrective dip to point B. 3. A rally into new highs but on lighter volume, point C. 4. A decline that moves below the previous peak at A and approaches the previous reaction low, point D.
5.
A third rally, point E, on noticeably light volume that fails to reach the top of the head at point C. 6. A close below the neckline. 7. A return move back to the neckline, point G, followed by new lows. What has become evident is 3 well-defined peaks. The middle peak, the head, is slightly higher than either of the two shoulders, points A and E. The pattern, however, is not complete until the neckline is decisively broken on a closing basis. Here again, the 1 to 3% penetration criterion, or some variation thereof, or the requirement of 2 successive closes below the neckline, the 2-day rule, can be used for added confirmation. Until that downside violation takes place, however, there is always the possibility that the pattern is not really a head and shoulders top and that the uptrend may resume at some point. The importance of volume. The accompanying volume pattern plays an important role in the development of the head and shoulders top, as it does in all price patterns. As a general rule, the second peak, the head, should take place on lighter volume than the left shoulder. This is not a requirement, but a strong tendency and an early warning of diminishing buying pressure. The most important volume signal takes place during the third peak, the right shoulder. Volume should be noticeably lighter than on the previous 2 peaks. Volume should then expand on the breaking of the neckline, decline during the return move, and then expand again once the return move is over. As mentioned earlier, volume is less critical during the completion of market tops. But at some point, volume should begin to increase if the new downtrend is to be continued. Volume plays a much more decisive role at market bottoms, a subject to be discussed shortly. Before doing so, however, let's discuss the measuring implications of the head and shoulders pattern. Finding a price objective. The method of arriving at a price objective is based on the height of the pattern. Take the vertical distance from the head, point C, to the neckline. Then project that distance from the point where the neckline is broken. Assume, for example, that the top of the head is at 100 and the neckline is at 80. The vertical distance, therefore, would be the difference, which is 20. That 20 points would be measured downward from the level at which the neckline is broken.
If the
neckline in Figure 5.1a is at 82 when broken, a downside objective would be projected to the 62 level, 82, 20 is equal to 62. Another technique that accomplishes about the same task but is a bit easier is to simply measure the length of the first wave of the decline, point C to D, and then double it. In either case, the greater the height or volatility of the pattern, the greater the objective. Chapter 4 stated that the measurement taken from a trendline penetration was similar to that used in the head and shoulders
pattern.
You should be able to see that now. Prices travel roughly the same distance below the broken neckline as they do above it. You'll see throughout our entire study of price patterns that most price targets on bar charts are based on the height or volatility of the various patterns. The theme of measuring the height of the pattern and then projecting that distance from a breakout point will be constantly repeated. It's important to remember that the objective arrived at is only a minimum target. Prices will often move well beyond the objective. Having a minimum target to work with, however, is very helpful in determining beforehand whether there is enough potential in a market move to warrant taking a position. If the market exceeds the price objective, that's just icing on the cake. The maximum objective is the size of the prior move. If the previous bull market went from 30 to 100, then the maximum downside objective from a topping pattern would be a complete retracement of the entire up move all the way down to 30. Reversal patterns can only be expected to reverse or retrace what has gone before them. Adjusting price objectives. A number of other factors should be considered while trying to arrive at a price objective. The measuring techniques from price patterns, such as the one just mentioned for the head and shoulders top, are only the first step. There are other technical factors to take into consideration. For example, where are the prominent support levels left by the reaction lows during the previous bull move? Bear markets often pause at these levels. What about percentage retracements? The maximum objective would be a 100% retracement of the previous bull market. But where are the 50% and 66% retracement levels? Those levels often provide significant support under the market. What about any prominent gaps underneath? They often function as support areas. Are there any long-term trend lines visible below the market? The technician must consider other technical data in trying to pinpoint price targets taken from price patterns. If a downside price measurement, for example, projects a target to 30 and there is a prominent support level at 32, then the chartist would be wise to adjust the downside measurement to 32 instead of 30. As a general rule, when a slight discrepancy exists between a projected price target and a clear-cut support or resistance level, it's usually safe to adjust the price target to that support or resistance level. It is often necessary to adjust the measure targets from price patterns to take into account additional technical information. The analyst has many different tools at his or her disposal.
The
most skillful technical analysts are those who learn to blend all of those tools together properly. The inverse head and shoulders. The head and shoulders bottom, or the inverse head and shoulders as it is sometimes called, is pretty much a mirror image of the topping pattern.
as
Figure 5.2a shows there are three distinct bottoms with a head middle trough, a bit lower than either of the two shoulders. A decisive close through the Neckline is also necessary to complete the pattern, and the measuring technique is the same. One slight difference at the bottom is the greater tendency for the return move back to the neckline to occur after the bullish breakout. See Figure 5.2b. Figure 5.2a example of an inverse head and shoulders. The bottom version of this pattern is a mirror image of the top. The only significant difference is the volume pattern in the second half of the pattern. The rally from the head should see heavier volume, and the breaking of the neckline should see a burst of trading activity. The return move back to the neckline is more common at bottoms. The most important difference between the top and bottom patterns is the volume sequence. Volume plays a much more critical role in the identification and completion of a head and shoulders bottom. This point is generally true of all bottom patterns. It was stated earlier that markets have a tendency to fall of their own weight. At bottoms, however, markets require a significant increase in buying pressure, reflected in greater volume, to launch a new bull market. Figure 5.2b, a head and shoulders bottom. The neckline has a slight downward slant, which is normally the case. The pullback after the breakout, see arrow, nicked the neckline a bit, but then resumed the uptrend. A more technical way of looking at this difference is that a market can fall just from inertia. Lack of demand or buying interest on the part of traders is often enough to push a market lower, but a market does not go up on inertia. Prices only rise when demand exceeds supply and buyers are more aggressive than sellers. The volume pattern at the bottom is very similar to that at the top for the first half of the pattern. That is, the volume at the head is a bit lighter than that at the left shoulder. The rally from the head, however, should begin to show not only an increase in trading activity, but the level of volume often exceeds that registered on the rally from the left shoulder. The dip to the right shoulder should be on very light volume. The critical point occurs at the rally through the
neckline.
This signal must be accompanied by a sharp burst of trading volume if the breakout is for real. This point is where the bottom differs the most from the top. At the bottom, heavy volume is an absolutely essential ingredient in the completion of the basing pattern. The return move is more common at bottoms than at tops and should occur on light volume. Following that, the new uptrend should resume on heavier volume. The measuring technique is the same as at the top. The slope of the neckline. The neckline at the top usually slopes slightly upward. Sometimes, however, it is horizontal. In either case, it doesn't make too much of a difference. Once in A. While, however, a top neckline slopes downward. This slope is a sign of market weakness and is usually accompanied by a weak right shoulder. However, this is a mixed blessing. The analyst waiting for the breaking of the neckline to initiate a short position has to wait a bit longer because the signal from the down sloping neckline occurs much later and only after much of the move has already taken place. For basing patterns, most necklines have a slight downward tilt.
A
rising neckline is a sign of greater market strength, but with the same drawback of giving a later signal. Complex head and shoulders patterns. A variation of the head and shoulders pattern sometimes occurs, which is called the complex head and shoulders pattern. These are patterns where two heads may appear or a double left and right shoulder. These patterns are not that common, but have the same forecasting implications. A helpful hint in this regard is the strong tendency towards symmetry in the head and shoulders
pattern.
This means that a single left shoulder usually indicates a single right shoulder. A double left shoulder increases the odds of a double right shoulder.
Tactics.
Market tactics play an important role in all trading. Not all technical traders like to wait for the breaking of the neckline before initiating a new position.
As
Figure 5.3 shows more aggressive traders, believing that they have correctly identified a head and shoulders bottom, will begin to probe the long side during the formation of the right shoulder, or they will buy the first technical signal that the decline into the right shoulder has ended. Some will measure the distance of the rally from the bottom of the head, point C to D, and then by a 50% or 66% retracement of that rally. Still others would draw a tight down trend line along the decline from points D to E and buy the first upside break of that trend line. Because these patterns are reasonably symmetrical, some will buy into the right shoulder as it approaches the same level as the bottom of the left shoulder. A lot of anticipatory buying takes place during the formation of the right shoulder. If the initial long probe proves to be profitable, additional positions can be added on the actual penetration of the neckline or on the return move back to the neckline after the breakout. The failed head and shoulders pattern. Once prices have moved through the neckline and completed a head and shoulders pattern, prices should not recross the neckline again. At a top, once the neckline has been broken on the downside, any decisive close back above the neckline is a serious warning that the initial breakdown was probably a bad signal and creates what is often called, for obvious reasons, a failed head and shoulders. This type of pattern starts out looking like a classic head and shoulders reversal, but at some point in its development, either prior to the breaking of the neckline, Figure 5.3 tactics for a head and shoulders bottom. Many technical traders will begin to initiate long positions while the right shoulder, E, is still being formed. 1/2 to 2/3 pullback of the rally from point C to D, a decline to the same level as the left shoulder at point A, or the breaking of a short-term down trendline, line 1, all provide early opportunities for market entry. More positions can be added on the breaking of the neckline or the return move back to the
neckline.
There are two important lessons here. The first is that none of these chart patterns are infallible. They work most of the time, but not always. The second lesson is that technical traders must always be on the alert for chart signs that their analysis is incorrect. One of the keys to survival in the financial markets is to keep trading losses small and to exit a losing trade as quickly as possible.
1.
Of the greatest advantages of chart analysis is its ability to quickly alert the trader to the fact that he or she is on the wrong side of the market. The ability and willingness to quickly recognize trading errors and to take defensive action immediately are qualities not to be taken lightly in the financial markets. The head and shoulders as a consolidation pattern. Before moving on to the next price pattern, there's one final point to be made on the head and shoulders. We started this discussion by listing it as the best known and most reliable of the major reversal patterns. You should be warned, however, that this formation can, on occasion, act as a consolidation rather than a reversal
pattern.
When this does happen, it's the exception rather than the rule. We'll talk more about this in Chapter 6, Continuation Patterns. Triple tops and bottoms. Most of the points covered in the treatment of the head and shoulders pattern are also applicable to other types of reversal patterns. See figures 5.4a-c. The triple top or bottom, which is much rarer in occurrence, is just a slight variation
of that pattern.
The main difference is that the three peaks or troughs in the triple top or bottom are at about the same level. See figure 5.4a. Chartists often disagree as to whether a reversal pattern is a head and shoulders or a triple top. The argument is academic because both patterns imply the exact same thing. The volume tends to decline with each successive peak at the top and should increase at the breakdown point. The triple top is not complete until support levels along both of the intervening lows have been broken. Conversely, prices must close through the two intervening peaks at the bottom to complete a triple bottom. As an alternate strategy, the breaking of the nearest peak or trough can also be used as a reversal signal. Heavy upside volume on the completion of the bottom is also essential. Figure 5.4a, a triple top. Similar to the head and shoulders except that all peaks are at the same level. Each rally peak should be on lighter volume. The pattern is complete when both troughs have been broken on heavier volume. The measuring technique is the height of the pattern projected downward from the breakdown point. Return moves back to the lower line are not unusual. Figure 5.4b, a triple bottom, similar to a head and shoulders bottom except that each low is at the same level, a mirror image of the triple top, except that volume is more important on the upside breakout. Figure 5.4c, a triple bottom reversal pattern. Prices found support just below 12 three times on this chart before launching a major advance. The bottom formation on this weekly chart lasted 2 full years, thereby giving it major significance. The measuring implication is also similar to the head and shoulders and is based on the height of the pattern. Prices will usually move a minimum distance from the breakout point at least equal to the height of the pattern. Once the breakout occurs, a return move to the breakout point is not unusual, because the triple top or bottom represents only a minor variation of the head and shoulders pattern. We won't say much more about it here. Double tops and bottoms. A much more common reversal pattern is the double top or bottom. Next to the head and shoulders, it is the most frequently seen and the most easily recognized. See figures 5.5a. Figures 5.5a and 5.5b show both the top and bottom variety. For obvious reasons, the top is often referred to as an M and the bottom as a W. The general characteristics of a double top are similar to that of the head and shoulders and triple top, except that only 2 peaks appear instead of 3. The volume pattern is similar, as is the measuring rule. Figure 5.5, example of a double top. This pattern has 2 peaks, A and C, at about the same level. The pattern is complete when the middle trough at point B is broken on a closing basis. Volume is usually lighter on the second peak, C, and picks up on the breakdown, D. A return move back to the lower line is not unusual. The minimum measuring target is the height of the top projected downward from the breakdown point. Figure 5.5, the example of a double bottom. A mirror image of the double top. Volume is more important on the upside breakout. Return moves back to the breakout point are more common at bottoms. Figure 5.5, see example of a double bottom. This stock bounced sharply off the 68 level twice over a span of 3 months. Note that the second bottom was also an upside reversal day. The breaking of resistance at 80 completed the bottom. In an uptrend, as shown in figure 5.5a, the market sets a new high at point A, usually on increased volume, and then declines to point B on declining volume. So far, everything is proceeding as expected in a normal uptrend. The next rally to point C, however, is unable to penetrate the previous peak at A on A closing basis and begins to fall back again. A potential double top has been set up. I use the word potential because, as is the case with all reversal patterns, the reversal is not complete until the previous support point at B is violated on A closing basis. Until that happens, prices could be in just a sideways consolidation phase, preparing for a resumption of the original uptrend. Figure 5.5d example of a double top. Sometimes the second peak doesn't quite reach the first peak, as in this example. This 2-month double top signaled a major decline. The actual signal was the breaking of support near 46 C box. The ideal top has 2 prominent peaks at about the same price level. Volume tends to be heavier during the first peak and lighter on the second. A decisive close under the middle trough at point B on heavier volume completes the pattern and signals a reversal of trend to the downside. A return move to the breakout point is not unusual prior to resumption of the downtrend. Measuring technique for the double top. The measuring technique for the double top is the height of the pattern projected from the breakdown point, the point where the middle trough at point B is broken. As an alternative, measure the height of the first down leg, points A to B, and project that length downward from the middle trough at point B. Measurements at the bottom are the same, but in the other direction. Figure 5.5e price patterns show up regularly on the charts of major stock averages. On this chart, the Nasdaq Composite Index formed a double bottom near the 1470 level before turning higher. The break of the downtrend line C box confirmed the upturn. Variations from the ideal pattern. As in most other areas of market analysis, real-life examples are usually some variation of the ideal. For one thing, sometimes the two peaks are not at exactly the same price level. On occasion, the second peak will not quite reach the level of the first peak, which is not too problematical. What does cause some problems is when the second peak actually exceeds the first peak by a slight margin. What at first may appear to be a valid upside breakout and resumption of the uptrend may turn out to be part of the topping process. To help resolve this dilemma, some of the filtering criteria already mentioned may come in handy. Filters. Most chartists require a close beyond a previous resistance peak instead of just an intraday penetration. Second, a price filter of some type might be used.
1.
Such example is a percentage penetration criterion such as 1% or 3%. Third, the 2-day penetration rule could be used as an example of a time filter. In other words, prices would have to close beyond the top of the first peak for 2 consecutive days to signal a valid penetration. Another time filter could be a Friday close beyond the previous peak. The volume on the upside breakout might also provide a clue to its reliability. These filters are certainly not infallible, but do serve to reduce the number of false signals or whipsaws that often occur. Sometimes these filters are helpful, and sometimes they're not. The analyst must face the realization that he or she is dealing with percentages and probabilities, and that there will be times when bad signals occur. That's simply a fact of trading life. It's not that unusual for the final leg or wave of a bull market to set a new high before reversing direction. In such a case, the final upside breakout would become a bull trap. See figures 5.6a and b. We'll show you some indicators later on that may help you spot these false breakouts. The term double top greatly overused. The terms double top and bottom are greatly overused in the financial markets. Most potential double tops or bottoms wind up being something else. The reason for this is that prices have a strong tendency to back off from a previous peak or bounce off a previous low. These price changes are a natural reaction and do not, in themselves, constitute a reversal pattern. Remember that at a top, prices must actually violate the previous reaction low before the double top exists. Figure 5.6, a example of a false breakout, usually called a bull trap.
Sometimes,
near the end of a major uptrend, prices will exceed a previous peak before failing. Chartists use various time and price filters to reduce such whipsaws. This topping pattern would probably qualify as a double top. Figure 5.6, the example of a false breakout. Notice that the upside breakout was on light volume and the subsequent decline on heavy volume, a negative chart combination. Watching the volume helps avoid some false breakouts, but not all. Notice in figure 5.7a that the price at point C backs off from the previous
peak at point A.
This is perfectly normal action in an uptrend. Many traders, however, will immediately label this pattern as a double top as soon as prices fail to clear the first peak on the first attempt. Figure 5.7b shows the same situation. In a downtrend, it is very difficult for the chartist to determine whether the pullback from the previous peak or the bounce from the previous low is just a temporary setback in the existing trend or the start of a double top or bottom reversal pattern. Because the technical odds usually favor continuation of the present trend, it is usually wise to await completion of the pattern before taking action. Figure 5.7, an example of a normal pullback from a previous peak before resumption of the uptrend. This is normal market action and not to be confused with a double top. The double top only occurs when support at point B is broken. Figure 5.7b example of a normal bounce off a previous low. This is normal market action and not to be confused with a double bottom. Prices will normally bounce off a previous low at least once, causing premature calls for a double bottom. Time between peaks or troughs is important. Finally, the size of the pattern is always important. The longer the time period, between the two peaks, and the greater the height of the pattern, the greater the potential impending reversal. This is true of all chart patterns. In general, most valid double tops or bottoms should have at least a month between the two peaks or troughs. Some will even be 2 or 3 months apart. On longer range, monthly and weekly charts, these patterns can span several years. Most of the examples used in this discussion have described market tops. The reader should be aware by now that bottoming patterns are mirror images of tops except for some of the general differences already touched upon at the beginning of the chapter. Saucers and spikes. Although not seen as frequently, reversal patterns sometimes take the shape of saucers or rounding bottoms. The saucer bottom shows a very slow and very gradual turn from down to sideways to up. It is difficult to tell exactly when the saucer has been completed or to measure how far prices will travel in the opposite direction. Saucer bottoms are usually spotted on weekly or monthly charts that span several years. The longer they last, the more significant they become. See Figure 5.8. Spikes are the hardest market turns to deal with because the spike, or V, pattern happens very quickly with little or no transition period. They usually take place in a market that has gotten so overextended in one direction that a sudden piece of adverse news causes the market to reverse direction very abruptly. A daily or weekly reversal on very heavy volume is sometimes the only warning they give us. That being the case, there's not much more we can say about them except that we hope you don't run into too many of them. Some technical indicators we discuss in later chapters will help you determine when markets have gotten dangerously overextended. See Figure 5.9. Figure 5.8. This chart shows what a saucer, or rounding, bottom looks like. They're very slow and gradual, but usually mark major turns. This bottom lasted for years. Figure 5.9 example of a V reversal pattern. These sudden reversals take place with little or no warning. A sudden price drop on heavy volume is usually the only telltale sign. Unfortunately, these sudden turns are hard to spot in advance. Conclusion. We've discussed the 5 most commonly used major reversal patterns: the head and shoulders, double and triple tops and bottoms, the saucer, and the V, or
spike.
Of those, the most common are the head and shoulders and double tops and bottoms. These patterns usually signal important trend reversals in progress and are classified as major reversal patterns. There is another class of patterns, however, which are shorter term in nature and usually suggest trend consolidations rather than reversals. They are aptly called continuation patterns. Let's look at this other type of pattern in Chapter 6. 6 Continuation Patterns. Introduction. The chart patterns covered in this chapter are called continuation patterns. These patterns usually indicate that the sideways price action on the chart is nothing more than a pause in the prevailing trend, and that the next move will be in the same direction as the trend that preceded the formation. This distinguishes this group of patterns from those in the previous chapter, which usually indicate that a major trend reversal is in progress. Another difference between reversal and continuation patterns is their time duration. Reversal patterns usually take much longer to build and represent major trend changes. Continuation patterns, on the other hand, are usually shorter term in duration and are more accurately classified as near-term or intermediate patterns. Notice the constant use of the term usually. The treatment of all chart patterns deals of necessity with general tendencies as opposed to rigid rules. There are always exceptions. Even the grouping of price patterns into different categories sometimes becomes tenuous. Triangles are usually continuation patterns, but sometimes act as reversal patterns. Although triangles are usually considered intermediate patterns, they may occasionally appear on long-term charts and take on major trend significance. A variation of the triangle, the inverted variety, usually signals a major market top. Even the head and shoulders pattern, The best known of the major reversal patterns will, on occasion, be seen as a consolidation pattern, even with allowances for a certain amount of ambiguity and the occasional exception. Chart patterns do generally fall into the above two categories and, if properly interpreted, can help the chartist determine what the market will probably do most of the time. Triangles. Let's begin our treatment of continuation patterns with the triangle. There are three types of triangles: symmetrical, ascending, and descending.
Some
Chartists include a fourth type of triangle known as an expanding triangle, or
broadening formation.
this is treated as a separate pattern later. Each type of triangle has a slightly different shape and has different forecasting implications. Figure 6.1a. See show examples of what each triangle looks like.
The
Symmetrical triangle, see Figure 6.1a, shows two converging trend lines, the upper line descending and the lower line ascending. The vertical line at the left, measuring the height of the pattern, is called the base. The point of intersection, at the right where the two lines meet, is called the apex. For obvious reasons, the symmetrical triangle is also called a coil. The ascending triangle has a rising lower line with a flat or horizontal upper line. See Figure 6.1b. The descending triangle, Figure 6.1c, by contrast, has the upper line declining with a flat or horizontal bottom line. Let's see how each one is interpreted. Figure 6.1, an example of a bullish symmetrical triangle. Notice the two converging trend lines. A close outside either trend line completes the pattern.
The
vertical line at the left is the base. The point at the right where the two lines meet is the apex. Figure 6.1b, example of an ascending triangle. Notice the flat upper line and the rising lower line. This is generally a bullish pattern. Figure 6.1c, example of a descending triangle. Notice the flat bottom line and the declining upper line. This is usually a bearish pattern. The symmetrical triangle. The symmetrical triangle, or the coil, is usually a continuation pattern.
It
represents a pause in the existing trend after which the original trend is resumed. In the example in Figure 6.1a, the prior trend was up, so that the percentages favor resolution of the triangular consolidation on the upside. If the trend had been down, then the symmetrical triangle would have bearish implications. The minimum requirement for a triangle is 4 reversal points. Remember that it always takes 2 points to draw a trend line. Therefore, in order to draw two converging trend lines, each line must be touched at least twice. In Figure 6.1a, the triangle actually begins at point 1, which is where the consolidation in the uptrend begins. Prices pull back to point 2 and then rally to point 3. Point 3, however, is lower than point 1. The upper trend line can only be drawn once. Prices have declined from point 3. Notice that point 4 is higher than point 2, only when prices have rallied. From point 4 can the lower upslanting line be drawn. It is at this point that the analyst begins to suspect that he or she is dealing with a symmetrical triangle. Now there are 4 reversal points, 1, 2, 3, and 4, and 2 converging trend lines. While the minimum requirement is 4 reversal points, many triangles have 6 reversal points as shown in Figure 6.1a. This means that there are actually 3 peaks and 3 troughs that combine to form 5 waves within the triangle before the uptrend resumes. When we get to the Elliott wave theory, we'll have more to say about the 5-wave tendency. Within triangles, time limit for triangle resolution. There is a time limit for the resolution of the pattern, and that is the point where the two lines meet at the apex. As a general rule, prices should break out in the direction of the prior trend somewhere between 2/3 to 3/4 of the horizontal width of the triangle. That is, the distance from the vertical base on the left of the pattern to the apex at the far right. Because the two lines must meet at some point, that time distance can be measured once the two converging lines are drawn. An upside breakout is signaled by a penetration of the upper trend line. If prices remain within the triangle beyond the 3/4 point, the triangle begins to lose its potency and usually means that prices will continue to drift out to the apex and beyond. The triangle, therefore, provides an interesting combination of price and
time.
the converging trend lines give the price boundaries of a pattern and indicate at what point the pattern has been completed and the trend resumed by the penetration of the upper trend line in the case of an uptrend. But these trend lines also provide a time target by measuring the width of the pattern. If the width, for example, were 20 weeks long, then the breakout should take place sometime between the 13th and the 15th week. See Figure 6.1d. The actual trend signal is given by a closing penetration of one of the trend lines. Sometimes a return move will occur back to the penetrated trend line after the breakout. In an uptrend, that line has become a support line.
In a
downtrend, the lower line becomes a resistance line once it's broken. The apex also acts as an important support or resistance level after the breakout occurs. Various penetration criteria can be applied to the breakout similar to those covered in the previous 2 chapters. A minimum penetration criterion would be a closing price outside the trend line and not just an intraday penetration. Figure 6.1d Dell formed a bullish symmetrical triangle during the fourth quarter of 1997. Measured from left to right, the triangle width is 18 weeks. Prices broke out on the 13th week, see circle, just beyond the 2/3 point. Importance of volume. Volume should diminish as the price swings narrow within the triangle. This tendency for volume to contract is true of all consolidation patterns, but the volume should pick up noticeably at the penetration of the trend line that completes the pattern. The return move should be on light volume with heavier activity again as the trend resumes. 2 other points should be mentioned about volume. As is the case with reversal patterns, volume is more important on the upside than on the downside. An increase in volume is essential to the resumption of an uptrend in all consolidation patterns. The second point about volume is that even though trading activity diminishes during formation of the pattern, a close inspection of the volume usually gives a clue as to whether the heavier volume is occurring during the up moves or down moves. In an uptrend, for example, there should be a slight tendency for volume to be heavier during the bounces and lighter on the price.
dips. Measuring technique.
Triangles have measuring techniques. In the case of the symmetrical triangle, there are a couple of techniques generally used. The simplest technique is to measure the height of the vertical line at the widest part of the triangle, the base, and measure that distance from the breakout point. Figure 6.2 shows the distance projected from the breakout point, which is the technique I prefer. The second method is to draw a trend line from the top of the base at point A, parallel to the lower trend line. This upper channel line then becomes the upside target in an uptrend. It is possible to arrive at a rough time target for prices to meet the upper channel line. Prices will sometimes hit the channel line. At the same time, the 2 converging lines meet at the apex. Figure 6.2. There are 2 ways to take a measurement from a symmetrical triangle. One is to measure the height of the base, AB. Project that vertical distance from the breakout point at C. Another method is to draw a parallel line upward from the top of the baseline, A, parallel to the lower line in the triangle. The ascending triangle. The ascending and descending triangles are variations of the symmetrical but have different forecasting implications. Figures 6.3a and b show examples of an ascending triangle. Notice that the upper trend line is flat, while the lower line is rising. This pattern indicates that buyers are more aggressive than sellers. It is considered a bullish pattern and is usually resolved with a breakout to the upside. Both the ascending and descending triangles differ from the symmetrical in a very important sense. No matter where in the trend structure the ascending or descending triangles appear, they have very definite forecasting implications. The ascending triangle is bullish and the descending triangle is bearish. The symmetrical triangle, by contrast, is inherently a neutral pattern. This does not mean, however, that the symmetrical triangle does not have forecasting value. On the contrary, because the symmetrical triangle is a continuation pattern, the analyst must simply look to see the direction of the previous trend and then make the assumption that the previous trend will continue. Figure 6.3, an ascending triangle. The pattern is completed on a decisive close. Above the upper line, this breakout should see a sharp increase in volume.
That
Upper resistance line should act as support on subsequent dips after the breakout. The minimum price objective is obtained by measuring the height of the triangle AB and projecting that distance upward from the breakout point at
C.
Figure 6.3b. The Dow transports formed a bullish ascending triangle near the end of 1997. Notice the flat upper line at 3,400 and the rising lower line. This is normally a bullish pattern no matter where it appears on the chart. Let's get back to the ascending triangle. As already stated, more often than not, the ascending triangle is bullish. The bullish breakout is signaled by a decisive closing above the flat upper trend line. As in the case of all valid upside breakouts, volume should see a noticeable increase on the breakout. A return move back to the support line, the flat upper line, is not unusual and should take place on light volume.
Measuring technique.
The measuring technique for the ascending triangle is relatively simple.
Simply
Measure the height of the pattern at its widest point and project that vertical distance from the breakout point. This is just another example of using the volatility of a price pattern to determine a minimum price objective. The ascending triangle as a bottom. While the ascending triangle most often appears in an uptrend and is considered a continuation pattern, it sometimes appears as a bottoming pattern. It is not unusual toward the end of a downtrend to see an ascending triangle develop. However, even in this situation, the interpretation of the pattern is bullish.
the
Breaking of the upper line signals completion of the base and is considered a bullish signal. Both the ascending and descending triangles are sometimes also referred to as right-angle triangles. The descending triangle. The descending triangle is just a mirror image of the ascending and is generally considered a bearish pattern. Notice in figures 6.4a and b, the descending upper line and the flat lower line. This pattern indicates that sellers are more aggressive than buyers and is usually resolved on the downside. The downside signal is registered by a decisive close under the lower trend line, usually on increased volume. A return move sometimes occurs which should encounter resistance at the lower trend line. The measuring technique is exactly the same as the ascending triangle in the sense that the analyst must measure the height of the pattern at the base to the left and then project that distance down from the breakdown point. The descending triangle as a top. While the descending triangle is a continuation pattern and usually is found within downtrends, it is not unusual on occasion for the descending triangle to be found at market tops. This type of pattern is not that difficult to recognize when it does appear in the top setting. In that case, a close below the flat lower line would signal a major trend reversal to the downside. Figure 6.4a, a descending triangle. The bearish pattern is completed with a decisive close under the lower flat line. The measuring technique is the height of the triangle AB projected down from the breakout at point C. Figure 6.4b, a bearish descending triangle formed in DuPont during the autumn of 1997. The upper line is descending while the lower line is flat. The break of the lower line in early October resolved the pattern to the downside. The volume pattern. The volume pattern in both the ascending and descending triangles is very similar in that the volume diminishes as the pattern works itself out and then increases on the breakout. As in the case of the symmetrical triangle, during the formation, the chartist can detect subtle shifts in the volume pattern coinciding with the swings in the price action. This means that in the ascending pattern, the volume tends to be slightly heavier on bounces and lighter on dips.
In the
descending formation, volume should be heavier on the downside and lighter during the bounces. The time factor in triangles. One final factor to be considered on the subject of triangles is that of the time dimension. The The triangle is considered an intermediate pattern, meaning that it usually takes longer than a month to form, but generally less than 3 months. A triangle that lasts less than a month is probably a different pattern, such as a pennant, which will be covered shortly. As mentioned earlier, triangles sometimes appear on long-term price charts, but their basic meaning is always the same: the broadening formation. This next price pattern is an unusual variation of the triangle and is relatively
Rare.
it is actually an inverted triangle or a triangle turned backwards. All of the triangular patterns examined so far show converging trend lines. The broadening formation, as the name implies, is just the opposite. As the pattern in Figure 6.5 shows, the trend lines actually diverge in the broadening formation, creating a picture that looks like an expanding triangle. It is also called a megaphone top. The volume pattern also differs in this formation. In the other triangular patterns, volume tends to diminish as the price swings grow narrower. Just the opposite happens in the broadening formation. The volume tends to expand, along with the wider price swings. This situation represents a market that is out of control and unusually emotional. Because this pattern also represents an unusual amount of public participation, it most often occurs at major market
Tops.
The expanding pattern, therefore, is usually a bearish formation.
It
Generally appears near the end of a major bull market. Figure 6.5a broadening top. This type of expanding triangle usually occurs at major tops. It shows 3 successively higher peaks and 2 declining troughs. The violation of the second trough completes the pattern. This is an unusually difficult pattern to trade and fortunately is relatively rare. Flags and pennants. The flag and pennant formations are quite common. They are usually treated together because they are very similar in appearance, tend to show up at about the same place in an existing trend, and have the same volume and measuring criteria. The flag and pennant represent brief pauses in a dynamic market move.
In
fact, one of the requirements for both the flag and the pennant is that they be preceded by a sharp and almost straight line move. They represent situations where a steep advance or decline has gotten ahead of itself, and where the market pauses briefly to catch its breath before running off again in the same
direction.
Flags and pennants are among the most reliable of continuation patterns and only rarely produce a trend reversal. Figures 6.6a-b show what these two patterns look like. To begin with, notice the steep price advance preceding the formations on heavy volume. Notice also the dramatic drop-off in activity as the consolidation patterns form, and then the sudden burst of activity on the upside. Breakout. Construction of flags and pennants. The construction of the two patterns differs slightly. The flag resembles a parallelogram or a rectangle marked by 2 parallel trend lines that tend to slope against the prevailing trend. In a downtrend, the flag would have a slight upward slope. Point 6. A example of a bullish flag. The flag usually occurs after a sharp move and represents a brief pause in the trend. The flag should slope against the
Trend.
volume should dry up during the formation and build again on the breakout. The flag usually occurs near the midpoint of the move. Figure 6.6b, a bullish pennant, resembles a small symmetrical triangle, but usually lasts no longer than 3 weeks. Volume should be light during its
Formation.
The move after the pennant is completed should duplicate the size of the move preceding it. The pennant is identified by 2 converging trend lines and is more horizontal. It very closely resembles a small symmetrical triangle. An important requirement is that volume should dry up noticeably while each of the patterns is forming. Both patterns are relatively short-term and should be completed within 1 to 3 weeks. Pennants and flags in downtrends tend to take even less time to develop and often last no longer than 1 or 2 weeks. Both patterns are completed on the penetration of the upper trend line in an uptrend. The breaking of the lower trend line would signal resumption of downtrends. The breaking of Those trend lines should take place on heavier volume. As usual, upside volume is more critically important than downside volume. See figures 6.7a-b. Measuring implications. The measuring implications are similar for both patterns. Flags and pennants are said to fly at half-mast from a flagpole. The flagpole is the prior sharp advance, or decline. The term half-mast suggests that these minor continuation patterns tend to appear at about the halfway point of the move. In general, the move after the trend has resumed will duplicate the flagpole or the move just prior to the formation of the pattern. Figure 6.7a, a bullish flag in international paper. The flag looks like a down, sloping parallelogram. Notice that the flag occurred right at the halfway point of the uptrend. To be more precise, measure the distance of the preceding move from the original breakout point. That is to say, the point at which the original trend signal was given either by the penetration of a support or resistance level or an important trend line. That vertical distance of the preceding move is then measured from the breakout point of the flag or pennant, that is, the point at which the upper line is broken in an uptrend or the lower line in a downtrend.
Summary.
Let's summarize the more important points of both patterns. Figure 6.7b, a couple of pennants are flying on this caterpillar chart.
Pennants
Are short-term continuation patterns that look like small symmetrical triangles. The pennant to the left continued the uptrend, while the one to the right
continued the downtrend.
1. They are both preceded by an almost straight-line move called a flagpole on heavy volume. 2. Prices then pause for about 1 to 3 weeks on very light volume. 3. The trend resumes on a burst of trading activity. 4. Both patterns occur at about the midpoint of the market move. 5. The pennant resembles a small horizontal symmetrical triangle. 6. The flag resembles a small parallelogram that slopes against the prevailing
Trend.
7. Both patterns take less time to develop in downtrends. 8. Both patterns are very common in the financial markets. The wedge formation. The wedge formation is similar to a symmetrical triangle both in terms of its shape and the amount of time it takes to form. Like the symmetrical triangle, it is identified by two converging trend lines that come together at an apex. In terms of the amount of time it takes to form, the wedge usually lasts more than 1 month, but not more than 3 months, putting it into the intermediate category. What distinguishes the wedge is its noticeable slant. The wedge pattern has a noticeable slant either to the upside or the downside. As a rule, like the flag pattern, the wedge slants against the prevailing trend. Therefore, a falling wedge is considered bullish and a rising wedge is bearish. Notice in figure 6.8a
That
the bullish wedge slants downward between two converging trend lines. In the downtrend in figure 6.8b, the converging trend lines have an unmistakable upward slant. Figure 6.8a example of a bullish falling wedge. The wedge pattern has two converging trend lines, but slopes against the prevailing trend. A falling wedge is usually bullish. Figure 6.8b example of a bearish wedge. A bearish wedge should slope upward against the prevailing downtrend. Wedges as tops and bottom reversal patterns. Wedges show up most often within the existing trend and usually constitute continuation patterns. The wedge can appear at tops or bottoms and signal a
trend reversal.
But that type of situation is much less common. Near the end of an uptrend, the chartist may observe a clear-cut rising wedge.
Because a
continuation wedge in an uptrend should slope downward against the prevailing trend. The rising wedge is a clue to the chartist that this is a bearish and not a bullish pattern. At bottoms, a falling wedge would be a tip-off of a possible end of a bear trend. Whether the wedge appears in the middle or the end of a market move, the market analyst should always be guided by the general maxim that a rising wedge is bearish and a falling wedge is bullish. See figure 6.8c. The rectangle formation. The rectangle formation often goes by other names, but is usually easy to spot on a price chart. It represents a pause in the trend during which prices move sideways between two parallel horizontal lines. See Figures 6.9a-c. The rectangle is sometimes referred to as a trading range or a congestion
area.
In Dow Theory parlance, it is referred to as a line. Whatever it is called, it usually represents just a consolidation period in the existing trend and is usually resolved in the direction of the market trend that preceded its occurrence.
In
terms of forecasting value, it can be viewed as being similar to the symmetrical triangle but with flat instead of converging trend lines. Figure 6.8 see example of a bearish rising wedge. The two converging trend lines have a definite upward slant. The wedge slants against the prevailing trend. Therefore, a rising wedge is bearish and a falling wedge is bullish. Figure 6.9, example of a bullish rectangle in an uptrend. This pattern is also called a trading range and shows prices trading between two horizontal trend lines. It is also called a congestion area. Figure 6.9 be example of a bearish rectangle. While rectangles are usually considered continuation patterns, the trader must always be alert for signs that it may turn into a reversal pattern, such as a triple bottom. Figure 6.9 see a bullish rectangle. Compact's uptrend was interrupted for 4 months while it traded sideways. The break above the upper line in early May completed the pattern and resumed the uptrend. Rectangles are usually continuation patterns. A decisive close outside either the upper or lower boundary signals completion of the rectangle and points the direction of the trend. The market analyst must always be on the alert, however, that the rectangular consolidation does not turn into a reversal pattern. In the uptrend shown in Figure 6.9a, for example, notice that the three peaks might initially be viewed as a possible triple top reversal pattern. The importance of the volume pattern. One important clue to watch for is the volume pattern. Because the price swings in both directions are fairly broad, the analyst should keep a close eye on which moves have the heavier volume. If the rallies are on heavier and the setbacks on lighter volume, then the formation is probably a continuation in the uptrend.
If
the heavier volume is on the downside, then it can be considered a warning of a possible trend reversal in the works. Swings within the range can be traded. Some chartists trade the swings within such a pattern by buying dips near the bottom and selling rallies near the top of the range. This technique enables the short-term trader to take advantage of the well-defined price boundaries and profit from an otherwise trendless market. Because the positions are being taken at the extremes of the range, the risks are relatively small and well-defined. If the trading range remains intact, this counter-trend trading approach works quite
well.
When a breakout does occur, the trader not only exits the last losing trade immediately, but can reverse the previous position by initiating a new trade in the direction of the new trend. Oscillators are especially useful in sideways trading markets, but less useful once the breakout has occurred for reasons discussed in Chapter 10. Other traders assume the rectangle is a continuation pattern and take long positions near the lower end of the price band in an uptrend, or initiate short positions near the top of the range in downtrends. Others avoid such trendless markets altogether and await a clear-cut breakout before committing their funds. Most trend-following systems perform very poorly during these periods of sideways and trendless market action. Other similarities and differences. In terms of duration, the rectangle usually falls into the 1 to 3 month category, similar to triangles and wedges. The volume pattern differs from other continuation patterns in the sense that the broad price swings prevent the usual drop-off in activity seen in other such patterns. The most common measuring technique applied to the rectangle is based on the height of the price range. Measure the height of the trading range from top to bottom, and then project that vertical distance from the breakout point. This method is similar to the other vertical measuring techniques already mentioned, and is based on the volatility of the market. When we cover the count in point and figure charting, we'll say more on the question of horizontal price Measurements. Everything mentioned so far concerning volume on breakouts and the probability of return moves applies here as well, because the upper and lower boundaries are horizontal and so well defined in the rectangle, support and resistance levels are more clearly evident. This means that, on upside breakouts, the top of the former price band should now provide solid support on any sell-offs. After a downside breakout in downtrends, the bottom of the trading range, the previous support area, should now provide a solid ceiling over the market on any rally attempts. The measured move. The measured move, or the swing measurement, as it is sometimes called, describes the phenomenon where a major market advance or decline is divided into two equal and parallel moves, as shown in Figure 6.10a. For this approach to work, the market moves should be fairly orderly and well-defined.
The
measured move is really just a variation of some of the techniques we've already
touched on.
We've seen that some of the consolidation patterns, such as flags and pennants, usually occur at about the halfway point of a market move. We've also mentioned the tendency of markets to retrace about a third to a half of a prior trend before resuming that trend. Figure 6.10, an example of a measured move or the swing measurement in an uptrend. This theory holds that the second leg in the advance, CD, duplicates the size and slope of the first upleg, AB. The corrective wave, BC, often retraces a third to a half of AB before the uptrend is resumed. Figure 6.10b, a measured move takes the prior upleg, AB, and adds that value to the bottom of the correction at C. On this chart, the prior uptrend, AB, was 20
points.
Adding that to the low point at C, 62, yielded a price target to 82D. In the measured move, when the chartist sees a well-defined situation, such as in Figure 6.10a, with a rally from point A to point B followed by a countertrend swing from point B to point C, which retraces a third to a half of wave AB, it is assumed that the next leg in the uptrend, CD, will come close to duplicating the first leg, AB. The height of wave, AB, therefore, is simply measured upward from the bottom of the correction at point C. The continuation, head, and shoulders
pattern.
In the previous chapter, we treated the head and shoulders pattern at some length and described it as the best known and most trustworthy of all reversal patterns. The head and shoulders pattern can sometimes appear as a continuation instead of a reversal pattern. In the continuation head and shoulders variety, prices trace out a pattern that looks very similar to a sideways rectangular pattern, except that the middle trough in an uptrend, see Figure 6.11a, tends to be lower than either of the two shoulders. In a downtrend, see Figure 6.11b, the middle peak in the consolidation exceeds the other two peaks. The result in both cases is a head and shoulders pattern turned upside down. Because it is turned upside down, there is no chance of confusing it with the reversal pattern. Figure 6.11, an example of a bullish continuation head and shoulders pattern. Figure 6.11b, example of a bearish continuation head and shoulders pattern. Figure 6.11c, General Motors formed a continuation head and shoulders pattern during the first half of 1997. The pattern is very clear but shows up in an unusual place. The pattern was completed and the uptrend resumed with the close above the neckline at 60. Confirmation and divergence. The principle of confirmation is one of the common themes running throughout the entire subject of market analysis and is used in conjunction with its counterpart, divergence. We'll introduce both concepts here and explain their meaning, but we'll return to them again and again throughout the book because their impact is so important. We're discussing confirmation here in the context of chart patterns, but it applies to virtually every aspect of technical analysis. Confirmation refers to the comparison of all technical signals and indicators to ensure that most of those indicators are pointing in the same direction and are confirming one another. Divergence is the opposite of confirmation and refers to a situation where different technical indicators fail to confirm one another while it is being used. Here, in a negative sense, divergence is a valuable concept in market analysis and one of the best early warning signals of impending trend reversals. We'll discuss the principle of divergence at greater length in Chapter 10, Oscillators and Contrary Opinion. Conclusion. This concludes our treatment of price patterns. We stated earlier that the three pieces of raw data used by the technical analysts were price, volume, and open
Interest.
Most of what we've said so far has focused on price. Let's take a closer look now at volume and open interest and how they are incorporated into the analytical process. 7. Volume and open interest. Introduction. Most technicians in the financial markets use a multidimensional approach to market analysis by tracking the movement of three sets of figures: price, volume, and open interest. Volume analysis applies to all markets. Open interest applies primarily to futures markets. Chapter 3 discussed the construction of the daily bar chart and showed how the three figures were plotted on that type of
Chart.
It was stated then that even though volume and open interest figures are available for each delivery month in futures markets, the total figures are the ones generally used for forecasting purposes. Stock chartists simply plot total volume along with the accompanying price. Most of the discussion of charting theory to this point has concentrated mainly on price action with some mention of volume. In this chapter, we'll round out the three-dimensional approach by taking a closer look at the role played by volume and open interest in the forecasting process. Volume and open interest as secondary indicators. Let's begin by placing volume and open interest in their proper perspective. Price is by far the most important. Volume and open interest are secondary in importance and are used primarily as confirming indicators. Of those two, volume is the more important. Volume is the number of entities traded during the time period under study. Because we'll be dealing primarily with daily bar charts, our main concern is with daily volume. That daily volume is plotted by a vertical bar at the bottom of the chart under the day's price action. See Figure 7.1. Figure 7.1. Notice that the volume bars are noticeably larger as prices are rallying. See circles. That means that volume is confirming the price rise and is bullish. Volume can be plotted for weekly bar charts as well. In that case, total volume for the week would simply be plotted under the bar representing that week's price action. Volume is usually not used, however, on monthly bar charts. Open interest in futures. The total number of outstanding or unliquidated contracts at the end of the day is open interest. In Figure 7.2, open interest is the solid line plotted on the chart under its corresponding price data for the day, but above the volume bars. Remember that official volume and open interest figures are reported a day late in the futures markets and are, therefore, plotted with a one-day lag. Only estimated volume figures are available for the last trading day. That means that each day the chartist plots the high, low, and closing price bar for the last day of trading, but plots the official volume and open interest figures for the previous
Day.
Open interest represents the total number of outstanding longs or shorts in the market, not the sum of both. Open interest is the number of contracts.
A.
Contract must have both a buyer and a seller. Therefore, two market participants, a buyer and a seller, combine to create only one contract. The open interest figure reported each day is followed by either a positive or negative number, showing the increase or decrease in the number of contracts for that day. It is those changes in the open interest levels, either up or down, that give the chartist clues as to the changing character of market participation and give open interest its forecasting value. How changes in open interest occur. In order to grasp the significance of how changes in the open interest numbers are interpreted, the reader must first understand how each trade produces a change in those numbers. Every time a trade is completed on the floor of the exchange, the open interest is affected in one of three ways: it increases, decreases, or stays unchanged. Let's see how those changes occur. In the first case, both the buyer and seller are initiating a new position, and a new contract is established. In case 2, the buyer is initiating a new long position, but the seller is merely liquidating an old long. One is entering and the other exiting a trade. The result is a standoff and no change takes place in the number of contracts. In case 3, the same thing happens except this time it is the seller who is initiating a new short and the buyer who is only covering an old short. Because one of the traders is entering and the other exiting a trade, again no change is produced. In case 4, both traders are liquidating an old position and the open interest decreases accordingly. To sum up, if both participants in a trade are initiating a new position, the open interest will increase. If both are liquidating an old position, the open interest will decline. If, however, one is initiating a new trade while the other is liquidating an old trade, open interest will remain unchanged. By looking at the net change in the total open interest at the end of the day, the chartist is able to determine whether money is flowing into or out of the market. This information enables the analyst to draw some conclusions about the strength or weakness of the current price trend. General rules for interpreting volume and open interest. The futures technician incorporates volume and open interest information into market analysis. The rules for the interpretation of volume and open interest are generally combined because they are so similar. There are, however, some distinctions between the two that should be addressed. We'll begin here with a statement of the general rules for both. Having done that, we'll then treat each one separately before combining them again at the end. If volume and open interest are both increasing, then the current price trend will probably continue in its present direction, either up or down. If, however, volume and open interest are declining, the action can be viewed as a warning that the current price trend may be nearing an end. Having said that, let's now take a look at volume and open interest separately. See Figure 7.2. Figure 7.2, a daily chart of crude oil futures shows volume and open interest. Solid line. The open interest line is rising as prices are falling, which is bearish. Interpretation of volume for all markets. The level of volume measures the intensity or urgency behind the price move. Heavier volume reflects a higher degree of intensity or pressure. By monitoring the level of volume along with price action, the technician is better able to gauge the buying or selling pressure behind market moves. This information can then be used to confirm price movement or warn that a price move is not to be
trusted.
See Figures 7.3 and 7.4. To state the rule more concisely, volume should increase or expand in the direction of the existing price trend. In an uptrend, volume should be heavier as the price moves higher and should decrease or contract on price dips. As long as this pattern continues, volume is said to be confirming the price trend. Figure 7.3, the upside price breakout by McDonald's through the November 1997 peak was accompanied by a noticeable burst of trading activity. That's bullish. Figure 7.4, the volume bars are following Intel's price uptrend. Volume is heavier as prices are rising and drops off as prices weaken. Notice the burst of trading activity during the last 3 days' price jump. The chartist is also watching for signs of divergence. There's that word again. Divergence occurs if the penetration of a previous high by the price trend takes place on declining volume. This action alerts the chartist to diminishing buying pressure. If the volume also shows a tendency to pick up on price dips, the analyst begins to worry that the uptrend is in trouble. Volume as confirmation in price patterns. During our treatment of price patterns in chapters 5 and 6, volume was mentioned several times as an important confirming indicator. One of the first signs of a head and shoulders top occurred when prices moved into new highs. During the formation of the head on light volume, with heavier activity on the subsequent decline to the neckline, the double and triple tops saw lighter volume on each successive peak followed by heavier downside activity. Continuation patterns, like the triangle, should be accompanied by a gradual
Drop off in volume.
As a rule, the resolution of all price patterns, the breakout point should be accompanied by heavier trading activity if the signal given by that breakout is real. See Figure 7.5. In a downtrend, the volume should be heavier during down moves and lighter on bounces. As long as that pattern continues, the selling pressure is greater than buying pressure and the downtrend should continue. It's only when that pattern begins to change that the chartist starts looking for signs of a bottom. Volume precedes price. By monitoring the price and volume together, we're actually using two different tools to measure the same thing, pressure. By the mere fact that prices are trending higher, we can see that there is more buying than selling pressure.
It
stands to reason then that the greater volume should take place in the same direction as the prevailing trend. Technicians believe that volume precedes price, meaning that the loss of upside pressure in an uptrend or downside pressure in a downtrend actually shows up in the volume figures before it is manifested in a reversal of the price trend. Figure 7.5. The first half of this chart shows a positive trend with heavier volume. On up days, the box at the top shows a sudden downturn on heavy volume, a negative sign. Notice the increase in trading as the continuation triangle is broken on the downside. On balance volume, technicians have experimented with many volume indicators to help quantify buying or selling pressure. Trying to eyeball the vertical volume bars along the bottom of the chart is not always precise enough to detect significant shifts in the volume flow. The simplest and best known of these volume indicators is on balance volume or OBV, developed and popularized by Joseph Granville in his 1963 book, Granville's New Key to Stock Market Profits. OBV actually produces a curving line on the price chart. This line can be used either to confirm the quality of the current price trend or warn of an impending reversal by diverging
from the price action.
Figure 7.6 shows the price chart with the OBV line along the bottom of the chart instead of the volume bars. Notice how much easier it is to follow the volume trend with the OBV line. The construction of the OBV line is simplicity itself. The total volume for each day is assigned a plus or minus value depending on whether prices close higher or lower for that day. A higher close causes the volume for that day to be given a plus value, while a lower close counts for negative volume. A running cumulative total is then maintained by adding or subtracting each day's volume based on the direction of the market close. It is the direction of the OBV line, its trend, that is important and not the actual numbers themselves. The actual OBV values will differ depending on how far back you are charting. Let the computer handle the calculations.
Concentrate
on the direction of the OBV line. The on-balance volume line should follow in the same direction as the price
trend.
If prices show a series of higher peaks and troughs, an uptrend, the OBV line should do the same. If prices are trending lower, so should the OBV line.
It's
when the volume line fails to move in the same direction as prices that a divergence exists and warns of a possible trend reversal. Figure 7.6. The line along the bottom shows on balance volume, OBV, for the same compact chart. Notice how much easier it was to spot the downturn in October 1997. Alternatives to OBV. The on-balance volume line does its job reasonably well, but it has some shortcomings. For one thing, it assigns an entire day's volume a plus or minus value. Suppose a market closes up on the day by some minimal amount such as 1 or 2 ticks. Is it reasonable to assign all of that day's activity a positive
value?
Or consider a situation where the market spends most of the day on the upside, but then closes slightly lower. Should all of that day's volume be given a negative value? To resolve these questions, technicians have experimented with many variations of OBV in an attempt to discover the true upside and downside volume. One variation is to give greater weight to those days where the trend is the strongest. On an up day, for example, the volume is multiplied by the amount of the price gain. This technique still assigns positive and negative values but gives greater weight to those days with greater price movement and reduces the impact of those days where the actual price change is minimal. There are more sophisticated formulas that blend volume and open interest with price action. James Sibbitt's demand index, for example, combines price and volume into a leading market indicator. The Herrick Payoff Index uses open interest to measure money flow. See Appendix A for an explanation of both indicators. It should be noted that volume reporting in the stock market is much more useful than in the futures markets. Stock trading volume is reported immediately, while it is reported a day late for futures. Levels of upside and downside volume are also available for stocks, but not in futures. The availability of volume data for stocks on each price change during the day has facilitated an even more advanced indicator called money flow, developed by Laszlo Barini, Jr. This real-time version of OBV tracks the level of volume on each price change in order to determine if money is flowing into or out of a stock. This sophisticated calculation, however, requires a lot of computer power and isn't readily available to most traders. These more sophisticated variations of OBV have basically the same intent: to determine whether the heavier volume is taking place on the upside, bullish, or the downside, bearish. Even with its simplicity, the OBV line still does a pretty good job of tracking the volume flow in a market, either in futures
or stocks.
And OBV is readily available on most charting software. Most charting packages even allow you to plot the OBV line right over the price data. For even easier comparison, see Figures 7.7 and 7.8. Figure 7.7, an excellent example of how a bearish divergence between the on-balance volume line, bottom, and the price of Intel correctly warned of a major downturn. Other volume limitations in futures. We've already mentioned the problem of the one-day lag in reporting futures volume. There is also the relatively awkward practice of using total volume numbers to analyze individual contracts instead of each contract's actual volume. There are good reasons for using total volume, but how does one deal with situations when some contracts close higher and others lower in the same futures market on the same day? Limit days produce other problems. Days when markets are locked limit up usually produce very light volume. This is a sign of strength, as the numbers of buyers so overwhelm the sellers that prices reach the maximum trading limit and cease trading. According to the traditional rules of interpretation, light volume on a rally is bearish. The light volume on limit days is a violation of that principle and can distort OBV numbers. Figure 7.8, overlaying the OBV solid line right over the price bars, makes for easier comparison between price and volume. This chart of McDonald shows the OBV line leading the price higher and warning in advance of the bullish breakout. Even with these limitations, however, volume analysis can still be used in the futures markets, and the technical trader would be well advised to keep a watchful eye on volume indications. Interpretation of open interest in futures. The rules for interpreting open interest changes are similar to those for volume, but require additional explanation. 1. With prices advancing in an uptrend and total open interest increasing, new money is flowing into the market, reflecting aggressive new buying, and is considered bullish. See Figure 7.9. Figure 7.9. The uptrend in silver prices was confirmed by a similar rise in the open interest line. The boxes to the right show some normal liquidation of outstanding contracts as prices start to correct downward. 2. If, however, prices are rising and open interest declines, the rally is being caused primarily by short covering holders of losing short positions, being forced to cover those positions. Money is leaving rather than entering the market. This action is considered bearish because the uptrend will probably run out of steam once the necessary short covering has been completed. See Figure 7.10. 3. With prices in a downtrend and open interest rising, the technician knows that new money is flowing into the market, reflecting aggressive new short selling. This action increases the odds that the downtrend will continue and is considered bearish. See Figure 7.11. 4. If, however, total open interest is declining along with declining prices, the price decline is being caused by discouraged or losing longs being forced to liquidate their positions. This action is believed to indicate a strengthening technical situation because the downtrend will probably end once open interest has declined sufficiently to show that most losing longs have completed their selling. Figure 7.10, an example of a weak price rebound in gold futures. The price rise is accompanied by falling open interest, while the price decline shows rising open interest. A strong trend would see open interest trending with price not against it. Let's summarize these 4 points. 1. Rising open interest in an uptrend is bullish. 2. Declining open interest in an uptrend is bearish. 3. Rising open interest in a downtrend is bearish. 4. Declining open interest in a downtrend is bullish. Figure 7.11. The downturn in copper during the summer of 1997 and the subsequent price decline was accompanied by rising open interest. Rising open interest during a price decline is bearish because it reflects aggressive short
Selling.
other situations where open interest is important. In addition to the preceding tendencies, there are other market situations where a study of open interest can prove useful. 1. Toward the end of major market moves, where open interest has been increasing throughout the price trend, a leveling off or decline in open interest is often an early warning of a change in trend. 2. A high open interest figure at market tops can be considered bearish if the price drop is very sudden. This means that all of the new longs established near the end of the uptrend now have losing positions. Their forced liquidation will keep prices under pressure until the open interest has declined sufficiently. As an example, let's assume that an uptrend has been in effect for some time. Over the past month, open interest has increased noticeably. Remember that every new open interest contract has one new long and one new short. Suddenly, prices begin to drop sharply and fall below the lowest price set over the past month. Every single new long established during that month now has a loss. The forced liquidation of those longs keeps prices under pressure until they have all been liquidated. Worse still, their forced selling often begins to feed on itself and, as prices are pushed even lower, causes additional margin selling by other longs and intensifies the new price decline. As a corollary to the preceding point, an unusually high open interest in a bull market is a danger signal. 3. If open interest builds up noticeably during a sideways consolidation or a horizontal trading range, the ensuing price move intensifies once the breakout occurs. This only stands to reason the market is in a period of indecision.
No.
One is sure which direction the trend breakout will take. The increase in open interest, however, tells us that a lot of traders are taking positions in anticipation of the breakout. Once that breakout does occur, a lot of traders are going to be caught on the wrong side of the market. Let's assume we've had a 3-month trading range and that the open interest has jumped by 10,000 contracts. This means that 10,000 new long positions and 10,000 new short positions have been taken. Prices then break out on the upside and new 3-month highs are established. Because prices are trading at the highest point in 3 months, every single short position, all 10,000 of them, initiated during the previous 3 months, now shows a loss. The scramble to cover those losing shorts naturally causes additional upside pressure on prices, producing even more panic. Prices remain strong until all or most of those 10,000 short positions have been offset by buying into the market.
Strength.
If the breakout had been to the downside, then it would have been the longs doing the scrambling. The early stage of any new trend immediately following a breakout is usually fueled by forced liquidation by those caught on the wrong side of the market. The more traders caught on the wrong side manifested in the high open interest, the more severe the response to a sudden adverse market move.
On a
more positive note, the new trend is further aided by those on the right side of the market whose judgment has been vindicated and who are now using accumulated paper profits to finance additional positions. It can be seen why the greater the increase in open interest during a trading range or any price formation for that matter, the greater the potential for the subsequent price
move.
4. Increasing open interest at the completion of a price pattern is viewed as added confirmation of a reliable trend signal. The breaking of the neckline, for example, of a head and shoulders bottom is more convincing if the breakout occurs on increasing open interest along with the heavier volume. The analyst has to be careful here, because the impetus following the initial trend signal is often caused by those on the wrong side of the market. Sometimes the open interest dips slightly at the beginning of a new trend. This initial dip in the open interest can mislead the unwary chart reader and argues against focusing too much attention on the open interest changes over the very short term. Summary of volume and open interest. Rules. Let's summarize some of the more important elements of price, volume, and open interest. 1. Volume is used in all markets. Open interest mainly in futures. 2. Only the total volume and open interest are used for futures. 3. Increasing volume and open interest indicate that the current price trend will probably continue. 4. Declining volume and open interest suggests that the price trend may be changing. 5. Volume precedes price. Changes in buying or selling pressure are often detected in volume before price. 6. On balance, volume, OBV, or some variation thereof, can be used to more accurately measure the direction of volume pressure. 7. Within an uptrend, a sudden leveling off or decline in open interest often warns of a change in trend. This applies only to futures. 8. Very high open interest at market tops is dangerous and can intensify downside pressure. This applies only to futures. 9. A buildup in open interest during consolidation periods intensifies the ensuing breakout. This applies only to futures. 10. Increases in volume and open interest help confirm the resolution of price patterns or any other significant chart developments that signal the beginning of a new trend. Blow-offs and selling climaxes. One final situation not covered so far that deserves mention is the type of dramatic market action that often takes place at tops and bottoms, blow-offs and selling climaxes. Blow-offs occur at major market tops and selling climaxes at bottoms. In futures, blow-offs are often accompanied by a drop in open interest during the final rally. In the case of a blow-off at market tops, prices suddenly begin to rally sharply after a long advance, accompanied by a large jump in trading activity and then peak abruptly. See Figure 7.12. In a selling climax, bottom, prices suddenly drop sharply on heavy trading activity and rebound as
quickly.
Refer back to Figure 4.22c. Commitments of Traders Report. Our treatment of open interest would not be complete without mentioning the Commitments of Traders (COT) report and how it is used by futures technicians. As a forecasting tool, the report is released by the Commodity Futures Trading Commission (CFTC) twice a month, a mid-month report and one at months.
And
the report breaks down the open interest numbers into 3 categories: large hedgers, large speculators, and small traders. The large hedgers, also called commercials, use the futures markets primarily for hedging purposes. Large speculators include the large commodity funds, who rely primarily on mechanical trend-following systems. The final category of small traders includes the general public, who trade in much smaller amounts. Figure 7.12a. A couple of blow-off tops in coffee futures. In both cases, prices rallied sharply on heavy volume. The negative warnings came from the decline in open interest solid line. During both rallies, see arrows. Watch the commercials. The guiding principle in analyzing the commitments report is the belief that the large commercial hedgers are usually right, while the traders are usually wrong. That being the case, the idea is to place yourself in the same positions as the hedgers and in the opposite positions of the 2 categories of traders.
4.
Example, a bullish signal at a market bottom would occur when the commercials are heavily net long while the large and small traders are heavily net short.
In a
Rising market, a warning signal of a possible top would take place when the large and small traders become heavily net long at the same time that the commercials are becoming heavily net short. Net trader positions. It is possible to chart the trends of the three market groups and to use those trends to spot extremes in their positions. One way to do that is to study the net trader positions published in futures charts, published by Commodity Trend Service, P.O. Box 32309, Palm Beach Gardens, Florida 33420. That charting service plots three lines that show the net trader positions for all three groups on a weekly price chart for each market going back 4 years. By providing 4 years of data, historical comparisons are easily done. Nick Van Nice, the publisher of that chart service, looks for situations where the commercials are at one extreme and the two categories of traders at the other to find buying and selling opportunities, as shown in figures 7.13 and 7.14. Even if you don't use the COD report as a primary input in your trading decisions, it's not a bad idea to keep an eye on what those three groups are doing. Open interest in options. Our coverage of open interest has concentrated on the futures markets. Open interest plays an important role in options trading as well. Open interest figures are published each day for put and call options on futures markets, stock averages, industry indexes, and individual stocks. While open interest in options may not be interpreted in exactly the same way as in futures, it tells us essentially the same thing where the interest is and the liquidity. Some option traders compare call open interest bulls to put open interest bears in order to measure market sentiment. Others use option volume. Figure 7.13. This weekly chart of S&P 500 futures shows 3 buy signals. See arrows. The lines along the bottom show the commercials, solid line, heavily net long, and the large speculators, dashed line, heavily net short at each buy signal. Put/call ratios. Volume figures for the options markets are used essentially the same way as in futures and stocks. That is, they tell us the degree of buying or selling pressure in a given market. Volume figures in options are broken down into call volume, bullish, and put volume, bearish. By monitoring the volume in calls versus puts, we are able to determine the degree of bullishness or bearishness in a market. One of the primary uses of volume data in options trading is the construction of put/call volume ratios. When options traders are bullish, call volume exceeds put volume and the put/call ratio falls. A bearish attitude is reflected in heavier put volume and a higher put/call ratio. The put/call ratio is usually viewed as a contrary indicator. A very high ratio signals an oversold market. A very low ratio is a negative warning of an overbought market. Figure 7.14. This weekly chart of copper futures shows 3 sell signals marked by the arrows. Each sell signal shows net long positions by the two categories of speculators and a net short position by the commercials. The commercials were
right.
Combine option sentiment with technicals. Options traders use open interest and volume put/call figures to determine extremes in bullish or bearish sentiment. These sentiment readings work best when combined with technical measures such as support, resistance, and the trend of the underlying market. Since timing is so crucial in options, most option traders are technically oriented. Conclusion. That concludes our coverage of volume and open interest, at least for now. Volume analysis is used in all financial markets, futures, options, and stocks. Open interest applies only to futures and options. But since futures and options are traded on so many stock market vehicles, some understanding of how open interest works can be useful in all three financial arenas. In most of our discussions so far, we've concentrated on daily bar charts. The next step is to broaden our time horizon and to learn how to apply the tools we've learned to weekly and monthly charts in order to perform long-range trend analysis.
We'll
Accomplish that in the next chapter. 8 long-term charts. Introduction. Of all the charts utilized by the market technician for forecasting and trading the financial markets, the daily bar chart is, by far, the most popular. The daily bar chart usually covers a period of only 6 to 9 months. However, because most traders confine their interest to relatively short-term market action, daily bar charts have gained wide acceptance as the primary working tool of the chartist. The average trader's dependence on these daily charts, however, and the preoccupation with short-term market behavior cause many to overlook a very useful and rewarding area of price charting: the use of weekly and monthly charts for longer-range trend analysis and forecasting. The daily bar chart covers a relatively short period of time in the life of any market. A thorough trend analysis of a market, however, should include some consideration of how the daily market price is moving in relation to its long-range trend structure. To accomplish that task, longer-range charts must be employed, whereas on the daily bar chart each bar represents one day's price action. On the weekly and monthly charts, each price bar represents 1 week's and 1 month's price action, respectively. The purpose of weekly and monthly charts is to compress price action in such a way that the time horizon can be greatly expanded and much longer time periods can be studied. The importance of longer-range
perspective.
Long-range price charts provide a perspective on the market trend that is impossible to achieve with the use of daily charts alone. During our introduction to the technical philosophy in Chapter 1, it was pointed out that one of the greatest advantages of chart analysis is the application of its principles to virtually any time dimension, including long-range forecasting. We also address the fallacy espoused by some that technical analysis should be limited to short-term timing, with longer-range forecasting left to the
fundamental analyst.
The accompanying charts will demonstrate that the principles of technical analysis, including trend analysis, support and resistance levels, trend lines, percentage retracements, and price patterns, lend themselves quite well to the analysis of long-range price movements. Anyone who is not consulting these longer-range charts is missing an enormous amount of valuable price information. Construction of continuation charts. For futures, the average futures contract has a trading life of about 1.5 years before expiration. This limited life feature poses some obvious problems for the technician interested in constructing a long-range chart going back several years. Stock market technicians don't have this problem. Charts are readily available for individual common stocks and the market averages from the inception of trading. How then does the futures technician construct longer-range charts for contracts that are constantly expiring? The answer is the continuation chart. Notice the emphasis on the word continuation. The technique most commonly employed is simply to link a number of contracts together to provide continuity. When one contract expires, another one is used. In order to accomplish this, the simplest method and the one used by most chart services is to always use the price of the nearest expiring contract. When that nearest expiring contract stops trading, the next in line becomes the nearest contract and is the one plotted. Other ways to construct continuation charts. The technique of linking prices of the nearest expiring contracts is relatively simple and does solve the problem of providing price continuity. However, there are some problems with that method. Sometimes the expiring contract may be trading at a significant premium or discount to the next contract, and the changeover to the new contract may cause a sudden price drop or jump on the
chart.
Another potential distortion is the extreme volatility experienced by some spot contracts just before expiration. Futures technicians have devised many ways to deal with these occasional distortions. Some will stop plotting the nearest contract a month or two before it expires to avoid the volatility in the spot month. Others will avoid using the nearest contract altogether and will instead chart the second or third contract. Another method is to chart the contract with the highest open interest on the theory that that delivery month is the truest representation of market value. Continuation charts can also be constructed by linking specific calendar months. For example, a November soybean continuation chart would combine only the historic data provided by each successive year's November soybean contract. This technique of linking specific delivery months was favored by
Віршо Доуган.
some chartists go even further by averaging the prices of several contracts or constructing indices that attempt to smooth the changeover by making adjustments in the price premium or discount. The perpetual contract, an innovative solution to the problem of price continuity, was developed by Robert Pelletier, president of Commodity Systems Incorporated, a commodity and stock data service (CSI). 200 West Palmetto Park Road, Boca Raton, Florida 33422, called the perpetual contract. Perpetual contract is a registered trademark of that firm. The purpose of the perpetual contract is to provide years of futures price history in one continuous time series. That is accomplished by constructing a time series based on a constant forward time period. For example, the series would determine a value 3 months or 6 months into the future.
The time
Period varies and can be chosen by the user. The perpetual contract is constructed by taking a weighted average of 2 futures contracts that surround the time period desired. The value for the perpetual contract is not an actual price, but a weighted average of 2 other prices. The main advantage of the perpetual contract is that it eliminates the need for using only the nearest expiring contract and smooths out the price series by eliminating the distortions that can take place during the transition between delivery months. For chart analysis purposes, the nearest month continuation charts published by chart services are more than adequate. A continuous price series, however, is more useful for backtesting, trading systems, and indicators. A more complete explanation of ways to construct continuous futures contracts is provided by Greg Morris in Appendix
D.
Long-term trends dispute randomness. The most striking features of long-range charts is that not only are trends very clearly defined, but that long-range trends often last for years. Imagine making a forecast based on one of these long-range trends and not having to change that forecast for several years. The persistence of long-range trends raises another interesting question that should be mentioned: the question of randomness. While technical analysts do not subscribe to the theory that market action is random and unpredictable, it seems safe to observe that whatever randomness does exist in price action is probably a phenomenon of the very short term. The persistence of existing trends over long periods of time, in many cases for years, is a compelling argument against the claims of random walk theorists that prices are serially independent and that past price action has no effect on future price action. Patterns on charts, weekly and monthly reversals. Price patterns appear on the long-range charts, which are interpreted in the same way as on the daily charts. Double tops and bottoms are very prominent on these charts, as are head and shoulder reversals. Triangles, which are usually continuation patterns, are frequently seen. Another pattern that occurs quite frequently on these charts is the weekly and monthly reversal. For example, on the monthly chart, a new monthly high, followed by a close below the previous month's close, often represents a significant turning point, especially if it occurs near a major support or resistance
area.
Weekly reversals are quite frequent on the weekly charts. These patterns are the equivalent of the key reversal day on the daily charts, except that on the long-range charts these reversals carry a great deal more significance. Long-term to short-term charts. It's especially important to appreciate the order in which price charts should be studied in performing a thorough trend analysis. The proper order to follow in chart analysis is to begin with the long range and gradually work to the near term. The reason for this should become apparent as one works with the different time dimensions. If the analyst begins with only the near-term picture, he or she is forced to constantly revise conclusions as more price data is considered.
A.
Thorough analysis of a daily chart may have to be completely redone after looking at the long-range charts by starting with the big picture going back as far as 20 years. All data to be considered are already included in the chart, and a proper perspective is achieved once the analyst knows where the market is from. A longer-range perspective, he or she gradually zeroes in on the shorter term. The first chart to be considered is the 20-year monthly chart. The analyst looks for the more obvious chart patterns, major trend lines, or the proximity of major support or resistance levels. He or she then consults the most recent 5 years on the weekly chart, repeating the same process. Having done that, the analyst narrows his or her focus to the last 6 to 9 months of market action on the daily bar chart, thus going from the macro to the micro approach.
If
the trader wants to proceed further, intraday charts can then be consulted for an even more microscopic study of recent action. Why should long-range charts be adjusted for inflation? A question often raised concerning long-term charts is whether or not historic price levels seen on the charts should be adjusted for inflation. After all, the argument goes, do these long-range peaks and troughs have any validity if not adjusted to reflect the changes in the value of the US dollar? This is a point of some controversy among analysts. I do not believe that any adjustment is necessary on these long-range charts, for a number of reasons. The main reason is my belief that the markets themselves have already made the necessary adjustments. A currency declining in value causes commodities quoted in that currency to increase in value.
the
Declining value of the dollar, therefore, would contribute to rising commodity prices. A rising dollar would cause the price of most commodities to fall. The tremendous price gains in commodity markets during the 1970s and declining prices in the 1980s and 1990s are classic examples of inflation at work. To have suggested during the 1970s that commodity price levels that had doubled and tripled in price should then be adjusted to reflect rising inflation would make no sense at all. The rising commodity markets already were a manifestation of that inflation. Declining commodity markets since the 1980s reflect a long period of disinflation. Should we take the price of gold, which is now worth less than half of its value in 1980, and adjust it to reflect the lower inflation rate? The market has already taken care of that. The final point in this debate goes to the heart of the technical theory, which states that price action discounts everything, even inflation. All financial markets adjust to periods of inflation and deflation and to changes in currency values. The real answer to whether long-range charts should be adjusted for inflation lies in the charts themselves. Many markets fail at historic resistance levels set several years earlier and then bounce off support levels not seen in several years. It's also clear that falling inflation since the early 1980s has helped support bull markets in bonds and stocks. It would seem that those markets have already made their own inflation adjustment. See Figure 8.1. Figure 8.1. The gold price peak in 1980 ushered in 2 decades of low inflation. Low inflation normally causes falling gold prices and rising stock prices, as this chart shows. Why adjust the charts again for inflation? It's already been done. Long-term charts not intended for trading purposes. Long-term charts are not meant for trading purposes. A distinction has to be made between market analysis for forecasting purposes and the timing of market commitments. Long-term charts are useful in the analytical process to help determine the major trend and price objectives. They are not suitable, however, for the timing of entry and exit points and should not be used for that purpose. For that more sensitive task, daily and intraday charts should be utilized. Examples of long-term charts. The following pages contain examples of long-term weekly and monthly charts. Figures 8.2 to 8.12. The drawings on the charts are limited to long-term support and resistance levels, trend lines, percentage retracements, weekly reversals, and an occasional price pattern. Be aware, however, that anything that can be done on a daily chart can also be done on a weekly or monthly. We'll show you later in the book how the application of various technical indicators to these long-term charts is accomplished and how signals on weekly charts become valuable filters for shorter-term timing decisions. Remember also that semi-log chart scaling becomes more valuable when studying long-range price trends. Figure 8.2. This chart of semiconductor stocks shows the valuable perspective of a weekly chart. The late 1997 price fall stopped right at the 62% retracement level and bounced off chart support formed the previous spring. See circle. Figure 8.3. The early 1998 bottom in General Motors began right at the trendline drawn along the 1995 to 1996 lows. That's why it's a good idea to track weekly charts. Figure 8.4. This monthly chart shows the 1997 rally in Burlington Resources, stopping right at the same level that stopped the 1989 and 1993 rallies.
The
1995 bottom was at the same level as the 1991 bottom. Who says charts don't have a memory? Figure 8.5. An investor in Inco Limited during the 1997 rally could have benefited from the knowledge that the 1989, 1991, and 1995 tops occurred right at 38. Figure 8.6. Do long-term charts matter? The 1993 bottom in IBM was at the same level as the bottom formed 20 years earlier in 1974. The break of an 8-year downtrend line C-box in 1995 confirmed the new major uptrend. Figure 8.7. Helmerich and Payne finally broke out above 19 in 1996 after failing in 1987, 1990, and 1993. The late 1996 pullback at 28 occurred near the 1980
peak.
Figure 8.8. This monthly chart of Dow Jones shows a head and shoulders bottom forming for 10 years from 1988 to 1997. The right shoulder also has the shape of a bullish ascending triangle. The breakout over the neckline at 42 completed the bottom. Figure 8.9. A bullish symmetrical triangle was easy to spot on the monthly chart of Southwest Airlines, but you probably wouldn't have spotted it on a daily
chart.
Figure 8.10. The 1994 bottom in the Dow Utilities bounced off a trend line lasting 20 years. There are those who claim that past price action has no bearing on the future. If you still believe that, go back and look at these long-term charts again. Figure 8.11. On this linear scaled chart of the Japanese stock market, the long-term uptrend line, line 1, drawn under the 1982 and 1984 lows was broken in early 1992, see circle, near 22,000. That was 2 years after the actual peak. Figure 8.12. The same Japanese chart from Figure 8.11 using log scaling. Line 1 is the trend line from the previous figure. The steeper line 2 was broken in mid-1990, C-box, at 30,000. Uptrend lines on log charts are broken sooner than linear uptrend lines. 9 moving averages. Introduction. The moving average is one of the most versatile and widely used of all technical indicators because of the way it is constructed and the fact that it can be so easily quantified and tested. It is the basis for many mechanical trend-following systems in use today. Chart analysis is largely subjective and difficult to test. As a result, chart analysis does not lend itself that well to computerization. Moving average rules, by contrast, can easily be programmed into a computer, which then generates specific buy and sell signals. While two technicians may disagree as to whether a given price pattern is a triangle or a wedge, or whether the volume pattern favors the bull or bear side, moving average trend signals are precise and not open to
debate.
Let's begin by defining what a moving average is. As the second word implies, it is an average of a certain body of data. For example, if a 10-day average of closing prices is desired, the prices for the last 10 days are added up, and the total is divided by 10. The term moving is used because only the latest 10 days' prices are used in the calculation. Therefore, the body of data to be averaged, the last 10 closing prices, moves forward with each new trading day. The most common way to calculate the moving average is to work from the total of the last 10 days' closing prices. Each day, the new close is added to the total, and the close 11 days back is subtracted. The new total is then divided by the number of days, 10. See Figure 9.1a. The above example deals with a simple 10-day moving average of closing prices. There are, however, other types of moving averages that are not simple. There are also many questions as to the best way to employ the moving average. For example, how many days should be averaged? Should a short-term or a long-term average be used? Is there a best moving average for all markets or for each individual market? Is the closing price the best price to average?
Would it be
better to use more than one average? Figure 9.1a, a 10-day moving average applied to a daily bar chart of the S&P 500. Prices crossed the average line several times, see arrows, before finally turning higher. Prices stayed above the average during the subsequent rally. Which type of average works better, a simple, linearly weighted, or exponentially smoothed? Are there times when moving averages work better than others? There are many questions to be considered when using moving averages. We'll address many of these questions in this chapter and show examples of some of the more common usages of the moving average. The moving average, a smoothing device with a time lag. The moving average is essentially a trend-following device.
its purpose is to
Identify or signal that a new trend has begun or that an old trend has ended or reversed. Its purpose is to track the progress of the trend.
It might be viewed as a
Curving trend line. It does not, however, predict market action in the same sense that standard chart analysis attempts to do. The moving average is a follower, not a leader. It never anticipates, it only reacts. The moving average follows a market and tells us that a trend has begun, but only after the fact. The moving average is a smoothing device. By averaging the price data, a smoother line is produced, making it much easier to view the underlying trend. By its very nature, however, the moving average line also lags the market action. A shorter moving average, such as a 20-day average, would hug the price action more closely than a 200-day average. The time lag is reduced with the shorter averages, but can never be completely eliminated. Shorter-term averages are more sensitive to the price action, whereas longer-range averages are less sensitive. In certain types of markets, it is more advantageous to use a shorter average, and at other times a longer and less sensitive average proves more useful. See Figure 9.1b. Which prices to average? We have been using the closing price in all of our examples so far. However, while the closing price is considered to be the most important price of the trading day and the price most commonly used in moving average construction, the reader should be aware that some technicians prefer to use other prices. Some prefer to use a midpoint value, which is arrived at by dividing the day's range by
2.
Figure 9.1b, a comparison of a 20-day and a 200-day moving average. During the sideways period from August to January, prices crossed the shorter average several times. However, they remained above the 200-day average throughout the entire period. Others include the closing price in their calculation by adding the high, low, and closing prices together and dividing the sum by 3. Still others prefer to construct price bands by averaging the high and low prices separately. The result is two separate moving average lines that act as a sort of volatility buffer or neutral zone. Despite these variations, the closing price is still the price most commonly used for moving average analysis and is the price that we'll be focusing most of our attention on in this chapter. The simple moving average. The simple moving average, or the arithmetic mean, is the type used by most technical analysts, but there are some who question its usefulness on 2 points. The first criticism is that only the period covered by the average, the last 10 days, for example, is taken into account. The second criticism is that the simple moving average gives equal weight to each day's price. In a 10-day average, the last day receives the same weight as the first day in the calculation. Each day's price is assigned a 10% weighting. In a 5-day average, each day would have an equal 20% weighting. Some analysts believe that a heavier weighting should be given to the more recent price action, the linearly weighted moving average. In an attempt to correct the weighting problem, some analysts employ a linearly weighted moving average. In this calculation, the closing price of the 10th day, in the case of a 10-day average, would be multiplied by 10, the 9th day by 9, the 8th day by 8, and so on. The greater weight is therefore given to the more recent closings. The total is then divided by the sum of the multipliers. 55 in the case of the 10-day average, 10 plus 9 plus 8 plus 1. However, the linearly weighted average still does not address the problem of including only the price action covered by the length of the average itself. The exponentially smoothed moving average. This type of average addresses both of the problems associated with the simple moving average. First, the exponentially smoothed average assigns a greater weight to the more recent data. Therefore, it is a weighted moving average.
But
while it assigns lesser importance to past price data, it does include in its calculation all of the data in the life of the instrument. In addition, the user is able to adjust the weighting to give greater or lesser weight to the most recent day's price. This is done by assigning a percentage value to the last day's price, which is added to a percentage of the previous day's value. The sum of both percentage values adds up to 100. For example, the last day's price could be assigned a value of 10%, 0.10, which is added to the previous day's value of 90%, 0.90. That gives the last day 10% of the total weighting. That would be the equivalent of a 20-day average. By giving the last day's price a smaller value of 5%, 0.05, lesser weight is given to the last day's data and the average is less sensitive. That would be the equivalent of a 40-day moving average. See Figure 9.2. Figure 9.2. The 40-day exponential moving average dotted line is more sensitive than the simple arithmetic 40-day moving average solid line. The computer makes this all very easy for you. You just have to choose the number of days you want in the moving average, 10, 20, 40, etc. Then select the type of average you want, simple, weighted, or exponentially smooth. You can also select as many averages as you want, 1, 2, or 3. The use of one moving average. The simple moving average is the one most commonly used by technicians and is the one that we'll be concentrating on. Some traders use just one moving average to generate trend signals. The moving average is plotted on the bar chart in its appropriate trading day along with that day's price action. When the closing price moves above the moving average, a buy signal is generated. A sell signal is given when prices move below the moving average. For added confirmation, some technicians also like to see the moving average line itself turn in the direction of the price crossing. See Figure 9.3. If a very short-term average is employed, a 5 or 10-day, the average tracks prices very closely and several crossings occur. This action can be either good or bad. The use of a very sensitive average produces more trades with higher commission costs and results in many false signals, whipsaws. If the average is too sensitive, some of the short-term random price movement or noise activates bad trend signals. Figure 9.3. Prices fell below the 50-day average during October. See left circle. The sell signal is stronger when the moving average also turns down. See left arrow. The buy signal during January was confirmed when the average itself turned higher. While the shorter average generates more false signals, it has the advantage of giving trend signals earlier in the move. It stands to reason that the more sensitive the average, the earlier the signals will be. So there is a trade-off at work here. The trick is to find the average that is sensitive enough to generate early signals, but insensitive enough to avoid most of the random noise. See Figure 9.4. Figure 9.4. A shorter average gives earlier signals. The longer average is slower, but more reliable. The 10-day turned up first at the bottom,
but it also gave a
premature buy signal during November and an untimely sell signal during February. See boxes. Let's carry the above comparison a step further. While the longer average performs better while the trend remains in motion, it gives back a lot more when the trend reverses. The very insensitivity of the longer average, the fact that it trailed the trend from a greater distance, which kept it from getting tangled up in short-term corrections during the trend, works against the trader when the trend actually reverses. Therefore, we'll add another corollary here. The longer averages work better as long as the trend remains in force, but a shorter average is better when the trend is in the process of reversing. It becomes clearer, therefore, that the use of one moving average alone has several disadvantages. It is usually more advantageous to employ two moving averages. How to use two averages to generate signals. This technique is called the double crossover method. This means that a buy signal is produced when the shorter average crosses above the longer. For example, two popular combinations are the 5 and 20-day averages and the 10 and 50-day averages. In the former, a buy signal occurs when the 5-day average crosses above the 20 and a sell signal when the 5-day moves below the 20. In the latter example, the 10-day crossing above the 50 signals an uptrend and a downtrend takes place with a 10 slipping under the 50. This technique of using two averages together lags the market a bit more than the use of a single average, but produces fewer whipsaws. See figures 9.5 and 9.6. Figure 9.5. The double crossover method uses two moving averages. The 5 and 20-day combination is popular with futures traders. The 5-day fell below the 20-day during October, see circle, and caught the entire downtrend in crude oil prices. The use of three averages, or the triple crossover method. That brings us to the triple crossover method. The most widely used triple crossover system is the popular 4-9-18-day moving average combination. The 4-9-18 method is used mainly in futures trading. This concept was first mentioned by R.C. Allen in his 1972 book, How to Build a Fortune in Commodities, and again later in a 1974 work by the same author, How to Use the 4-day, 9-day, and 18-day moving averages to earn larger profits from commodities. The 4-9-18-day system is a variation on the 5, 10, and 20-day moving average numbers, which are widely used in commodity circles. Many commercial chart services publish the 4-9-18-day moving averages. Many charting software packages use the 4-9-18-day combination as their default values when plotting three averages. Figure 9.6. Stock traders use 10 and 50-day moving averages. The 10-day fell below the 50-day in October, left circle, giving a timely sell signal. The bullish crossover in the other direction took place during January, lower circle. How to use the 4-9-18-day moving average system. It's already been explained that the shorter the moving average, the closer it follows the price trend. It stands to reason, then, that the shortest of the three averages, the 4-day, will follow the trend most closely, followed by the 9-day, and then the 18. In an uptrend, therefore, the proper alignment would be for the 4-day average to be above the 9-day, which is above the 18-day average.
In a
downtrend, the order is reversed and the alignment is exactly the opposite.
That
is, the 4-day would be the lowest, followed by the 9-day, and then the 18-day average. See figures 9.7a-b. A buying alert takes place in a downtrend when the 4-day crosses above both the 9 and the 18. A confirmed buy signal occurs when the 9-day then crosses above the 18. This places the 4-day over the 9-day, which is over the 18-day. Some intermingling may occur during corrections or consolidations, but the general uptrend remains intact. Some traders may take profits during the intermingling process, and some may use it as a buying opportunity. There is Obviously, a lot of room for flexibility here in applying the rules, depending on how aggressively one wants to trade. Figure 9.7 of futures traders like the 9 and 18-day moving average combination. A sell signal was given in late October, first circle, when the 9-day fell below the 18. A buy signal was given in early 1998 when the 9-day crossed back above the 18-day. When the uptrend reverses to the downside, the first thing that should take place is that the shortest and most sensitive average, the 4-day, dips below the 9-day and the 18-day. This is only a selling alert. Some traders, however, might use that initial crossing as reason enough to begin liquidating long positions. Then, if the next longer average, the 9-day, drops below the 18-day, a confirmed sell short signal is given. Figure 9.7b, the April 9th 18-day moving average combo, is also popular with futures traders. At a bottom, the 4-day solid line turns up first and crosses the other two lines. Then the 9-day crosses over the 18-day, see circle, signaling a bottom. Moving average envelopes. The usefulness of a single moving average can be enhanced by surrounding it with envelopes. Percentage envelopes can be used to help determine when a market has gotten overextended in either direction. In other words, they tell us when prices have strayed too far from their moving average line. In order to do this, the envelopes are placed at fixed percentages above and below the average. Shorter-term traders, for example, often use 3% envelopes around a simple 21-day moving average. When prices reach one of the envelopes 3% from the average, the short-term trend is considered to be overextended. For long-range analysis, some possible combinations include 5% envelopes around a 10-week average or a 10% envelope around a 40-week average. See figures 9.8a-b. Figure 9.8, a 3% envelopes placed around a 21-day moving average of the Dow. Moves outside the envelopes suggest an overextended stock market. Figure 9.8b, for longer range analysis, 5% envelopes can be placed around a 10-week average. Moves outside the envelopes helped identify market extremes. Bollinger Bands. This technique was developed by John Bollinger. Two trading bands are placed around a moving average similar to the envelope technique, except that Bollinger Bands are placed 2 standard deviations above and below the moving average, which is usually 20 days. Standard deviation is a statistical concept that describes how prices are dispersed around an average value. Using 2 standard deviations ensures that 95% of the price data will fall between the 2 trading
bands.
As a rule, prices are considered to be overextended on the upside, overbought when they touch the upper band. They are considered overextended on the downside, oversold when they touch the lower band.
C.
Figures 9.9a-b. Figure 9.9, a Bollinger Bands plotted around a 20-day moving average. During the sideways period from August to January, prices kept touching the outer
bands.
Once the uptrend resumed, prices traded between the upper band and 20-day average. Figure 9.9b, Bollinger Bands work on weekly charts as well by using a 20-week average as the middle line. Each touch of the lower band, see circles, signaled an important market bottom and a buying opportunity. Using Bollinger Bands as targets. The simplest way to use Bollinger Bands is to use the upper and lower bands as price targets. In other words, if prices bounce off the lower band and cross above the 20-day average, the upper band becomes the upper price target. A crossing below the 20-day average would identify the lower band as the downside target. In a strong uptrend, prices will usually fluctuate between the upper band and the 20-day average. In that case, a crossing below the 20-day average warns of a trend reversal to the downside. Bandwidth measures volatility. Bollinger Bands differ from envelopes in one major way. Whereas the envelopes stay a constant percentage width apart, Bollinger Bands expand and contract based on the last 20 days' volatility. During a period of rising price volatility, the distance between the 2 bands will widen. Conversely, during a period of low market volatility, the distance between the two bands will contract. There is a tendency for the bands to alternate between expansion and contraction.
When the
Bands are unusually far apart. That is often a sign that the current trend may be
ending.
when the distance between the two bands has narrowed too far. That is often a sign that a market may be about to initiate a new trend. Bollinger Bands can also be applied to weekly and monthly price charts by using 20 weeks and 20 months instead of 20 days. Bollinger Bands work best when combined with overbought/oversold oscillators that are explained in the next chapter.
C.
Appendix A for additional band techniques. Centering the average. The more statistically correct way to plot a moving average is to center it.
That
Means to place it in the middle of the time period it covers. A 10-day average, for example, would be placed 5 days back. A 20-day average would be plotted 10 days back in time. Centering the average, however, has the major flaw of producing much later trend change signals. Therefore, moving averages are usually placed at the end of the time period covered instead of the middle. The centering technique is used almost exclusively by cyclic analysts to isolate underlying market cycles. Moving averages tied to cycles. Many market analysts believe that time cycles play an important role in market movement. Because these time cycles are repetitive and can be measured, it is possible to determine the approximate times when market tops or bottoms will occur. Many different time cycles exist simultaneously, from a short-term 5-day cycle to Kondratieff's long 54-year cycle. We'll delve more into this fascinating branch of technical analysis in Chapter 14. The subject of cycles is introduced here only to make the point that there seems to be a relationship between the underlying cycles that affect a certain market and the correct moving averages to use. In other words, the moving averages can be adjusted to fit the dominant cycles in each market. There appears to be a definite relationship between moving averages and cycles. For example, the monthly cycle is one of the best-known cycles operating throughout the commodity markets. A month has 20 to 21 trading days. Cycles tend to be related to their next longer and shorter cycles harmonically, or by a factor of 2. That means that the next longer cycle is double the length of a cycle and the next shorter cycle is half its length. The monthly cycle, therefore, may explain the popularity of the 5, 10, 20, and 40-day moving averages. The 20-day cycle measures the monthly cycle. The 40-day average is double the 20-day. The 10-day average is half of 20, and the 5-day average is half again of 10. Many of the more commonly used moving averages, including the 4, 9, and 18-day averages, which are derivatives of 5, 10, and 20, can be explained by cyclic influences and the harmonic relationships of neighboring cycles. Incidentally, the 4-week cycle may also help explain the success of the 4-week rule, covered later in the chapter, and its shorter counterpart, the 2-week rule. Fibonacci numbers used as moving averages. We'll cover the Fibonacci number series in the chapter on Elliott wave theory. However, I'd like to mention here that this mysterious series of numbers, such as 13, 21, 34, 55, and so on, seem to lend themselves quite well to moving average analysis. This is true not only of daily charts, but for weekly charts as
well.
The 21-day moving average is a Fibonacci number. On the weekly charts, the 13-week average has proven valuable in both stocks and commodities.
We'll
postpone a more in-depth discussion of these numbers until Chapter 13. Moving averages applied to long-term
charts.
The reader should not overlook using this technique in longer-range trend analysis. Longer-range moving averages, such as 10 or 13 weeks, in conjunction with the 30 or 40-week average, have long been used in stock market analysis, but haven't been given as much attention in the futures markets. The 10 and 40-week moving averages can be used to help track the primary trend on weekly charts for futures and stocks. See Figure 9.10. Figure 9.10 moving averages are valuable on weekly charts. The 40-week Moving average should provide support during bull market corrections as it did. Here, some pros and cons of the moving average. One of the great advantages of using moving averages, and one of the reasons they are so popular as trend-following systems, is that they embody some of the oldest maxims of successful trading. They trade in the direction of the trend. They let profits run and cut losses short. The moving average system forces the user to obey those rules by providing specific buy and sell signals based on those principles. Because they are trend-following in nature, however, moving averages work best when markets are in a trending period. They perform very poorly when markets get choppy and trade sideways for a period of time. And that might be a third to a half of the time. The fact that they do not work that well for significant periods of time, however, is one very compelling reason why it is dangerous to rely too heavily on the moving average technique. In certain trending markets, the moving average can't be beat. Just switch the program to automatic. At other times, a non-trending method like the overbought, oversold oscillator is more appropriate. In Chapter 15, we'll show you an indicator called ADX that tells you when a market is trending and when it is not, and whether the market climate favors a trending moving average technique or a non-trending oscillator approach. Moving averages as oscillators. One way to construct an oscillator is to compare the difference between two moving averages. The use of two moving averages in the double crossover method, therefore, takes on greater significance and becomes an even more useful technique. We'll see how this is done in Chapter 10. One method compares two exponentially smoothed averages. That method is called moving average convergence/divergence (MACD). It is used partially as an oscillator. Therefore, we'll postpone our explanation of that technique until we deal with the entire subject of oscillators in Chapter 10. The moving average applied to other technical data. The moving average can be applied to virtually any technical data or indicator. It can be used on open interest and volume figures, including on balance volume. The moving average can be used on various indicators and ratios. It can be applied to oscillators as well. The weekly rule. There are other alternatives to the moving average as a trend-following device. One of the best known and most successful of these techniques is called the weekly price channel, or simply the weekly rule. This technique has many of the benefits of the moving average, but is less time-consuming and simpler to use. With the improvements in computer technology over the past decade, a considerable amount of research has been done on the development of technical trading systems. These systems are mechanical in nature, meaning that human emotion and judgment are eliminated. These systems have become increasingly sophisticated. At first, simple moving averages were utilized. Then double and triple crossovers of the averages were added. The averages were then linearly weighted and exponentially smoothed. These systems are primarily trend-following, which means their purpose is to identify and then trade in the direction of an existing trend. With the increased fascination with fancier and more complex systems and indicators, however, there's been a tendency to overlook some of the simpler techniques that continue to work quite well and have stood the test of time. We're going to discuss one of the simplest of these techniques, the weekly rule. In 1970, a booklet entitled The Trader's Notebook was published by Dunn and Hargit's Financial Services in Lafayette, Indiana. The best-known commodity trading systems of the day were computer-tested and compared. The final conclusion of all that research was that the most successful of all the systems tested was the 4-week rule, developed by Richard Donkian. Mr. Donkian has been recognized as a pioneer in the field of commodity trend trading using mechanical systems. In 1983, Managed Account Reports chose Donkian as the first recipient of the Most Valuable Performer Award for outstanding contributions to the field of futures money management and presents the Donkian Award to other worthy recipients. More recent work done by Louis Lecoq, former research director at Dunn and Hargit and currently president of Wizard Trading, a Massachusetts CTA, supports the earlier conclusions that breakout or channel systems similar to the Weekly rule continued to show superior results.
Lucas et al.
Asterisk. Of the 12 systems tested from 1975 to 84, only 4 generated significant profits. Of those 4, 2 were channel breakout systems, and 1 was a dual moving average, a crossover system. A later article by Lecoq and Borson in the Financial Review, November 1990, published the results of a more extensive study done on data from 1976 to 86 that compared 23 technical trading systems. Once again, channel breakouts and moving average systems came out on top. Lecoq finally concluded that a channel breakout system was his personal choice as the best starting point for all technical trading system testing and development. The 4-week rule. The 4-week rule is used primarily for futures trading. The system based on the 4-week rule is simplicity itself. 1. Cover short positions and buy long whenever the price exceeds the highs of the 4 preceding full calendar weeks. 2. Liquidate long positions and sell short whenever the price falls below the lows of the 4 preceding full calendar weeks. The system, as it is presented here, is continuous in nature, which means that the trader always has a position, either long or short. As a general rule, continuous systems have a basic weakness. They stay in the market and get whipsawed during trendless market periods. It's already been stressed that trend-following systems do not work well when markets are in these sideways or trendless phases. The 4-week rule can be modified to make it non-continuous. This can be accomplished by using a shorter time span, such as a 1 or 2-week rule for liquidation purposes. In other words, a 4-week breakout would be necessary to initiate a new position, but a 1 or 2-week signal in the opposite direction would warrant liquidation of the position. The trader would then remain out of the market until a new 4-week breakout is registered. The logic behind the system is based on sound technical principles. Its signals are mechanical and clear-cut. Because it is trend following, it virtually guarantees participation on the right side of every important trend. It is also structured to follow the often quoted maxim of successful trading: let profits run while cutting losses short. Another feature, which should not be overlooked, is that this method tends to trade less frequently so that commissions are lower. Another plus is that the system can be implemented with or without the aid of a computer. The main criticism of the weekly rule is the same one leveled against all trend-following approaches, namely, that it does not catch tops or bottoms.
But
what trend-following system does? The important point to keep in mind is that the 4-week rule performs at least as well as most other trend-following systems and better than many, but has the added benefit of incredible simplicity. Adjustments to the 4-week rule. Although we're treating the 4-week rule in its original form, there are many adjustments and refinements that can be employed. For one thing, the rule does not have to be used as a trading system. Weekly signals can be employed simply as another technical indicator to identify breakouts and trend reversals. Weekly breakouts can be used as a confirming filter for other techniques, such as moving average crossovers. 1 or 2-week rules function as excellent filters. A moving average crossover signal could be confirmed by a 2-week breakout in the same direction in order for a market position to be taken. Shorten or lengthen time periods for sensitivity. The time period employed can be expanded or compressed in the interests of risk management and sensitivity. For example, the time period could be shortened if it is desirable to make the system more sensitive. In a relatively high-priced market, where prices are trending sharply higher, a shorter time span could be chosen to make the system more sensitive. Suppose, for example, that a long position is taken on a 4-week upside breakout with a protective stop placed just below the low of the past 2 weeks. If the market has rallied sharply and the trader wishes to trail the position with a closer protective stop, a 1-week
stop-out point could be used.
In a trading range situation, where a trend trader would just as soon stay on the sidelines until an important trend signal is given, the time period could be expanded to 8 weeks. This would prevent taking positions on shorter term and premature trend signals. The 4-week rule tied to cycles. Earlier in the chapter, reference was made to the importance of the monthly cycle. In commodity markets, the 4-week or 20-day trading cycle is a dominant cycle that influences all markets. This may help explain why the 4-week time period has proven so successful. Notice that mention was made of 1, 2, and 8-week rules. The principle of harmonics in cyclic analysis holds that each cycle is related to its neighboring cycles, next longer and next shorter cycles, by 2. In the previous discussion of moving averages, it was pointed out how the monthly cycle and harmonics explain the popularity of the 5, 10, 20, and 40-day moving averages. The same time periods hold true in the realm of weekly rules. Those daily numbers translated into weekly time periods are 1, 2, 4, and 8 weeks. Therefore, adjustments to the 4-week rule seem to work best when the beginning number, 4, is divided or multiplied by 2.
To shorten the time span, go
from 4 to 2 weeks. If an even shorter time span is desired, go from 2 to 1.
2.
Lengthen, go from 4 to 8. Because this method combines price and time, there's no reason why the cyclic principle of harmonics should not play an important
role.
The tactic of dividing a weekly parameter by 2 to shorten it, or doubling it to lengthen it, does have cycle logic behind it. The 4-week rule is a simple breakout system. The original system can be modified by using a shorter time period, a 1 or 2-week rule for liquidation purposes. If the user desires a more sensitive system, a 2-week period can be employed for entry signals. Because this rule is meant to be simple, it is best addressed on that level. The 4-week rule is simple, but it works. Charting packages allow you to plot price channels above and below current prices too. Spot channel breakouts. Price channels can be used on daily, weekly, or monthly charts. See figures 9.11 and 9.12. Figure 9.11, a 20-day for week price channel applied to Treasury bond futures prices. A buy signal was given when prices closed above the upper channel. See circle. Prices have to close beneath the lower channel to reverse the signal. Figure 9.12, a 4-month price channel applied to the S&P 500 index prices crossed the upper channel in early 1995. See circle. To give a buy signal which remains in effect 3 years later. A close beneath the lower line is needed to give a sell signal. To optimize or not. The first edition of this book included the results of extensive research produced by Merrill Lynch, which published a series of studies on computerized trading techniques applied to the futures markets from 1978 to 82. Extensive testing of various moving average and channel breakout parameters was performed to find the best possible combinations in each futures market.
The Merrill Lynch
researchers produced a different set of optimized indicator values for each market. Most charting packages allow you to optimize systems and indicators. Instead of using the same moving average in all markets, for example, you could ask the computer to find the moving average or moving average combinations that have worked the best in the past for that market. That could also be done for daily and weekly breakout systems and virtually all technical indicators included. In this book, optimization allows technical parameters to adapt to changing market conditions. Some argue that optimization helps their trading results and others that it doesn't. The heart of the debate centers on how the data is optimized. Researchers stress that the correct procedure is to use only part of the price data to choose the best parameters and another portion to actually test the results. Testing the optimized parameters on out-of-sample price data helps ensure that the final results will be closer to what one might experience from actual trading. The decision to optimize or not is a personal one. Most evidence, however, suggests that optimization is not the holy grail some think it to be. I generally advise traders following only a handful of markets to experiment with optimization. Why should Treasury bonds or the German mark have the exact same moving averages as corn or cotton? Stock market traders are a different
story.
Having to follow thousands of stocks argues against optimizing. If you specialize in a handful of markets, try optimizing. If you're a generalist who follows a large number of markets, use the same technical parameters for all of them.
Summary.
We've presented a lot of variations on the moving average approach. Let's try to simplify things a bit. Most technicians use a combination of two moving averages. Those two averages are usually simple averages. Although exponential averages have become popular, there's no real evidence to prove that they work any better than the simple average. The most commonly used daily moving average combinations in futures markets are 4 and 9, 9 and 18, 5 and 20, and 10 and 40. Stock traders rely heavily on a 50-day or 10-week moving average. 4. Longer-range stock market analysis. Popular weekly moving averages are 30 and 40 weeks or 200 days. Bollinger Bands make use of 20-day and 20-week moving averages. The 20-week average can be converted to daily charts by utilizing a 100-day average, which is another useful moving average.
Channel.
Breakout systems work extremely well in trending markets and can be used on daily, weekly, and monthly charts. The adaptive moving average. One of the problems encountered with the moving average is choosing between a fast or a slow average. While one may work better in a trading range market, the other may be preferable in a trending market. The answer to the problem of choosing between the two may lie with an innovative approach called the adaptive moving average. Perry Kaufman presents this technique in his book Smarter Trading.
The
speed of Kaufman's adaptive moving average automatically adjusts to the level of noise or volatility in a market. The AMA moves more slowly when markets are trending sideways, but then moves more swiftly when the market is trending. That avoids the problem of using a faster moving average and getting whipsawed more frequently during a trading range, and using a slower average that trails too far behind a market when it is trending. Kaufman does that by constructing an efficiency ratio that compares price direction with the level of volatility. When the efficiency ratio is high, there is more direction than volatility, favoring a faster average. When the ratio is low, there's more volatility than direction, favoring a slower average.
By
incorporating the efficiency ratio, the AMA automatically adjusts to the speed most suitable for the current market. Alternatives to the moving average. Moving averages don't work all of the time. They do their best work when the market is in a trending phase. They're not very helpful during trendless periods, when prices trade sideways. Fortunately, there's another class of indicator that performs much better than the moving average during those frustrating trading ranges. They're called oscillators, and we'll explain them in the next chapter. See bibliography. 10 oscillators and contrary opinion. Introduction. In this chapter, we're going to talk about an alternative to trend following approaches, the oscillator. The oscillator is extremely useful in non-trending markets where prices fluctuate in a horizontal price band or trading range, creating a market situation where most trend-following systems simply don't work that well. The oscillator provides the technical trader with a tool that can enable him or her to profit from these periodic sideways and trendless market environments. The value of the oscillator is not limited to horizontal trading ranges. However, used in conjunction with price charts during trending phases, the oscillator becomes an extremely valuable ally by alerting the trader to short-term market extremes, commonly referred to as overbought or oversold conditions. The oscillator can also warn that a trend is losing momentum before that situation becomes evident in the price action itself. Oscillators can signal that a trend may be nearing completion by displaying certain divergences. We'll begin by explaining first what an oscillator is and the basis for its construction and interpretation. We'll then discuss the meaning of momentum and its implications for market forecasting. Some of the more common oscillator techniques will be presented from the very simple to the more complicated. The important question of divergence will be covered. We'll touch on the value of coordinating oscillator analysis with underlying market cycles. Finally, we'll discuss how oscillators should be used as part of the overall technical analysis of a market. Oscillator usage in conjunction with
Trend.
the oscillator is only a secondary indicator in the sense that it must be subordinated to basic trend analysis. As we go through the various types of oscillators used by technicians, the importance of trading in the direction of the overriding market trend will be constantly stressed. The reader should also be aware that there are times when oscillators are more useful than at others.
4.
Example, near the beginning of important moves, oscillator analysis isn't that helpful and can even be misleading. Toward the end of market moves, however, oscillators become extremely valuable. We'll address these points as we go along. Finally, no study of market extremes would be complete without a discussion of contrary opinion. We'll talk about the role of the contrarian philosophy and how it can be incorporated into market analysis and trading. Interpretation of oscillators. While there are many different ways to construct momentum oscillators, the actual interpretation differs very little from one technique to another. Most oscillators look very much alike. They are plotted along the bottom of the price chart and resemble a flat horizontal band. The oscillator band is basically flat, while prices may be trading up, down, or sideways. However, the peaks and troughs in the oscillator coincide with the peaks and troughs on the price chart. Some oscillators have a midpoint value that divides the horizontal range into two halves, an upper and a lower. Depending on the formula used, this midpoint line is usually a zero line. Some oscillators also have upper and lower boundaries, ranging from 0 to 100. General rules for interpretation. As a general rule, when the oscillator reaches an extreme value in either the upper or lower end of the band, this suggests that the current price move may have gone too far too fast and is due for a correction or consolidation of some
Type.
As another general rule, the trader should be buying when the oscillator line is in the lower end of the band and selling in the upper end. The crossing of the midpoint line is often used to generate buy and sell signals. We'll see how these general rules are applied as we deal with the various types of oscillators. The three most important uses for the oscillator. There are three situations when the oscillator is most useful. You'll see that these three situations are common to most types of oscillators that are used. 1. The oscillator is most useful when its value reaches an extreme reading near the upper or lower end of its boundaries. The market is said to be overbought when it is near the upper extreme and oversold when it is near the lower extreme. This warns that the price trend is overextended and vulnerable. 2. A divergence between the oscillator and the price action when the oscillator is in an extreme position is usually an important warning. 3. The crossing of the zero or midpoint line can give important trading signals in the direction of the price trend. Figure 10.1 of the 10-day momentum line fluctuates around a zero line. Readings too far above the zero line are overbought, while values too far below the line are oversold. Momentum should be used in conjunction with the trend of the market. Measuring momentum. The concept of momentum is the most basic application of oscillator analysis. Momentum measures the velocity of price changes as opposed to the actual price levels themselves. Market momentum is measured by continually taking price differences for a fixed time interval. To construct a 10-day momentum line, simply subtract the closing price 10 days ago from the last closing price. This positive or negative value is then plotted around a zero line. The formula for momentum is
M rovnítko v X,
where V is the latest closing price and Vx is the closing price X days ago. Figure 10.1b a comparison of 10 and 40-day momentum lines. The longer version is more helpful in catching major market turns, see circles. If the latest closing price is greater than that of 10 days ago, in other words, prices have moved higher, then a positive value would be plotted above the zero
line.
If the latest close is below the close 10 days earlier, prices have declined. Then a negative value is plotted below the zero line. While the 10-day momentum is a commonly used time period for reasons discussed later, any time period can be employed. See Figure 10.1a. A shorter time period, such as 5 days, produces a more sensitive line with more pronounced oscillations. A longer number of days, such as 40 days, results in a much smoother line in which the oscillator swings are less volatile. See Figure 10.1b. Momentum measures rates of ascent or descent. Let's talk a bit more about just what this momentum indicator is measuring.
By
Plotting price differences for a set period of time, the chartist is studying rates of ascent or descent. If prices are rising and the momentum line is above the zero line and rising, this means the uptrend is accelerating. If the upslanting momentum line begins to flatten out, this means that the new gains being achieved by the latest closes are the same as the gains 10 days earlier.
while
Prices may still be advancing, the rate of ascent, or the velocity, has leveled off. When the momentum line begins to drop toward the zero line, the uptrend in prices is still in force, but at a decelerating rate. The uptrend is losing momentum. When the momentum line moves below the zero line, the latest 10-day close is now under the close of 10 days ago, and a near-term downtrend is in effect. And incidentally, the 10-day moving average also has begun to decline.
as
Momentum continues to drop farther below the zero line, the downtrend gains momentum. Only when the line begins to advance again does the analyst know that the downtrend is decelerating. It's important to remember that momentum measures the differences between prices at 2 time intervals. In order for the line to advance, the price gains for the last day's close must be greater than the gains of 10 days ago.
if
Prices advance by only the same amount as 10 days ago, the momentum line will be flat. If the last price gain is less than that of 10 days ago, the momentum line begins to decline even though prices are still rising. This is how the momentum line measures the acceleration or deceleration in the current advance or decline. In the price trend, the momentum line leads the price action. Because of the way it is constructed, the momentum line is always a step ahead of the price movement. It leads the advance or decline in prices, then levels off. While the current price trend is still in effect, it then begins to move in the opposite direction as prices begin to level off. The crossing of the zero line as a trading signal. The momentum chart has a zero line. Many technicians use the crossing of the zero line to generate buy and sell signals. A crossing above the zero line would be a buy signal, and a crossing below the zero line a sell signal. It should be stressed here again, however, that basic trend analysis is still the overriding consideration. Oscillator analysis should not be used as an excuse to trade against the prevailing market trend. Buy positions should only be taken on crossings above the zero line if the market trend is up. Short positions should be taken on crossings below the zero line only if the price trend is down.
C.
Figures 10.2a and b. Figure 10.2 the trend lines on the momentum chart are broken sooner than those on the price chart. The value of the momentum indicator is that it turns sooner than the market itself, making it a leading indicator. Figure 10.2b. Some traders regard a crossing above the zero line as a buy signal, and a crossing below the line as a sell signal. See circles. A moving average is helpful to confirm trend changes. The momentum line peaked before the price. See arrows. The need for an upper and lower boundary. One problem with the momentum line, as it is described here, is the absence of a fixed upper and lower boundary. It was stated earlier that one of the major values of oscillator analysis is being able to determine when markets are in extreme areas. But how high is too high and how low is too low on the momentum line? The simplest way to solve this problem is by visual inspection. Check the back history of the momentum line on the chart and draw horizontal lines along its upper and lower boundaries. These lines will have to be adjusted periodically, especially after important trend changes have occurred. But it is the simplest and probably the most effective way of identifying the outer extremities.
C.
Figures 10.3 and 10.4. Figure 10.3 by visual inspection, the analyst can find the upper and lower momentum boundaries that are suitable for each market. See horizontal lines. Figure 10.4, a 13-week momentum line on a weekly chart of Treasury bonds.
The
Arrows mark the turning points from momentum extremes. The momentum line. Change direction before the price at each major turn, points 1, 2, and 3. Measuring rate of change, ROC. To measure the rate of change, a ratio is constructed of the most recent closing price to a price a certain number of days in the past. To construct a 10-day rate of change oscillator, the latest closing price is divided by the close 10 days ago.
The
Formula is as follows. Rate of change equals 100 V/Vx, where V is the latest close and Vx is the closing price X days ago. In this case, the 100 line becomes the midpoint line. If the latest price is higher than the price 10 days ago, prices are rising, the resulting rate of change value will be above 100. If the last close is below 10 days ago, the ratio would be below 100. Charting software sometimes uses variations of the preceding formulas for momentum and rate of change. While the construction techniques may vary, the interpretation remains the same. Constructing an oscillator using two moving averages. Chapter 9 discussed two moving averages being used to generate buy and sell signals. The crossing of the shorter average above or below the longer average registered buy and sell signals, respectively. It was mentioned at that time that these dual moving average combinations could also be used to construct
oscillator charts.
This can be done by plotting the difference between the two averages as a histogram. These histogram bars appear as a plus or minus value around a centered zero line. This type of oscillator has three uses. 1. To help spot divergences. 2. To help identify short-term variations from the long-term trend when the shorter average moves too far above or below the longer average. 3. To pinpoint the crossings of the two moving averages, which occur when the oscillator crosses the zero line. The shorter average is divided by the longer. In both cases, however, the shorter average oscillates around the longer average, which is in effect the zero
line.
If the shorter average is above the longer, the oscillator would be positive. A negative reading would be present if the shorter average were under the longer. See figures 10.5 to 10.7. When the two moving average lines move too far apart, a market extreme is created, calling for a pause in the trend. See figure 10.6. Very often the trend remains stalled until the shorter average line moves back to the longer. When the shorter line approaches the longer, a critical point is reached. In an uptrend, for example, the shorter line dips back to the longer average but should bounce off
it.
This usually represents an ideal buying area. It's much like the testing of an up trend line. If the shorter average crosses below the longer average, however, a
Trend reversal is signaled.
Figure 10.5. The histogram lines measure the difference between the two moving averages. Crossing above and below the zero line give buy and sell signals. See arrows. Notice that the histogram turns well before the actual signals. See circles. Figure 10.6. A histogram measuring the difference between the 10 and 50-day averages. The histogram always turns well before the zero line crossover.
In an
uptrend, the histogram will find support at the zero line and turn up again. Third arrow. In a downtrend, a rise in the shorter average to the longer usually represents an ideal selling area unless the longer line is crossed, in which case a trend reversal signal would be registered. The relationships between the two averages can be used, therefore, not only as an excellent trend-following system but also to help identify short-term overbought and oversold conditions. Figure 10.7. A histogram plotting the difference between two weekly averages.
The
histogram turned in the direction of the new price trend weeks before the actual zero line crossings on the histogram. Notice how easily the overbought and
Oversold levels are seen.
Commodity Channel Index. It is possible to normalize an oscillator by dividing the values by a constant, divisor. In the construction of his Commodity Channel Index, CCI, Donald R. Lambert compares the current price with a moving average over a selected time span, usually 20 days. He then normalizes the oscillator values by using a divisor based on mean deviation. As a result, the CCI fluctuates in a constant range from plus 100 on the upside to minus 100 on the downside. Lambert recommended long positions in those markets with values over plus 100. Markets with CCI values below minus 100 were candidates for short sales. It seems, however, that most chartists use CCI simply as an overbought/oversold oscillator. Used in that fashion, readings over plus 100 are considered overbought and under minus 100 are oversold. While the Commodity Channel Index was originally developed for commodities, it is also used for trading stock index futures and options like the S&P 100 OEX.
Although 20
days is the common default value for CCI, the user can vary the number to adjust its sensitivity. See figures 10.8 and 10.9. Figure 10.8, a 20-day commodity channel index. The original intent of this indicator was to buy moves above plus 100 and sell moves below minus 100 as shown here. Figure 10.9, the commodity channel index can be used for stock indexes like this one, and can also be used like any other oscillator to measure market extremes. Notice that the CCI turns before prices at each top and bottom.
The
default length is 20 days. The Relative Strength Index, RSI. The RSI was developed by J. Wells Wilder, Jr. and presented in his 1978 book, New Concepts in Technical Trading Systems. We're only going to cover the main points here. A reading of the original work by Wilder himself is recommended for a more in-depth treatment, because this particular oscillator is so popular among traders. We'll use it to demonstrate most of the principles of oscillator analysis. As Wilder points out, one of the two major problems in constructing a momentum line using price differences is the erratic movement often caused by sharp changes in the values being dropped off. A sharp advance or a decline 10 days ago, in the case of a 10-day momentum line, can cause sudden shifts in the momentum line even if the current prices show little change. Some smoothing is therefore necessary to minimize these distortions. The second problem is that there is the need for a constant range for comparison purposes. The RSI formula not only provides the necessary smoothing, but also solves the latter problem by creating a constant vertical range of 0 to 100. The term relative strength, incidentally, is a misnomer and often causes confusion among those more familiar with that term as it is used in stock market analysis. Relative strength generally means a ratio line comparing two different entities. A ratio of a stock or industry group to the S&P 500 index is one way of gauging the relative strength of different stocks or industry groups against one objective benchmark. We'll show you later in the book how useful relative strength or ratio analysis can be. Wilder's relative strength index doesn't really measure the relative strength between different entities, and in that sense, the name is somewhat misleading. The RSI, however, does solve the problem of erratic movement and the need for a constant upper and lower boundary. The actual formula is calculated as follows. 14 days are used in the calculation. 14 weeks are used for weekly
charts.
To find the average up value, add the total points gained on up days during the 14 days and divide that total by 14. To find the average down value, add the total number of points lost during the down days and divide that total by 14. Relative strength, RS, is then determined by dividing the up average by the down average. That RS value is then inserted into the formula for RSI.
The
number of days can be varied by simply changing the value of X. Wilder originally employed a 14-day period. The shorter the time period, the more sensitive the oscillator becomes, and the wider its amplitude. RSI works best when its fluctuations reach the upper and lower extremes. Therefore, if the user is trading on a very short-term basis and wants the oscillator swings to be more pronounced, the time period can be shortened. The time period is lengthened to make the oscillator smoother and narrower in amplitude.
The
Amplitude in the 9-day oscillator is therefore greater than the original 14-day. While 9 and 14-day spans are the most common values used, technicians experiment with other periods. Some use shorter lengths, such as 5 or 7 days, to increase the volatility of the RSI line. Others use 21 or 28 days to smooth out the RSI signals. See figures 10.10 and 10.11. Figure 10.10, the 14-day relative strength index becomes overbought over 70 and oversold below 30. This chart shows the S&P 100 being oversold in October and overbought during February. Figure 10.11, the amplitude of the RSI line can be widened by shortening the time period. Notice that the 7-day RSI reaches the outer extremes more frequently than the 14-day RSI. That makes the 7-day RSI more useful to short-term traders. Interpreting RSI. RSI is plotted on a vertical scale of 0 to 100. Movements above 70 are considered overbought, while an oversold condition would be a move under 30. Because of shifting that takes place in bull and bear markets, the 80 level usually becomes the overbought level in bull markets and the 20 level the oversold level. In bear markets, failure swings, as Wilder calls them, occur when the RSI is above 70 or under 30. A top failure swing occurs when a peak in the RSI, over 70, fails to exceed a previous peak in an uptrend, followed by a downside break of a previous trough. A bottom failure swing occurs when the RSI is in a downtrend, under 30, fails to set a new low, and then proceeds to exceed a previous peak. See figures 10.12ab. Figure 10.12a, a bottom failure swing in the RSI line. The second RSI trough, point 2, is higher than the first, point 1, while it is below 30 and prices are still
falling.
The upside penetration of the RSI peak, point 3, signals a bottom. Figure 10.12b, a top failure swing. The second peak, 2, is lower than the first one, while the RSI line is over 70 and prices are still rallying. The break by the RSI line below the middle trough, point 3, signals the top. Divergence between the RSI and the price line, when the RSI is above 70 or below 30, is a serious warning that should be heeded. Wilder himself considers divergence the single most indicative characteristic of the relative strength index. Wilder, page 70. Trendline analysis can be employed to detect changes in the trend of the
RSI.
Moving averages can also be used for the same purpose. See figure 10.13. Figure 10.13, trendlines work very effectively on the RSI line. The breaking of the two RSI trendlines gave timely buy and sell signals on this chart. See arrows. In my own personal experience with the RSI oscillator, its greatest value lies in failure swings or divergences that occur when the RSI is over 70 or under 30. Let's clarify another important point on the use of oscillators. Any strong trend, either up or down, usually produces an extreme oscillator reading before too long. In such cases, claims that a market is overbought or oversold are usually premature and can lead to an early exit from a profitable trend. In strong uptrends, overbought markets can stay overbought for some time. Just because the oscillator has moved into the upper region is not reason enough to liquidate a long position or, even worse, short into the strong uptrend. The first move into the overbought or oversold region is usually just a warning. The signal to pay close attention to is the second move by the oscillator into the danger zone. If the second move fails to confirm the price move into new highs or new lows, forming a double top or bottom on the oscillator, a possible divergence exists. At that point, some defensive action can be taken to protect existing positions. If the oscillator moves in the opposite direction, breaking a previous high or low, then a divergence or failure swing is confirmed. The 50 level is the RSI midpoint value and will often act as support during pullbacks and resistance during bounces. Some traders treat RSI crossings above and below the 50 level as buying and selling signals respectively, using the 70 and 30 lines to generate signals. Horizontal lines appear on the oscillator chart at the 70 and 30 values. Traders often use those lines to generate buy and sell signals. We already know that a move under 30 warns of an oversold condition. Suppose the trader thinks a market is about to bottom and is looking for a buying opportunity.
He or she
Watches the oscillator dip under 30. Some type of divergence or double bottom may develop in the oscillator in that oversold region. A crossing back above the 30 line at that point is taken by many traders as a confirmation that the trend in the oscillator has turned up. Accordingly, in an overbought market, a crossing back under the 70 line can often be used as a sell signal. See Figure 10.14. Figure 10.14. The RSI oscillator can be used on monthly charts. Notice the two major oversold buy signals in 1974 and 1994. The overbought peaks in the RSI line did a pretty good job of pinpointing important tops in the utilities.
Stochastique, K%D.
The stochastic oscillator was popularized by George Lane, president of Investment Educators Incorporated, Watseka, Illinois. It is based on the observation that as prices increase, closing prices tend to be closer to the upper end of the price
range.
Conversely, in downtrends, the closing price tends to be near the lower end of the range. Two lines are used in the stochastic process, the %K line and the %D line. The %D line is the more important and is the one that provides the major signals. The intent is to determine where the most recent closing price is in relation to the price range for a chosen time period. 14 is the most common period used for this oscillator. To determine the K line, which is the more sensitive of the two, the formula is.
This formula is for the cent K line of the stochastic oscillator, a popular indicator in trading. The formula, cent K equals 100 times frac C minus L14, H14 minus L14. What each part means. C equals current closing price, L14 equals lowest price over the last 14 periods, H14 equals highest price over the last 14 periods. 14, the look-back period, can be changed, but 14 is standard. What the formula is doing, it measures where the current price sits within the recent price range. If price is near the highest high, H14, cent K is close to 100. If price is near the lowest low, L14, cent K is close to 0. Simple intuition. Think of it like this. Open quote, out of the last 14 candles, how high is the current price? Close quote. Example, highest price H14 is 100, lowest price L14 is 80, current price C equals 90, cent K equals 100. Frac 90 minus 80, 100 minus 80 equals 100. 10, 20 equals 50. Price is exactly in the middle of the range. Cent K equals 50. How traders use it. Above 80, overbought, price near top of range. Below 20, oversold, price near bottom of range. Crossovers with cent D line, buy-sell signals. Key idea. This indicator does not predict the future. It shows momentum and position inside a range.
Where C is the latest close, L14 is the lowest low for the last 14 periods, and H14 is the highest high for the same 14 periods. 14 periods can refer to days, weeks, or months. The formula simply measures, on a percentage basis of 0 to 100, where the closing price is in relation to the total price range for a selected time period.
A
very high reading, over 80, would put the closing price near the top of the range, while a low reading, under 20, near the bottom of the range. The second line, %D, is a 3-period moving average of the %K line.
This
formula produces a version called fast stochastics. By taking another 3-period average of %D, a smoother version called slow stochastics is computed. Most traders use the slow stochastics because of its more reliable signals. asterisk. These formulas produce two lines that oscillate between a vertical scale, from 0 to 100. The K line is a faster line, while the D line is a slower line.
The
Major signal to watch for is a divergence between the D line and the price of the underlying market when the D line is in an overbought or oversold area.
the
Upper and lower extremes are the 80 and 20 values. See figure 10.15. A bearish divergence occurs when the D line is over 80 and forms two declining peaks while prices continue to move higher. A bullish divergence is present when the D line is under 20 and forms two rising bottoms while prices continue to move lower. Assuming all of these factors are in place, the actual buy or sell signal is triggered when the faster K line crosses the slower D line. There are other refinements in the use of stochastics, but this explanation covers the more essential points. Despite the higher level of sophistication, the basic oscillator interpretation remains the same. An alert or setup is present when the percent D line is in an extreme area and diverging from the price action. The actual signal takes place when the D line is crossed by the faster K line. The stochastic oscillator can be used on weekly and monthly charts for longer range perspective. It can also be used effectively on intraday charts for shorter-term trading. See figure 10.16. One way to combine daily and weekly stochastics is to use weekly signals to determine market direction and daily signals for timing. It's also a good idea to combine stochastics with RSI. See figure 10.17. Figure 10.15. The down arrows show two sell signals which occur when the faster percent K line crosses below the slower percent D line from above the 80 level. The percent K line crossing above the percent D line below 20 is a buy signal, up arrow. Figure 10.16 turns in the 14-week stochastics from above 80 and below 20 did a nice job of anticipating major turns in the Treasury bond market. Stochastics charts can be constructed for 14 days, 14 weeks, or 14 months. Figure 10.17. A comparison of the 14-week RSI and stochastics. The RSI line is less volatile and reaches extremes less frequently than stochastics.
the best.
Signals occur when both oscillators are in overbought or oversold territory. Larry Williams percent R. Larry Williams percent R is based on a similar concept of measuring the latest close-in relation to its price range over a given number of days. Today's close is subtracted from the price high of the range for a given number of days, and that difference is divided by the total range for the same period. The concepts already discussed for oscillator interpretation are applied to percent R as well, with the main factors being the presence of divergences in overbought or oversold areas.
C.
Figure 10.18. Ins percent R is subtracted from the high. It looks like an upside down stochastics. To correct that, charting packages plot an inverted version of
ER.
Figure 10.18. Larry Williams percent R oscillator is used in the same fashion as other oscillators. Readings over 80 or under 20 identify market extremes. Choice of time period tied to cycles. Oscillator lengths can be tied to underlying market cycles. A time period of 1/2. The cycle length is used. Popular time inputs are 5, 10, and 20 days based on calendar day periods of 14, 28, and 56 days. Wilder's RSI uses 14 days, which is half of 28. In the previous chapter, we discussed some reasons why the numbers 5, 10, and 20 keep cropping up in moving average and oscillator formulations, so we won't repeat them here. Suffice it to mention here that 28 calendar days, 20 trading days represent an important dominant monthly trading cycle, and that the other numbers are related harmonically to that monthly cycle. The popularity of the 10-day momentum and the 14-day RSI lengths are based largely on the 28-day trading cycle and measure 1/2 of the value of that dominant trading cycle. We'll come back to the importance of cycles in Chapter 14. The importance of trend. In this chapter, we've discussed the use of the oscillator in market analysis to help determine near-term overbought and oversold conditions and to alert Traders to possible divergences. We started with the momentum line.
We
Discussed another way to measure rates of change, ROC, by using price ratios. Instead of differences, we then showed how two moving averages could be compared to spot short-term extremes and crossovers. Finally, we looked at RSI and stochastics and considered how oscillators should be synchronized with cycles. Divergence analysis provides us with the oscillator's greatest value. However, the reader is cautioned against placing too much importance on divergence analysis to the point where basic trend analysis is either ignored or overlooked. Most oscillator buy signals work best in uptrends and oscillator sell signals are most profitable in downtrends. The place to start your market analysis is always by determining the general trend of the market.
If the trend is
Up, then a buying strategy is called for. Oscillators can then be used to help time market entry. Buy when the market is oversold in an uptrend. Sell short when the market is overbought in a downtrend. Or buy when the momentum oscillator crosses back above the zero line when the major trend is bullish, and sell a crossing under the zero line in a bear market. The importance of trading in the direction of the major trend cannot be overstated. The danger in placing too much importance on oscillators by themselves is the temptation to use divergence as an excuse to initiate trades. Contrary to the general trend, this action generally proves a costly and painful exercise. The oscillator, as useful as it is just one tool among many others and must always be used as an aid, not a substitute, for basic trend analysis. When oscillators are most useful, there are times when oscillators are more useful than at others. During choppy market periods, as prices move sideways for several weeks or months, oscillators track the price movement very closely. The peaks and troughs on the price chart coincide almost exactly with the peaks and troughs on the oscillator. Because both price and oscillator are moving sideways, they look very much alike.
at
Some point, however, a price breakout occurs and a new uptrend or downtrend begins. By its very nature, the oscillator is already in an extreme position just as the breakout is taking place. If the breakout is to the upside, the oscillator is already overbought. An oversold reading usually accompanies a downside breakout. The trader is faced with a dilemma. Should he or she buy the bullish breakout in the face of an overbought oscillator reading? Should the downside breakout be sold into an oversold market? In such cases, the oscillator is best ignored for the time being and the position taken. The reason for this is that in the early stages of a new trend, following an important breakout, oscillators often reach extremes very quickly and stay there for a while. Basic trend analysis should be the main consideration at such times, with oscillators given a lesser role. Later on, as the trend begins to mature, the oscillator should be given greater weight. We'll see in Chapter 13 that the fifth and final wave in Elliott wave analysis is often confirmed by bearish oscillator divergences. Many dynamic bull moves have been missed by traders who saw the major trend signal but decided to wait for their oscillators to move into an oversold condition before buying. To summarize, give less attention to the oscillator in the early stages of an important move, but pay close attention to its signals as the move reaches maturity. Moving average, convergence/divergence MACD. We mentioned in the previous chapter an oscillator technique that uses two exponential moving averages, and here it is. The moving average, convergence/divergence indicator, or simply MACD, was developed by Gerald
Appel.
What makes this indicator so useful is that it combines some of the oscillator principles we've already explained with a dual moving average crossover approach. You'll see only 2 lines on your computer screen, although 3 lines are actually used in its calculation. The faster line, called the MACD line, is the difference between 2 exponentially smoothed moving averages of closing prices, usually the last 12 and 26 days or weeks. The slower line, called The signal line is usually a 9-period exponentially smoothed average of the MACD line. Appel originally recommended one set of numbers for buy signals and another for sell signals. Most traders, however, utilize the default values of 12, 26, and 9 in all instances. That would include daily and weekly values.
C.
Figure 10.19a. The actual buy and sell signals are given when the two lines cross.
A.
Crossing by the faster MACD line above the slower signal line is a buy signal.
A.
Crossing by the faster line below the slower is a sell signal. In that sense, MACD resembles a dual moving average crossover method. However, the MACD values also fluctuate above and below a zero line. That's where it begins to resemble an oscillator. An overbought condition is present when the lines are too far above the zero line. An oversold condition is present when the lines are too far below the zero line. The best buy signals are given when prices are well below the zero line oversold. Crossings above and below the zero line are another way to generate buy and sell signals respectively, similar to the momentum technique we discussed previously. Figure 10.19 of the moving average convergence-divergence system shows two
lines.
A signal is given when the faster MACD line crosses the slower signal line. The arrows show 5 trading signals on this chart of the Nasdaq Composite Index. Divergences appear between the trend of the MACD lines and the price
Line.
A negative or bearish divergence exists when the MACD lines are well above the zero line overbought and start to weaken while prices continue to trend higher. That is often a warning of a market top. A positive or bullish divergence exists when the MACD lines are well below the zero line oversold and start to move up ahead of the price line. That is often an early sign of a market bottom. Simple trend lines can be drawn on the MACD lines to help identify important trend changes. See Figure 10.19b. Figure 10.19b. The MACD lines fluctuate around a zero line, giving it the quality of an oscillator. The best buy signals occur below the zero line. The best sell signals come from above. Notice the negative divergence given in October. See down arrow. MACD histogram. We showed you earlier in the chapter how a histogram could be constructed that plots the difference between two moving average lines.
Using that same
technique, the two MACD lines can be turned into an MACD histogram.
The
histogram consists of vertical bars that show the difference between the two MACD lines. The histogram has a zero line of its own. When the MACD lines are in positive alignment, faster line over the slower, the histogram is above its zero line. Crossings by the histogram above and below its zero line coincide with actual MACD crossover buy and sell signals. The real value of the histogram is spotting when the spread between the two lines is widening or narrowing. When the histogram is over its zero line, positive, but starts to fall toward the zero line, the uptrend is weakening. Conversely, when the histogram is below its zero line, negative, and starts to move upward toward the zero line, the downtrend is losing its momentum. Although no actual buy or sell signal is given until the histogram crosses its zero line, the histogram turns provide earlier warnings that the current trend is losing momentum. Turns in the histogram back toward the zero line always precede the
actual crossover signals.
Histogram turns are best used for spotting early exit signals from existing positions. It's much more dangerous to use the histogram turns as an excuse to initiate new positions against the prevailing trend.
C.
Figure 10.20 of the MACD histogram plots the difference between the two MACD lines. Signals are given on the zero line crossings. Notice that the histogram turns earlier than the crossover signals, giving the trader some advanced warning. Combine weeklies and dailies. As with all technical indicators, signals on weekly charts are always more important than those on daily charts. The best way to combine them is to use weekly signals to determine market direction, and the daily signals to fine-tune entry and exit points. A daily signal is followed only when it agrees with a weekly signal. Used in that fashion, the weekly signals become trend filters for daily signals. That prevents using daily signals to trade against the prevailing
trend.
Two crossover systems in which this principle is especially true are MACD and stochastics. See Figure 10.20b. Figure 10.20b. The MACD histogram works well on weekly charts. At the middle peak, the histogram turned down 10 weeks before the sell signal, down arrow. At the two upturns, the histogram turned up 2 and 4 weeks before the buy signals, up arrows. The principle of contrary opinion in futures. Oscillator analysis is the study of market extremes. One of the most widely followed theories in measuring those market extremes is the principle of contrary opinion. At the beginning of the book, two principal philosophies of market analysis were identified: fundamental and technical analysis.
Contrary
Opinion, although it is generally listed under the category of technical analysis, is more aptly described as a form of psychological analysis. Contrary opinion adds the important third dimension to market analysis, the psychological, by determining the degree of bullishness or bearishness among participants in the various financial markets. The principle of contrary opinion holds that when the vast majority of people agree on anything, they are generally wrong. A true contrarian, therefore, will first try to determine what the majority are doing and then will act in the opposite direction. Humphrey B. Neal, considered the dean of contrary thinking, described his theories in a 1954 book entitled The Art of Contrary Thinking. 10 years later, in 1964, James H. Sibbett began to apply Neal's principles to commodity futures trading by creating the Market Vein Advisory Service, which includes the bullish consensus numbers. Market Vein, P.O. Box 90490, Pasadena, California, 91109.
each
Week a poll of market letters is taken to determine the degree of bullishness or bearishness among commodity professionals. The purpose of the poll is to quantify market sentiment into a set of numbers that can be analyzed and used in the market forecasting process. The rationale behind this approach is that most futures traders are influenced to a great extent by market advisory services.
by
Monitoring the views of the professional market letters, therefore, a reasonably accurate gauge of the attitudes of the trading public can be obtained. Another service that provides an indication of market sentiment is the Consensus Index of Bullish Market Opinion, published by Consensus National. Commodity Futures Weekly, Consensus Incorporated, 1735, McGee Street, Kansas City.
Montag 64.108.
These numbers are published each Friday and use 75% as an overbought and 25% as an oversold measurement. Interpreting bullish consensus numbers. Most traders seem to employ a fairly simple method of analyzing these weekly numbers. If the numbers are above 75%, the market is considered to be overbought and means that a top may be near. A reading below 25% is interpreted to warn of an oversold condition and the increased likelihood that a market bottom is near. Contrary opinion measures remaining buying or selling power. Consider the case of an individual speculator. Assume that speculator reads his or her favorite newsletter and becomes convinced that a market is about to move substantially higher. The more bullish the forecast, the more aggressively that trader will approach the market. Once that individual speculator's funds are fully committed to that particular market, however, he or she is overbought, meaning there are no more funds to commit to the market. Expanding this situation to include all market participants, if 80 to 90% of market traders are bullish on a market, it is assumed that they have already taken their market positions. Who is left to buy and push the market higher? This, then, is one of the keys to understanding contrary opinion. If the overwhelming sentiment of market traders is on one side of the market, there simply isn't enough buying or selling pressure left to continue the present trend. Contrary opinion measures strong versus weak hands. A second feature of this philosophy is its ability to compare strong versus weak hands. Futures trading is a zero-sum game. For every long, there is also a short.
If
80% of the traders are on the long side of a market, then the remaining 20%, who are holding short positions, must be well financed enough to absorb the longs held by the other 80%. The shorts, therefore, must be holding much larger positions than the longs, in this case, 4-to-1. This means further that the shorts must be well capitalized and are considered to be strong hands. The 80% who are holding much smaller positions per trader are considered to be weaker hands who will be forced to liquidate those longs on any sudden turn in prices. Some additional features of the bullish consensus numbers. Let's consider a few additional points that should be kept in mind when using these numbers. The norm or equilibrium point is at 55%. This allows for a built-in bullish bias on the part of the general public. The upper extreme is considered to be 90% and the lower extreme 20%. Here again, the numbers are shifted upward slightly to allow for the bullish bias. A contrarian position can usually be considered when the bullish consensus numbers are above 90% or under 20%. Readings over 75% or under 25% are also considered warning zones and suggest that a turn may be near. However, it is generally advisable to await a change in the trend of the numbers before taking action against the trend. A change in the direction of the bullish consensus numbers, especially if it occurs from one of the danger zones, should be watched
closely.
The importance of open interest futures. Open interest also plays a role in the use of bullish consensus numbers.
In
general, the higher the open interest figures are, the better the chance that the contrarian positions will prove profitable. A contrarian position should not be taken, however, while open interest is still increasing. A continued rise in open interest numbers increases the odds that the present trend will continue. Wait for the open interest numbers to begin to flatten out or to decline before taking action. Study the commitments of traders report to ensure that hedgers hold less than 50% of the open interest. Contrary opinion works better when most of the open interest is held by speculators, who are considered to be weaker hands. It is not advisable to trade against large hedging interests. Watch the market's reaction to fundamental news. Watch the market's reaction to fundamental news very closely. The failure of prices to react to bullish news in an overbought area is a clear warning that a turn may be near. The first adverse news is usually enough to quickly push prices in the other direction. Correspondingly, the failure of prices in an oversold area under 25% to react to bearish news can be taken as a warning that all the bad news has been fully discounted in the current low price. Any bullish news will push prices higher. Combine contrarian opinion with other technical tools. As a general rule, trade in the same direction as the trend of the consensus numbers until an extreme is reached, at which time the numbers should be monitored for a sign of a change in trend. It goes without saying that standard technical analytical tools can and should also be employed to help identify market turns at these critical times. The breaking of support or resistance levels, trend lines, or moving averages can be utilized to help confirm that the trend is in fact turning. Divergences on oscillator charts are especially useful when the bullish consensus numbers are overbought or oversold.
Insights.
Each weekend Barron's includes in its Market Laboratory section a set of numbers under the heading Investor Sentiment Readings. In that space, 4 different investor polls are included to gauge the degree of bullishness and bearishness in the stock market. The figures are given for the latest week and the period 2 and 3 weeks back for comparison purposes. Here's a random sample of what the latest week's figures might look like. Remember that these numbers are contrary indicators. Too much bullishness is bad. Too much bearishness is good. Investors' intelligence numbers. Investors' intelligence, 30 Church Street, New Rochelle, New York, 10801, takes a weekly poll of investment advisors and produces three numbers: the percent of investment advisors that are bullish, those that are bearish, and those that are expecting a market correction. Bullish readings over 55% warn of too much optimism and are potentially negative for the market. Bullish readings below 35% reflect too much pessimism and are considered positive for the market.
The
Correction figure represents advisors who are bullish but expecting short-term weakness. Investors Intelligence also publishes figures each week that measure the number of stocks that are above their 10 and 30-week moving averages. Those numbers can also be used in a contrary fashion. Readings above 70% suggest an overbought stock market. Readings below 30% suggest an oversold market.
The
10-week readings are useful for measuring short to intermediate market turns. The 30-week numbers are more useful for measuring major market turns.
the
Actual signal of a potential change in trend takes place when the numbers rise back above 30 or fall back below 70. Asterisk the second smoothing produces three lines. Fast stochastics uses the first two
lines.
Slow stochastics uses the last two lines.